Imagine you're flying a heavy commercial jet, right? But your dashboard has two completely different instrument panels, and they just fundamentally disagree on your altitude, your speed, your fuel. I mean, if you trust the wrong panel at the wrong time, you crash. And that is the exact reality of running a liquefied natural gas trading desk today. You've got a financial system telling you one thing and a physical reality telling you something entirely different.
It's the absolute definition of flying blind.
Yeah.
Because in this market, the physical reality of moving molecules across oceans, and the financial reality of hedging them, they're just constantly diverging. And if you don't know exactly which panel to trust, well, you aren't actually managing risk. You're just kind of waiting for a catastrophic failure.
Yeah, exactly. So welcome to today's deep dive. If you are an aspiring or working LNG professional, so whether you're an originator, a quant, a risk manager, or, sitting on the chartering desk, our mission today is to give you the foundational blueprint of how an LNG trading desk actually survives and makes money. We're looking at a massive architecture today.
We really are.
Yeah, because over the course of this whole LNG trading desk master program, we are essentially building a highly durable trading business from scratch across 9 modules and 120 chapters. So we're covering everything from, module 1, just running the desk, and module 2, market structure, right through to module 3's senior trading playbooks.
Right. And then you have to get into the really heavy stuff like module 4's valuation and module skepticism and module 5, which is just about risk, credit, and sheer survival.
Right. And then module 6 is execution and shipping. Module 7 covers ETRM systems. Module 8 is regulation and conduct. And finally, module 9 rounds it out with desk leadership and legacy. It's a comprehensive journey.
It's the whole ecosystem.
Yeah.
And to make any of that work, right, we have to start at the absolute bedrock. So today we are diving into Chapter 1, what an LNG desk is accountable for. Because every optimization strategy, every risk model we build later on, it all relies entirely on the vocabulary and the baseline reality that we establish right here, right now.
Okay, let's unpack this. Let's start with that split personality you mentioned earlier. Why do those instrument panels disagree so violently?
Well, because when you strip away all the industry jargon, an LNG desk is fundamentally one of two things. It's either a logistics business with a derivatives overlay, or it's a derivatives business with a logistics liability.
Right.
The financial side of your desk, it measures itself in dollars per MMB2, million British thermal units. And it settles in cash. It's very clean. But the physical side measures itself in cubic meters, gross heating value, lake cans, berth slots. And it only actually settles when a massive physical ship ties up to a receiving terminal.
So if I'm, say, a risk manager looking at my energy trading and risk management software, my ETRM system, how do I actually reconcile those two realities? Because, if my system says I'm perfectly hedged financially, but my ship is delayed by a week in the Panama Canal, my physical position is completely exposed.
Precisely. And the two descriptions of the exact same cargo will routinely disagree by amounts that can exceed a desk's entire annual risk budget. Yeah. Because those two realities diverge so much, the very first thing we have to establish is what your desk actually owns. If you don't know what you own, you literally don't know what you're accountable for. And in the physical commodity world, ownership is entirely dictated by where title passes. Which brings us to the Incoterm divide.
Okay, let's define that for anyone who isn't, living in shipping contracts every single day. We're mainly talking about FOB versus DES, right?
Yes, exactly. So let's look at the physical reality of those two structures. FOB stands for free on board. Under an FOB purchase, title passes to the buyer the exact moment the LNG crosses the loading flange of the liquefaction plant.
So right as it gets on the ship.
Right. And from that exact second, your desk owns the entire laden voyage across the ocean. You own the boil-off gas, you own the freight risk, you own the discharge risk at the other end.
And DES is the opposite.
Right. DES stands for Delivered Ex-Ship. So under a DES purchase, your desk takes title at the discharge manifold at the receiving terminal. So the seller owns the voyage and all the risks of getting it there. It's the exact same cargo moving between the exact same two ports, but it represents a completely different universe of exposure for your desk.
And this is where that Hollywood image of a trader just shouting at a screen to buy low and sell high completely falls apart, doesn't it? Because a real LNG trader's day is entirely dictated by these physical logistics.
Entirely. Your working day is a sequence of decisions made under a deadline set by a ship, not by a financial exchange. You're sourcing cargoes against term commitments. You are optimizing, which basically means deciding where specific cargo should geographically go to capture the most value.
You're finding the best home for it.
Exactly. You're fixing vessels against a global fleet that you probably don't even own. You're hedging, scheduling, and you're monitoring the voyage for, the inevitable disruptions.
And all of that physical and financial activity rolls up into what the chapter identifies as the big three true accountabilities of the desk, right? So that's P&L, risk, and conduct.
Correct. So first, P&L. This is your actual economic result over time. It is not just the daily accounting number your ETRM system spits out. A desk that optimizes for the reported accounting number instead of the actual physical economic reality, well, they'll look like geniuses for about 2 quarters before reality violently catches up to them.
Yeah, the math always wins.
Exactly. And second is risk. This is the actual exposure you hold in the market. In LNG, one single cargo carries price risk across multiple indices, volume risk from the plant and the voyage, and destination optionality.
I want to dig into that third accountability, though, conduct, because the course material makes a really sharp distinction here. Conduct isn't just about protecting your reputation. Conduct is an existential regulatory accountability.
It really is. It's the only accountability that can end your career and shut down the firm while the desk is still highly profitable. We often conflate conduct with reputation. But reputation isn't the accountability itself. Reputation is simply the corporate fallout. What happens when your conduct fails. You are strictly accountable to regulators, to counterparties, and to your board for how you obtained your P&L.
Which naturally leads us to who you actually answer to. And here's where it gets really interesting. Because we have to look at the massive structural contrast between a U.S. desk and an EU desk. Because even if a U.S. desk and an EU desk are trading the exact same molecules on the exact same ocean, they're governed by completely different realities.
It's a vital lens for anyone operating in this space. Yeah. So let's look at a typical U.S. desk first. They're usually selling FOB out of the Gulf Coast. Their home benchmark is Henry Hub, which is quoted in U.S. dollars per MMBtu.
Right, the standard U.S. gas price.
Yep. And from a regulatory standpoint, they answer to domestic authorities. So they need the Department of Energy, the DOE for export authorizations. They deal with ARRC for infrastructure and pipeline regulations.
Sure.
They answer to the CFTC for market conduct. And for counterparty screening, they're primarily navigating OFAC sanctions.
But if I'm sitting on an EU desk buying that exact same cargo from the U.S., my operating reality is completely inverted.
It is a totally different universe.
Yeah.
The EU desk is typically buying DES or maybe FOB into Europe. Their home benchmark is the TTF in Europe, which is quoted in euros per megawatt hour.
Not dollars per MMBtu.
Right. Different currency, different unit. Or, if they're optimizing into Asia, they're pricing against the JKM benchmark. They answer to REMITE for market conduct, which is supervised by ACER and various national authorities. And they're dealing with EU sanctions packages, which are incredibly complex, and they reach deeply into vessel ownership and terminal services.
So how does that difference actually change the day-to-day workflow of the trader? Like, why does it matter that one is dealing with the CFTC and the other is dealing with ACER?
Because of a crucial regulatory asymmetry. A U.S. desk primarily acquires what we call permissions. You get a DOE export authorization. You obtain it once, and you simply check it per transaction. It's like a static gate. You pass through it and you trade. An EU desk, however, primarily acquires demonstrations.
Demonstrations?
Yeah, these are dynamic, heavy obligations that have to be actively reproduced for every single cargo.
Give me an example of a demonstration.
Okay, think about the European methane MRV equivalence rules. That's monitoring, reporting, and verification. Under those rules, the regulatory obligation falls entirely on the importer. So the EU desk has to actively demonstrate that the methane emissions at the producer level in the U.S. meet strict European standards.
Wow, so the buyer has to prove the seller is compliant.
Exactly. That compliance burden is massive and is completely invisible to the U.S. producer sitting in Houston. The U.S. producer doesn't carry that direct regulatory exposure. So you have the exact same cargo, opposite ends of one contract, but the EU desk has this dynamic compliance exposure that the U.S. desk literally cannot see.
To really see how these physical realities hit the bottom line, let's look at our first desk-level work example. Let's put some real numbers to the U.S. desk. Imagine I'm sitting on a U.S. desk. I lift a cargo FOB from a Gulf Coast plant. My cost is priced against Henry Hub plus a fixed liquefaction fee. I turn around and sell that cargo DES into Northwest Europe, generating revenue priced against the TTF benchmark. So I buy a Henry Hub, sell at TTF. It sounds like a perfectly locked-in margin.
On a financial spreadsheet, it looks beautifully locked in. But let's look at the physical volume reality, the mismatch between what you pay for and what you actually invoice.
Okay.
Under your FOB purchase, you take title at the loading flange in Texas, so you pay for the loaded quantity.
Okay.
But because you sold it DES to Europe, you only invoice your buyer for the delivered quantity that actually comes out of the discharge manifold a month later.
Wait, so what happens to the gas in between?
It evaporates. I mean, LNG is literally a boiling liquid.
Hmm.
So during the voyage, you experience boil-off, which is the natural evaporation of the cargo, which is actually often consumed by the ship itself as fuel. And on top of that, you have the heel.
The heel.
Yeah, that's the volume of LNG deliberately left in the ship's tanks after discharge, just to keep them cold for the return trip.
Okay.
So on a standard modern cargo, the difference between what you paid for at the loading flange, what you actually deliver to your buyer, might be, say, 132,621 MMBtu.
That's ghost gas. I'm paying for it at Henry Hub, but it never arrives in Europe for me to invoice at TTF. I mean, if Henry Hub is, say, $3, I'm looking at nearly $400,000 per cargo that just vanishes into the atmosphere. If my ETRM system just has a single static volume field for a cargo, it is completely lying to me about my risk.
It will totally misstate your purchase exposure, your sale exposure, or usually both. And this leads directly to the most common and honestly lethal beginner mistake on a U.S. desk, the one-for-one hedge. A junior trader looks at the system, sees one cargo bought and one cargo sold, and thinks, oh, I'll just hedge one cargo's worth of Henry Hub against one cargo's worth of TTF.
But the volumes don't match, so how do you actually calculate the correct hedge?
You have to factor in two massive multipliers. First, the liquefaction plant itself requires fuel to run its massive compressors. That is built into your contract in a feed gas multiplier, which is commonly around 115%. Meaning, to produce 100 units of LNG, you actually have to buy 115 units of raw feed gas from the pipeline network.
So right off the bat, my cost exposure to Henry Hub is 15% larger than the physical cargo I'm putting on the ship.
Exactly. Then you add the void shrinkage we just discussed, the boil off and the heel. When you do the math, a 115% feed gas multiplier plus the physical voyage shrinkage result in a true hedge ratio of roughly 1.19. If you just hedge one for one based on the delivered volume, you are leaving hundreds of thousands of MMBtus of Henry Hub entirely unhedged. You think your book is flat, but you have a massive open risk position.
And the mechanics of the hedge trip people up too, don't they? If I'm buying physical gas on a floating price, how do I hedge it?
By buying futures. If your U.S. desk has a floating price purchase agreement for that feed gas, you hedge that cost by going long on Henry Hub futures. You want the financial derivative to pay out if the physical cost of your gas goes up.
Right.
It sounds so basic, but getting this backwards selling futures to hedge a purchase is a fatal flaw that literally doubles your market exposure instead of neutralizing it.
Okay, so the U.S. desk's nightmare is miscalculating volume, feed gas multipliers, and ghost gas. But what about the EU desk? Let's flip the perspective. How does the EU desk fail?
Well, if the U.S. desk gets killed by volume math, the EU desk gets killed by contractual obligations colliding with the global shipping fleet. Let's look at a case study of an EU desk getting it entirely right on price, but totally wrong on freight.
Set the scenario up for us.
Okay, your EU desk holds a long-term supply contract that is priced off crude oil, typically dated Brent. You have a cargo loading in the Middle East, and your desk has to make the ultimate optimization decision. Where do we send it? You can send it to your home market in Northwest Europe to sell against TTF, or you can utilize your destination flexibility clause and send it to Japan to sell against the Asian JKM benchmark.
Okay, so let's say crude oil is trading really high, but European gas prices, TTF, are relatively weak. Sending oil-indexed LNG into Europe in that environment is a massive liability.
It is a structural loss maker. The cost of your cargo is fixed based on that high Brent crude index. Let's say the physical cargo costs you just over $40 million. If you discharge it in Europe at prevailing TTF prices, the math dictates you will lose over $5 million on that single cargo. The home market is completely underwater.
Ouch.
But if you look at Asia, JKM prices are higher. If you send it to Japan, you make a $3.2 million profit.
So the decision is obvious, right? I exercise my destination flexibility clause, divert the cargo to Asia, avoid the $5 million loss, and lock in the $3 million profit. I mean, it's an $8+ million swing. I'm a hero on the desk.
You are a hero provided you actually have a ship. And this is what we call the fifth uncertainty of LNG. Steel on water. Every commodity trader manages volume, price, location, and timing. But LNG adds a fifth dimension. which specific vessel from a global fleet you do not control is actually going to carry this gas and at what daily cost.
Wait, so even if my contract gives me the legal right to divert this cargo to Asia, if I don't already have a vessel chartered, I am completely at the mercy of the spot freight market to execute that right.
Entirely at their mercy. And here's how the mechanics of that market just crush you. Let's say in a normal environment, your budgeted term freight rate is $85,000 a day. But you need this ship during a winter squeeze, exactly when Asian prices are spiking, maybe the Panama Canal is congested, and vessels are scarce. The spot charter rate can easily explode to $300,000 a day.
Wow. Let's do that math. That is an extra $215,000 a day over a standard, 30-day voyage?
Down there?
That is $6.45 million in extra freight costs.
Exactly. That difference alone eats almost $6.5 million of your margin. Your desk correctly read the gas market. You were completely right to divert to Asia to chase the higher price, and yet you end up handing almost a full cargo's worth of value directly over to the ship owner.
Unbelievable.
In LNG, the transport constraint is not just a pipeline right that you either hold or you don't. It is a physical global fleet, and spot freight prices are highly correlated with the exact macro events that make your cargo valuable in the first place.
So a legal right you can't actually transport is basically just a sentence in a contract.
Right.
If your ETRM system is modeling the full value of that Asian destination option, but ignoring the spot freight volatility required to get it there, it is feeding you a fantasy.
Which brings us to the ultimate contractual trap, one that bridges both the US and EU experiences and can wipe out a desk entirely overnight. We really need to talk about the asymmetry of force majeure.
Okay, because losing $6 million to a ship owner hurts, but force majeure asymmetry is what actually breaks the firm, isn't it?
It is an acute catastrophic failure. Let's look at a composite example based on a major physical outage, like the fire at the Freeport LNG facility in Texas back in 2022. That single event took a fifth of U.S. liquefaction offline instantly.
Right. So put us in the seat of a portfolio desk during that outage. I have a supply agreement to buy gas from that U.S. plant, and I have a separate sale agreement to deliver that exact volume downstream to a buyer in Europe. I've matched my volumes perfectly. I feel fully hedged.
You feel hedged until the legal reality hits. So the U.S. plant catches fire and declares force majeure. Legally, the plant is excused from delivering the gas to you. You don't have to buy it. You are protected on the supply side. But, and here's the fatal question, does your downstream sale contract to your European buyer contain a matching relief clause?
If it doesn't, I am still legally obligated to deliver physical gas to Europe, but my supply just vaporized.
Precisely. Treating a matched volume purchase and a matched volume sale as a perfectly offset risk is a really dangerous illusion if only one side of that transaction can be legally excused in an emergency. You are now short physical gas in a global market that is panicking because a major U.S. plant just went offline.
So I am forced to go into the spot market, bid against everyone else who is panicking, and buy replacement gas at exorbitant prices just to fulfill my downstream sale.
Exactly. In our composite numbers for this scenario, your desk originally expected to make a $21 million profit on that perfectly matched trade. Instead, because you had to buy replacement spot gas at the very top of a panic market, you take a $20 million loss. It is a $41 million swing in P&L, caused entirely by missing contractual symmetry.
Which begs the obvious question. Why on earth didn't the desk fix this asymmetry before the plant caught fire? I mean, if you know your contracts don't match, you fix them.
Because of what the chapter calls the control loop and the shrinking window of optionality. On an LNG desk, your optionality shrinks from left to right across the chronological life of a trade.
Left to right.
Yeah, so the stages are deal, nomination, load, voyage, and discharge. Your ability to control the outcome is at its absolute highest before the contract is signed at the deal stage, right on the left. And it is at its absolute lowest when the ship is sitting at the discharge terminal on the far right.
So if I spot this force majeure mismatch during the contract negotiation, the deal stage, how much does it cost me to fix?
It costs you a legal fee and some negotiation capital with your counterparty. Let's call that cost 1x. But if you fail to decompose your exposure, ignore the contractual risk and only try to fix the problem when the loss crystallizes at discharge.
Well, our analysis shows the cost to intervene is 18 times higher.
18 times.
Yeah.
Failures on LNG desks are chains, not isolated events. The chain is cheap to break early, and it is almost impossibly expensive to break late.
That is a staggering multiplier. Okay, we have covered an incredible amount of ground today. Let's step back and summarize the absolute foundational necessities for the listener. Number one, you must know whether your desk holds permissions or demonstrations. because that dictates your entire regulatory survival and your operational workflow.
Number two, you cannot just look at flat volume fields. You have to calculate the volume that actually arrives, accounting for boil-off and feed gas, and apply the true 1.19 hedge ratio. Number three, you must secure your steel on water before banking and arbitrage, or the ship owner eats your entire optimization margin. And finally, relentlessly match your force majeure clauses, or your perfectly matched book is just an illusion waiting to explode.
That is the bedrock of accountability. And now that we know exactly what an LNG desk is accountable for, Chapter 2 is going to pull apart the spectrum between physical and financial desks. We're going to reveal which of the 5 specific sources of result your particular desk is actually equipped to capture and which ones it is structurally locked out of.
So bringing it all back to your desk right now, think about your own ETRM system. If your digital risk software records a physical cargo as just a single flat volume field, ignoring boil-off entirely, and if it models the full value of a destination clause without factoring in the spot freight volatility required to actually execute it, well, is your software really managing your risk? Or is it just generating a highly precise illusion of safety? Keep that firmly in mind the next time you look at your position screen, and we will see you in Chapter 2.
So, imagine you have this bulletproof view of the market, right? You know exactly what is going to happen next.
Right, which is basically the dream scenario for any trader.
Exactly. So you want to execute a trade, and you essentially have 2 choices here. You can execute this trade on a digital screen, just strictly on paper, and the margin for that is about $1.6 million.
Okay, pretty standard.
Right, yeah. But your other choice is to express that exact same market view in the physical world. And if you do that, it's going to cost you nearly $24 million. It's the exact same trade, just physical.
Yeah, that is just a massive, massive jump.
It's 14.22 times more capital, to be exact. So the question is, why on earth would any rational trading desk choose to tie up 14 times more capital just to do the exact same trade physically?
Well, I mean, that staggering multiplier is just the reality of the market. And it's actually the exact question that separates a desk that survives from one that, goes completely under.
Because it's not just about capital, right?
No, not at all. Because the answer isn't just about having more money to spend. It fundamentally changes what you are allowed to earn. And, well, more importantly, it changes the risks you are taking on.
Which is exactly what we are getting into today. Welcome to today's deep dive. If you're listening to this, you are stepping directly into the shoes of an elite LNG trading and risk management consultant from Durga Analytics.
It is a great place to be.
It really is. And just to remind everyone of the overarching framework here, we are navigating the LNG Trading Desk Master program. So that's a sequence journey across 9 modules and 120 chapters, covering everything from the actual physics of liquefaction all the way to P&L.
Right, the whole value chain.
Exactly. And today, we are firmly in Module 1, which is running an LNG trading desk. Specifically, we are unpacking Chapter 2, Physical versus Financial LNG Desks.
Which is such a crucial chapter.
It is. Our mission today is to break down why desks deliberately take on that massive physical capital cost, the hidden dangers of what we call the obligation ladder, and the really massive structural differences between running a U.S. desk and an EU desk.
Yeah, and to really understand how a modern desk operates, I think we have to start by completely shattering a very common industry binary.
Oh, the physical versus financial question.
Exactly. When executives or, new traders sit down to build a desk, they almost always ask, are we a physical desk or a financial desk?
And framing it that way is just a trap, right?
A massive trap. I mean, answering that question as a strict either or will fundamentally misdesign your desk and your risk systems from literally day one.
Because it's not a category.
Right, it's a spectrum.
Yeah.
So on the far left, you have pure paper. Swaps and futures with absolutely no physical delivery whatsoever.
Just digits on a screen.
Exactly. Then moving right, you have paper with a physical option. Then you get into spot physical trading, then portfolio trading, and all the way on the far right, you have asset-backed trading with equity liquefaction or regasification capacity.
So basically, nothing on this spectrum is inherently better or more sophisticated than the rest?
No, not at all. Your position on the spectrum just dictates what you can earn.
Which brings us right back to that 14.22 times capital cost. Because if a purely financial paper desk is so capital efficient, if it only costs $1.6 million in margin instead of $24 million in cash at loading, why do desks deliberately move to the right side of that spectrum?
They do it because, well, a purely financial desk is locked out of the majority of the actual value in liquefied natural gas.
Okay, unpack that for us.
Sure. So in LNG, there are essentially 5 sources of financial result. If you are a purely paper desk, 2 of those 5 are completely closed off to you, and a third is really only half open.
Wow, okay, so what can they actually access?
On paper, you can trade the flat price of gas, and you can trade paper basin spreads.
Like the difference between Europe and Asia.
Exactly. But you absolutely cannot access freight optimization. You cannot access boil off. And you are just entirely locked out of contract optionality.
And contract optionality is arguably like the golden goose over a full market cycle.
Oh, absolutely.
Let me try an analogy here to ground this for the listener. It sounds to me like paper trading versus physical trading is a lot like renting a hotel room versus building and owning the actual hotel.
Okay, I like where this is going.
Right, so renting the room, which is the paper trade, it's clean. You get a place to stay. You get exposure to that location's value for the night. And, if you don't like it, you just check out.
Yes, exactly. And building the hotel takes vastly more capital upfront and comes with just endless operational headaches.
Right, you have to maintain the plumbing, hire staff, deal with zoning laws, all of that.
But by owning the physical asset, you have so many more levers to pull to actually generate revenue.
Exactly. Like you can charge for the minibar, which is basically like optimizing your boil-off gas in LNG.
Yes, perfect comparison.
And you can rent out the conference rooms, which is like subletting your shipping capacity, so that's your freight. And you can eventually sell the underlying property when the market peaks, which is your contract optionality.
That is a phenomenal way to visualize it. I mean, 2/3 of the value in LNG sits in that physical optionality and logistics. You simply cannot buy the minibar revenue or the conference room rentals on a trading screen.
You have to own the physical reality.
Right. But this is also a really severe warning. A desk that takes on physical risk to reach those extra revenue streams, but fails to actually build the operational and risk systems to manage them, well, they've basically bought the liability of the hotel without setting up a way to collect the rent.
Which is a disaster.
Yeah.
And that raises a really interesting operational question. If physical trading is so capital intensive and complex,
Yeah.
why do so many firms run hybrid books? Because almost every major LNG player I look at has both a paper book and a physical book operating at the exact same time.
Yeah, and they do that because a hybrid structure is incredibly sound design, provided it has the right governance.
Okay.
A physical book rarely survives perfectly on its own in modern markets. The paper book basically acts as a vital support system.
How so?
Well, it supplies the physical book with hedges for the massive index exposure that physical cargoes create. It also provides price discovery at weird tenors.
Meaning those highly specific delivery dates, like months or years out, where no physical cargo is actively trading to give you a clear price.
Exactly. And it gives traders a way to hold a market view without tying up a massive physical vessel.
So having both books isn't the issue.
Not at all. The trap is when a single risk mandate governs both books. When you have one set of limits covering both physical and financial activity interchangeably, the desk inevitably experiences what we call drift.
Drift. And that drift pushes a trading desk up something called the obligation ladder, right? And this almost always happens without management noticing until it's far too late.
Yes, exactly.
I really want to dig into this obligation ladder because this is where the mechanics of risk seem to be completely misunderstood by most people who are just looking at a spreadsheet.
It is wildly misunderstood.
So you've got to visualize this ladder as a staircase of commitment. As a cargo moves through its life cycle, the cost to reverse your decision doesn't just go up linearly. It multiplies violently at every single step.
And this isn't just, theoretical modeling. Let's look at the actual numbers for unwinding a single standard LNG cargo of roughly 3.7 million MMBtu.
Yeah, let's walk through these because the escalation here is honestly terrifying. So rung one is your cash-settled paper position. Let's say you want to change your mind and exit that trade.
Right.
It takes a few clicks on a screen, and the transaction cost is about $187,000. So that is our baseline cost. We'll just call that 1x.
Okay, pretty manageable.
Right. Then at rung two, you are physically settled but haven't committed a vessel yet. Your exit cost jumps slightly to 1.8x or about $337,000.
Still fairly normal for a trading desk.
But then someone on the chartering desk goes out and fixes a vessel for that cargo. We hit rung three.
Right, rung three, you fix a vessel.
And your exit cost doesn't just nudge up. It skyrockets to 7.8 times your baseline.
Yeah.
You are now looking at nearly $1.46 million just to walk away. Why such a massive jump? just for booking a ship.
Because you aren't just clicking sell on a screen anymore. To reverse that decision, you have to unwind a physical charter party agreement.
Oh, so you're dealing with real people and hard assets now.
Exactly. You are now dealing with ship owners who expect to be paid for the time you reserved. You have to pay kill fees. You might be on the hook for deadweight tonnage if they can't find another cargo immediately, and you have to negotiate this exit manually.
It's a whole legal and operational mess.
And notice who usually charters that vessel. It's often someone on the operations or chartering team who doesn't even think of themselves as taking a quote-unquote position in the market.
Right. They're just doing their job securing transport.
Exactly. Yet their operational action just quadrupled the trading desk's financial exit cost.
That is wild. And that brings us to rung 4, which is when the cargo is loaded and physically out at sea. The exit cost there jumps to 17 times the baseline, so over $3.1 million.
But it's rung 5 that really is the killer.
Yeah, rung 5 blew my mind. This is the ultimate trap. This is the moment you fix the discharge slot at a terminal and you formally nominate a buyer.
Right.
The cost jumps to 26.4 times the baseline. We are talking almost $5 million just to change your mind. Now, coming from standard corporate logistics, nominating a buyer sounds like a totally routine administrative task.
Yeah.
Why on earth is an ops team checking a box triggering a $5 million liability?
Because treating it as checking a docs is the fatal flaw of a poorly designed LNG desk. When you hit rung 5 and nominate that buyer for that specific discharge slot, you are no longer dealing with a clearinghouse or a single ship owner.
You're dealing with a crowd.
Yes, you have just committed 3 distinct counterparties to a tightly orchestrated plan. You have the buyer, the vessel operator, and the physical terminal. You have locked in a physical terminal berth that has its own incredibly rigid schedule. You cannot simply undo that without triggering massive penalties across all 3 entities.
So the operations team thinks they're just doing paperwork, but the trading desk has just literally bolted itself to a physical reality.
Precisely. This is the exact moment the desk completely loses the ability to pivot cheaply. If the market suddenly shifts and you want to send that gas elsewhere, you have to buy your way out of terminal slot penalties, and you potentially have to break a supply contract.
It's not just a trade anymore.
No. On the obligation ladder, delegating the nomination to someone who isn't tracking risk basically means you are delegating the decision to stop being able to change your mind.
That's a great way to put it. And if you think rung 5 is severe, look at what happens at rung 6.
Right, rung 6.
This is when the downstream customer is actually supplied. The multiplier is 5 to 6x. The cost is $10.49 million, which the notes call a distressed replacement cost.
Yes, because at rung 6, there is no exit at any price you can proactively control.
It's totally out of your hands.
Completely. If you fail to perform at this stage, it is a non-performance event, not a financial margin call.
Right, those are very different things.
Very different. A margin call is a demand for cash against a paper position you can still close. A failed discharge is a demand for physical performance you literally cannot supply. And the penalties are usually based on whatever extortionate price the buyer has to pay to replace your gas on 0 notice.
So how does a modern desk actually fix this? Because if I look at a standard risk report, it just shows my MMB2 exposure, just my baseline energy delta.
Right.
It doesn't show any of this escalating logistical danger.
No, standard reports completely miss it.
So what is the practical day one solution for a risk manager?
Well, the consultant's desk-ready fix for this is brilliantly simple, and the best part is it doesn't require multi-million-dollar software upgrades. You just have to stop only measuring MMB2 exposure.
Okay, so what do you add?
Because 2 desks can have the exact same MMB2 position on paper, but differ by a factor of 26 in what it actually costs to exit those positions. So to fix this, you add exactly 2 columns to your daily position report.
Just 2 columns.
Just 2. You add the ladder rung that specific cargo is currently on and the cost to reach flat.
The cost to reach flat, that is such a brilliant metric. It's really the only honest dollar value statement of what the desk can actually survive if everything goes completely wrong.
Yes, exactly. It forces honesty.
So we've established that taking physical control of this gas creates a massive financial web of ships, terminals, and counterparties. But here's where the structure of a desk gets really tested.
So the regulatory side.
Exactly. Because the moment that physical gas crosses a border, you aren't just dealing with counterparties anymore. You are fundamentally triggering governments and regulators.
And this regulatory burden looks completely different depending on whether you are sitting on a U.S. desk or an EU desk.
This is one of the most critical structural contrasts in the entire program, right? A desk built for the U.S. Gulf Coast will fail spectacularly if you just copy-paste it to Europe. and vice versa.
Oh, 100%. Let's look at the U.S. desk first. When a U.S. desk moves from paper to physical trading, they are primarily dealing with the acquisition of permissions.
Okay, so what exactly falls under permissions? Like, what are they asking for?
Well, it starts with export authorizations under Section 3 of the Natural Gas Act. Remember, a paper swap has no destination, it's just numbers. But a physical cargo has to go somewhere.
Right. It physically exists.
And the U.S. government treats exports to free trade agreement destinations very differently from non-FTA destinations. Non-FTA destinations require a lengthy public interest finding.
Right.
So you need permission for where the gas actually lands.
That makes sense.
Second, moving to physical gas attracts dual anti-manipulation scrutiny.
Right, because if you are just trading cash-settled paper, you sit cleanly under the jurisdiction of the CFTC. They just look at the screens.
But the moment you combine physical control of gas with a benchmark-settled hedge, you attract both the CFTC and FERC.
The Federal Energy Regulatory Commission.
Exactly. And crucially, neither agency is bound by the other's view.
Wait, really? So they can look at the same thing and disagree?
Yes. What the CFTC considers a totally normal paper hedge, FERC might view as an attempt to manipulate the physical pipeline price to benefit that hedge.
Oh, wow. That sounds like a compliance nightmare.
It really is. And finally, your sanctions screening just explodes. On paper, you only screen the financial counterparty. In physical, you have to screen the counterparty, the actual vessel, the ship's owner, the ship manager, the flag it flies, and its prior port calls.
Right. Okay, so the U.S. desk is entirely structured around permissions, authorizations, and dual agency scrutiny. What about the EU desk? How is that different?
For an EU desk, it's not about permissions, it's about demonstrations. And these are relatively recent, incredibly heavy obligations attached specifically to the act of importing gas into Europe.
Like the origin verification rules.
Exactly. Under the regulations designed to phase out Russian gas, imports into the EU need prior authorization, and the country of production must be actively verified, not just assumed based on some certificate.
And again, a paper position doesn't have a country of production.
Right. But the heaviest burden by far is methane MRV equivalents.
MRV, so monitoring, reporting, and verification.
Oh?
Yeah, basically tracking the actual carbon and methane footprint. And the catch here is huge, right? The EU makes the importer the point of obligation, not the producer.
Which is just a massive paradigm shift. When an EU desk crosses from paper to physical, they acquire a demonstration burden at the producer level for cargoes they themselves did not even produce.
So wait, they have to prove to European regulators that the gas they bought from a third party halfway around the world was extracted and liquefied in a way that meets European emissions standards. That's intense. Let me try to synthesize this with another analogy. So a U.S. desk is acquiring permissions. It's a lot like getting your driver's license. You go to the DMV, you do the paperwork, you get the license once, you keep it in your wallet, and, maybe it gets checked if you get pulled over.
Okay, yeah.
But the EU desk is acquiring demonstrations. That is like having to pass your driving test all over again for every single trip you take to the grocery store, with the DMV sitting in the passenger seat actively tracking your vehicle's emissions.
Yes. And building on that, imagine having to prove to the DMV how the factory that built your car managed its emissions.
That is just wild.
It is. A permission is obtained once and checked occasionally. A demonstration must be reproduced for every single cargo for every competent authority on request.
Which explains why the structure of the desk is so different.
Exactly. This demonstration burden dictates your middle office headcount years in advance. It is a recurring daily workload proportional to your cargo count. It's not just some one-off legal exercise you hand to the compliance team once a year.
And the EU desk has one more massive structural difference on its obligation ladder that we haven't talked about, right? The regasification slot.
Oh, yes. For an EU desk, terminal regasification capacity, which is basically the physical slot at a port to turn the liquid back into gas, becomes a major balance sheet item. You book it in advance to ensure you have market access, and you pay for it whether you use it or not.
Okay, and in our standard chapter economics from Durga Analytics, that regas slot fee is $1.2 million per cargo.
Correct.
Okay, so let's put you, the listener, in a scenario. You are running an EU desk. You hold a booked regas slot in Europe, but the Asian market suddenly spikes. You realize you have a massive diversion advantage, like you can send your ship to Asia instead of Europe and make an extra $8.45 million in profit.
A great day for the trader.
Right. So you tell your operations lead to divert the ship. The ops lead says, great, But that European regas slot is a sunk cost, so we just have to eat the $1.2 million fee.
And this is exactly where a consultant steps in and stops everything, because that operations lead is making a massive quantifiable error that happens, frankly, all the time.
Wait, hold on. I know exactly what you're going to say. That is a massive mistake because it isn't actually sunk.
It is not a sunk cost. If you actively release that slot back to the terminal, you can typically recover about 60% of the value on the secondary market.
Wow.
That is $720,000 per cargo in recovered capital. And desks routinely fail to do this because they structurally treat it as sunk.
Just structurally baked into their process.
Right. So if you have a 20 cargo program and your operations team fails to click the release button, you are leaving $14.4 million on the table purely because of an administrative omission.
Think about that for a second. We aren't talking about bad trade or some market crash. We are talking about $14.4 million evaporating because someone on the ops team literally just forgot to send an email releasing a slot.
It happens.
But it gets worse than just lost cash in Europe, doesn't it?
Much worse. In several European regimes, use it or lose it, regulations aren't just polite suggestions. They are strict legal obligations. You can actually be compelled by regulators to offer unused capacity back to the market to prevent hoarding.
Oh, wow.
So a desk that fails to release its capacity might be committing a regulatory breach while simultaneously setting $14.4 million on fire.
That is a terrible Tuesday. Let's bring all of these concepts together with the case study provided in the chapter. They call it the constructed composite, but it perfectly represents a pattern of failure that genuinely ruins real trading desks.
It really does.
So we start with a desk that was mandated, strictly on paper by their executives, as a financial trading operation.
Exactly. Their risk reporting, their limits, their capital allocations, everything was designed and built exclusively for rung one of the obligation ladder.
But then the drift begins. Over 18 months, they make a series of totally reasonable incremental decisions. First, they add a physically settled spread just to improve their execution pricing.
Which puts them on rung two.
Right. Then they take on a single physical cargo just to test out a new relationship with a supplier.
And then they take on a short-term charter to avoid demurrage exposure, those massive daily penalty fees when a ship is stuck waiting at port. So suddenly they are on rung three.
And finally, they grab a cheap regas slot because they figured it might be useful for optionality. Before they even realize it, they have drifted all the way to rung 5.
Yep, the trend.
Their capital requirement has 14x'd. Their exit cost has gone from $187,000 to nearly $5 million. If they want to exit their position, they now need the manual agreement of a physical terminal, a ship owner, and a buyer. But what did their daily risk report show the executives?
The risk report just showed a standard long position of 3.7 million MMB2 of delta.
Just their baseline exposure to the price of natural gas.
Right, because that is what the original financial mandate asked the software to measure. It measured price exposure, not physical obligation. The drift was entirely invisible to their risk systems. Nobody actively approved this massive transition in risk appetite. It just happened incrementally because they didn't track their ladder rung.
It's a terrifying reality check for anyone managing risk. If you're listening to this and you run a business, you know how easy it is for scope creep to happen. Well, in LNG, scope creep doesn't just cost you a few extra hours. It pushes you up the obligation ladder into a multi-million-dollar trap.
It really does.
So let's distill the key takeaways from this module. First, remember that physical versus financial is a spectrum, not a binary. Your position on it dictates exactly what revenue streams you can access, like the minibar in our hotel analogy, and what liabilities you must survive.
Second, respect that 14.22x capital ratio. It is the mandatory price of admission to access freight optimization, boil off, and contract optionality.
And third, fix your risk reporting immediately. Know exactly what rung of the obligation ladder every live position sits on, and track the hard dollar cost to reach flat.
Yes. And finally, design your middle office for the reality of your geography. U.S. desks must be built to manage permissions and dual agency scrutiny, while EU desks must be staffed to manage continuous cargo-by-cargo demonstrations like MRV equivalents.
Which gracefully bridges us to where the program goes next.
Indeed it does. So in Chapter 3, the Durga Analytics program pushes to the far right-hand end of the spectrum. We will move past spot physical trading and look deeply into portfolio and asset-backed trading.
That sounds fascinating.
We will explore situations where a desk deliberately commits to a fixed physical cost before they have any market position at all. And in doing so, we will actually price the single most valuable and most misunderstood option in all of LNG.
I cannot wait to unpack the mechanics of that. But before we go, I want to leave you with a final thought to mull over. Taking these lessons beyond just the LNG trading floor, we talked about how treating a massive logistical commitment like a routine administrative task pushed a desk into a $5 million trap,
Right.
and how failing to click release on a regas slot burned $14 million. So in your own line of work outside of LNG, what quote-unquote administrative boxes are your operations teams checking right now that might actually be pushing your business up an invisible, irreversible obligation ladder? You step onto a trading desk and, the very first rule of business you ever learned, which is if something is losing money, you just stop doing it well, that suddenly completely reverses.
Right. Yeah, it really does.
You find yourself in this absolutely terrifying scenario where stopping the pain is actually the exact thing that kills the firm.
It is, it's the ultimate paradox of physical commodity markets, right? We are all conditioned to cut our losses.
Right.
If a
Exactly.
stock tanks, you sell it. If a product line fails, you shut it down. But when you are operating an asset-backed LNG desk, that instinct won't just lose you money. It will honestly likely get you fired by the end of the quarter.
Which is wild. And that counterintuitive reality is exactly what we are unpacking today for you. We are continuing our journey through the LNG Trading Desk Master Program.
Yes, we are.
And for those of you following along in the curriculum, we're currently in Module 1, which is running an LNG trading desk. And today we're tearing into Chapter 3, Portfolio LNG versus Asset-Backed LNG Trading.
And we really need to look at this not by what a desk calls itself in, like a press release or on their website, but by the cold, hard arithmetic of where their costs actually sit.
Okay, let's unpack this, because we are doing this by looking through the lens of your actual desk operations, right?
Yeah, exactly. I mean, through years of consulting at Durga Analytics, actually building these desks, structuring the long-term sale and purchase agreements, and auditing the risk systems that monitor them, you just see the same fatal misunderstandings repeat over and over.
Like that.
We really have to understand why a professionally run desk will routinely and rationally load a ship with liquefied natural gas long after that specific transaction starts making a net profit.
Right. So let's start by grounding the terminology for everyone. Before we get into these massive financial commitments, what fundamentally separates a portfolio position from an asset-backed one? In simple terms.
Yeah, so the defining difference is really the obligation to capacity. I mean, a pure portfolio desk is essentially an opportunist. They buy when they see value in the market, they sell when they see a margin, and they own absolutely no infrastructure between those trades.
They're just flipping it, basically.
Exactly. An asset-backed desk, however, has actually signed a contract for physical capacity. So that could be liquefaction at an export facility, or a fleet of LNG carriers, or regasification space at the import terminal.
Right.
And crucially, they pay for that capacity whether they actually use it or not.
Wow. Okay. So let's put some real numbers to this so we can really feel the weight of that obligation.
Let's do it.
Looking at a standard U.S. desk program, say a firm has committed to lifting 20 cargoes a year.
Oh.
And just so we're all on the same page, when we say lifting, we are talking about the physical act of a vessel pulling up to an export terminal and loading the liquefied gas, right?
That is correct, yes. You are taking physical delivery of the commodity right onto your chartered vessel.
Okay, so we have 20 cargoes, and a standard cargo is what, roughly 3.88 million MMBtu?
Yeah, that's a good standard baseline.
And the fixed liquefaction fee, like the toll you pay the plant, just to have the right to use their equipment.
Yeah.
Let's say that's $2.50 per MMBtu.
Right. So if you do the arithmetic on that, you arrive at a fixed annual fee of exactly $194,010,000.
Basically $200 million.
Yeah.
And the brutal reality of a tolling agreement is that this fee is essentially paid on January 1st. I mean, it is a sunk cost locked in before the desk makes a single trading decision for the entire year.
Exactly.
So it's a bit like signing a year-long, completely non-refundable lease on an ultra-luxury apartment in a new city versus, I don't know, just booking a hotel only when you actually travel there.
That's a perfect analogy, actually.
Right, because if you've already paid the lease, that money's gone.
Yeah.
You might as well sleep in the apartment as long as your daily utilities, like your variable costs, are cheaper than getting a hotel room. But surely there's a point where you stop going.
Well, the apartment analogy is perfectly apt, yet you would be just stunned by how often executive boards fail to grasp it when the numbers get this large.
I can imagine the panic.
Oh, absolutely. Sunk costs must be entirely excluded from a marginal decision. For an asset-backed desk, when you're deciding whether to lift the next cargo, the only numbers that actually matter are the variable costs.
Which would be what, exactly?
So that's buying the raw feed gas and paying for the freight measured against the revenue of selling that cargo. The $2.50 fixed fee has absolutely no place in that decision.
Okay, here's where it gets really interesting. Let's test that logic, because this is where the theory hits the wall of corporate panic, like we just said.
Yeah, let's hear the scenario.
Let's say we enter a narrow spread regime. The market just drops. The TTF, the European gas benchmark is sitting at $5.50.
Okay, a weak market.
Right. At this price, that entire 20-cargo annual program is losing over $111 million across the year. Over $100 million in the red. Now, put yourself in the CFO's shoes. I am staring at a $111 million hole. And you're telling me the rational move is to keep going. To spend another, $16 million on feed gas and shipping just to load the next vessel.
Yes, I am.
Walk me through why ordering the desk to just stop is a catastrophic error.
Because the CFO in that scenario is blending a historical fixed cost with a current variable margin. Let's isolate a single cargo at that 550 TTF price.
Okay, one cargo.
So the variable cost, meaning buying the physical feed gas in the U.S. Gulf and chartering the ship to move it, is roughly $16.5 million. And the revenue from selling it into Europe at 550 is about $20.6 million.
Okay, wait. So the revenue of $20.6 million actually covers the $16.5 million variable cost.
Yeah.
You actually clear about $4.1 million on the physical movement of the gas itself.
Yes, exactly. Every single time you lift a cargo in that environment, you generate $4.1 million of positive margin over your variable costs. Now, remember the fixed fee per cargo. That sunk cost is $9.7 million.
Ouch.
Yeah. So you take your $4.1 million operating margin and you use it to chip away at that $9.7 million fixed fee. Yes, on a fully costed basis, you still lose about $5.6 million on that specific cargo.
But if you cancel the lifting.
If you cancel, you generate zero revenue. I mean, sure, you save the $16.5 million in feed gas and freight, but you still legally owe the $9.7 million fixed fee to the liquefaction plant.
Oh, wow. So you just take the full $9.7 million hit.
Exactly. By panicking and canceling all 20 cargoes, the firm's loss explodes from $111 million to the full $194 million.
That is insane.
The CFO's instinct to, quote-unquote, stop the bleeding literally destroys over $82 million of corporate value. You have to grit your teeth and keep lifting just to offset the fixed cost.
So there has to be a threshold, right?
Yeah.
I mean, a point where the market is so depressed that it actually does make sense to walk away.
There is. And in these U.S. tolling contracts, it is built in as what we call the cancellation right. You have the contractual right to decline to lift, pay the fixed fee, and just walk away.
Okay.
Economically, this right is a put option on the lifting decision, and it's struck exactly at the variable cost. You only invoke it when the market revenue no longer covers the cost of feed, gas, and freight.
So based on the underlying arithmetic, that indifference point, the exact threshold where canceling finally beats lifting, is when TTF drops to what, $4.40?
Right.
Like 4.4026 techs to be exact.
That's the exact number, yes.
So if the market is at 441, you lift. If it is 439, you cancel and eat the fixed fee.
And executing that requires immense operational discipline on the desk. Modern desks build cancellation decision engines right into their ETRM, their energy trading and risk management system.
Right, the software handling this.
Yeah, and it's essentially a really clean 30-line function.
Right.
But the fatal trap developers fall into is they write the code to compare the net profit after fixed costs against zero.
Because that feels intuitive to a software developer.
Yeah.
Or an accountant. They just want to know, is this transaction profitable overall?
Exactly. But it is fundamentally wrong for optimization. The correct code must compare the lift margin over variable costs against zero. If your ETRM system includes the fixed fee in the marginal lifting decision, the software will literally instruct your desk to cancel profitable cargoes throughout a weak year.
Which just compounds your losses automatically.
Completely.
So what does this all mean for the people actually doing the work? If you are listening to this and thinking, how on earth do you evaluate the human beings running a desk like this? I mean, I'm right there with you.
It's a huge issue.
Right, because if I'm a trader, and my bonus and performance reviews are tied to a desk that is down 9 figures, I am immediately updating my resume.
Yeah.
How do you measure competence when the baseline is a $194 million anchor?
Well, what's fascinating here is that tension exposes a massive flaw in standard corporate performance metrics, specifically return on allocated capital, or ROAC.
Okay, let's walk through that.
Let's assume the firm allocated $650 million of capital to this desk. In a widespread regime where European gas prices spike and TTF is, let's say, $9.80, the desk nets $210 million.
That's massive.
It is. That translates to a ROIC of positive 32.39%.
The traders are treated like geniuses. Massive bonuses all around, popping champagne.
Precisely. But in the narrow regime we just discussed, with TTF at 550, the ROIC is negative 17.19%. And here's the crucial realization: nothing about the current desk's skill changed.
Wow. They did the exact same optimization.
They optimized every cargo perfectly in both scenarios. A performance measure that swings by 50 percentage points based entirely on an infrastructure cost the desk does not control is useless for evaluating personnel.
So how do you fix the reporting so you aren't firing great traders just because it's a down market?
Best practice dictates you must never blend the numbers. You have to report the program result completely separate from the trading result.
Okay, program versus trading.
Right. The program result asks a strategic question. Was signing this 20-year, $194 million fixed-fee contract actually a good idea? And that decision was likely made a decade ago by an executive committee whose members have, long since retired.
So the current desk is just living in the house the previous generation built.
Exactly. The trading result, however, asks, given the structural constraints of that house, how well did the current desk optimize the cargoes they were handed?
That makes total sense.
That is the only component the current traders control. Reporting one blended P&L completely conceals both the historical strategic error and the present-day trading competence.
And it's not just performance metrics that get distorted by these fixed fees, right? It's survival metrics, too. If you are a risk manager listening to this, the implications for value at risk, or VAR, are frankly terrifying.
It is perhaps the most dangerous blind spot in commodity risk management, period.
Explain that for us.
So VAR is designed to compute the potential loss on variable market positions. But that $194 million fixed fee isn't a market position, it is a legal certainty. Because it has zero volatility, it contributes exactly $0 to your measured VAR.
Okay, let me make sure I'm hearing this right. A firm has a nearly $200 million cash obligation, a massive liability, and it just doesn't show up in the daily VAR reports at all.
It does not at all. So in our narrow market scenario, the desk loses $111 million. If the chief risk officer set a VAR limit of $12 million, they just experienced an outcome that is more than 9 times their VAR.
Heads would roll. Management would instantly panic.
Oh, they assume a trader went rogue or a massive limit was breached. But there was no bad trade. It is simply the arithmetic of a massive cash commitment that the statistical risk system was never built to hold.
That's wild.
You have to show contracted fixed cash obligations alongside VAR, never blended into it.
So if tolling contracts carry these intense risks with unyielding fixed fees, a logical person might look at this and think, well, why rent when you can own? Wouldn't it just be safer to own a share of the actual liquefaction plant? Equity feels like the strongest position. You're an owner, not a renter subject to a toll.
That assumption is the most dangerous trap in asset-backed trading.
Really?
Yes. It is vital to distinguish between the 3 types of asset backing: tolling, equity offtake, and capacity booking. Tolling is what we've been discussing. You pay a fee, supply your own feed gas, and crucially, you have that embedded put option.
The cancellation, right.
Which, as we established, caps your downside. In the worst case scenario, you lose the fixed fee, but you stop the bleeding on feed gas and freight.
But consider equity offtake. You own a share of the plant and its output. You are the producer and the seller of the LNG. And a seller has no contractual right to decline to produce just because the market is weak.
There is no cancellation right. Your downside is completely uncapped if the destination market collapses. Desks that move from tolling structures to equity stakes often build their risk models assuming they still have a cancellation right, and they discover its terrifying absence in the very first weak quarter.
That is a brutal awakening.
Yeah.
So how do the massive global players survive this? I mean, the oil and gas majors, the huge utilities, they're heavily exposed to equity offtake and tolling, but they don't blow up every time the market narrows.
Because they utilize the portfolio player model. They don't just hold one tolling contract or one equity stake. They hold diversified supply across multiple basins, the U.S. Gulf, West Africa, the Middle East. They control massive chartered fleets, and they hold regasification access in several global markets. They survive through structural scale, utilizing basically four specific mechanisms.
Let's break those down. How exactly does scale protect them?
First is substitution. If a specific export plant goes down due to maintenance or, say, a hurricane, a single asset player has to panic buy replacement cargoes in a distressed, spiked market to meet their delivery obligations.
Right.
A portfolio player just quietly substitutes a cargo from their own supply in a different basin. Second is destination arbitrage at scale.
This is where fleet logistics come in, right?
Yes. Say a terminal in Europe is congested and your ship can't unload. A single cargo player faces ruinous demurrage costs or an outright default. A portfolio player can just divert that ship mid-ocean to a different terminal in Asia and route a different ship that was heading to Asia back into Europe a week later when the congestion clears.
Wow.
They absorb constraints that would completely crush a smaller desk. Third is fleet utilization optimizing the ballast leg. A vessel that would normally sail back empty across the Atlantic can be erected to load again somewhere else on the way.
That's incredibly efficient. And the
Right.
fourth mechanism?
That is optionality netting. And this is where the real value lies. It is netting a cancellation right on a U.S. tolling contract against a physical supply shortfall on an equity project in the Pacific.
So balancing the two.
Exactly. You use the embedded options of one contract to physically hedge the risks of another. But there is a massive Durga Analytics warning on this model. A structure whose value comes from netting across multiple global positions cannot be managed by a legacy ETRM system that evaluates positions individually.
Because it can't see the big picture.
Right. If your risk architecture cannot aggregate these complex embedded options and see the whole board simultaneously, that diversification is just an illusion. You are flying blind.
We've spent a lot of time looking at the U.S. side,
Yeah.
the liquefaction and export mechanics. But a core principle of this master program is that we must always cover both sides of the trade. We have to flip the map. What is the operational reality for the EU desk on the receiving end?
If we connect this to the bigger picture, the EU asset-backed desk is holding the exact structural mirror image of the U.S. desk's commitment. Instead of holding liquefaction capacity in the Gulf Coast, they hold booked regasification capacity at a European import terminal.
So they have a fixed cost of access to a consumer market rather than a fixed cost of access to supply. But the arithmetic is identical.
Yeah.
Like you pay for the terminal slot whether your ship arrives or not.
The arithmetic of the sunk cost is identical, yes, but their embedded option is different. It isn't cancel the lifting because they aren't loading gas, they are delivering it.
So what's their option?
Their option is divert away from the terminal. If the European price collapses, they can reroute the ship to Asia and just eat the sunk cost of the European terminal slot. But operationally and regulatory-wise, the EU desk lives in a completely different universe.
This brings us to a recurring contrast in the industry. Permissions versus demonstrations. Why does the operational tempo feel so much heavier in Europe?
Well, because a U.S. desk mostly acquires permissions. Think of a Department of Energy export authorization. You obtain that permission once, it binds the destination of the gas, and the compliance team simply checks it per transaction. It is relatively static.
But the EU desk trader doesn't have that luxury, do they?
Not at all. The EU desk acquires demonstrations, import authorizations, verifying the physical origin of the gas to ensure it doesn't violate sanctions, demonstrating the methane intensity of the supply chain.
It sounds like a lot of paperwork.
It's massive. These are heavy, complex burdens that must be reproduced from scratch for every single cargo that arrives. If an EU operator fails a demonstration, the cargo cannot discharge, and the financial fallout is immediate. It creates a completely different failure mode for the desk.
There's also a major difference in how a sunk cost really is on the two continents, isn't there? For the U.S. desk, if you exercise that cancellation right, that $9.7 million fee goes into the void. It is dead money.
But for the EU desk, unused regasification capacity is frequently resaleable in a secondary market. Other players might need that specific delivery window.
Oh, I see.
So while a U.S. desk's unlifted fee is unrecoverable, an EU desk's unused terminal slot might be sold to a competitor. That fundamental structural difference completely changes how a trader behaves on the margin.
So they are just giving up immediately.
Exactly. For an EU trader, their first action in a weak market isn't just to swallow the loss, it's to actively test that secondary market to salvage the sunk cost.
It is incredible how just shifting the geography changes the very definition of what a sunk cost is and how a trader actually has to maneuver to survive. Let's pull all of this together. If you are an analyst building a pricing model or a risk manager evaluating a trader's daily performance, recognizing exactly where the cost sits is the difference between navigating a narrow spread and being crushed by it.
Couldn't agree more.
We've seen why separating variable from fixed costs is the only way to make rational marginal decisions, why VAR is dangerously blind to fixed obligations, and how the operational realities of U.S. permissions contrast sharply with EU demonstrations.
And this raises an important question to leave the audience with.
What's that?
Imagine sitting on a trading desk today. Your bonuses, your daily performance metrics, your stress levels, they are all tethered to a 20-year fixed-fee capacity contract signed by a committee a decade ago.
Wow.
How much of a trader's daily anxiety and how much of a risk manager's panic is actually just the ghost of a prior generation's capital allocation?
That is a haunting thought for anyone trying to hit their P&L targets this quarter. It really reframes who is actually responsible for the desk's survival. And it's the perfect pivot for where we go next. Next time, in Module 1, Chapter 4, we turn to the allocation of authority. We will look at who actually gets to decide where a cargo goes and how the most valuable decision on your desk comes with a deadline dictated not by the market, but by a vessel's physical position on the water. You will not want to miss it.
When you look at a traditional corporate org chart, there is this really comforting illusion of safety.
Oh, absolutely.
You see all those neat little boxes. They're connected by solid lines, cascading all the way down from the executive suite down to the analysts.
It looks perfectly engineered. Secure, even.
Yeah, exactly. Secure. And the unspoken rule we all just kind of seem to accept is that the higher up you go on that chart, well, the more authority you naturally possess to make the big calls.
I mean, that is the ultimate corporate assumption, right? Seniority and authority are just treated as the exact same thing. Like, the bigger the title, the louder the voice, the more final the say.
But then you take that assumption and you step onto a physical commodity trading floor.
And it completely falls apart.
Right. Suddenly that beautiful org chart feels a bit like trying to navigate this treacherous mountain pass using a map drawn by, I don't know, a graphic designer who has literally never been outside.
Yeah, the map looks great, but it completely ignores the physical terrain.
Exactly. So welcome back to another deep dive. For those of you joining us to level up your professional game, you know the drill by now. We are continuing our intensive progression through the LNG Trading Desk Master Program.
And this is just a massive, highly sequenced journey for you guys. We're talking 9 full modules, 120 chapters that cover, well, basically the absolute breadth of the industry.
Yeah, from the physical physics of liquefaction and contract structures
Through ETRM systems, risk budgets, all the way to desk legacy and leadership. And we anchor everything in real markets, verified arithmetic, and the actual applied builds you need to survive on a modern trading desk.
Right now, though, we are firmly in Module 1, which is running an LNG trading desk. Specifically, we are tackling Chapter 4, which carries this deceptively simple title, Senior Trader versus Junior Trader Authority.
It's such a critical chapter for anyone aspiring to build or run a desk, because the biggest misconception we see, and frankly this plagues most corporate environments, not just trading, is this idea that authority is a property of a person.
Like, you get the promotion, you get the authority automatically.
Exactly. That a senior trader just inherently holds the authority because they have, 10 years of tenure. But in reality, on a highly functional desk, authority is a property that must be allocated to a specific decision.
So we aren't asking who is the most senior.
No, we are asking how is this specific decision structured?
Right. So our mission today is to break down exactly how that works for you. We're going to explore how physical geography dictates your deadlines in LNG. We are going to calculate the exact dollar cost of delaying a decision.
It's a staggering number, as we'll see.
Oh, it really is. We'll also look at why kicking a major commercial choice up the ladder can mathematically destroy value. And finally, we'll dive into the strict regulatory differences between operating out of the U.S. versus the EU.
So let's start with that decision structure. The source material outlines 4 distinct roles that must be assigned for any action on the desk. First up is propose.
And this one is pretty wide open, right?
Very wide open. An analyst, a junior trader, a scheduler, anyone can spot a market opportunity, run the initial numbers, and just raise their hand to propose a trade.
But then we hit the bottleneck. Box 2 is decide. And the rule here is incredibly rigid.
Yeah, for any given decision, exactly one named person holds the right to decide. Not a committee, not two co-heads who, usually get along, just one person.
The text actually highlights that having two decide boxes is the most common and honestly the most dangerous structural defect on trading desk.
It really is. It usually happens because of corporate politeness or maybe some kind of matrix management setup. And what is terrifying is that this defect remains completely invisible as long as those two people agree.
Right, the business just hums along.
Exactly. But the day they disagree is, by definition, a day when the market is volatile, the decision is incredibly complex, and the deadline is imminent.
Which is literally the worst possible moment to discover your desk doesn't actually know who is accountable.
Exactly. It paralyzes the desk when time is most critical.
Which naturally leads us to the third role, which is the veto. And I was thinking about this because a veto sounds so powerful, but it's actually a very narrow right.
It is.
It's held by a named person to stop an action, but only on stated, predefined grounds. It's kind of like, well, think of it like taking your car to a mechanic for a pre-road trip inspection.
Okay, I like this.
Right, so if the mechanic looks at your vehicle and says, hey, you cannot drive this through the mountains, your brake lines are leaking, that is a valid veto. They are stopping you on physical, mechanical grounds.
That is a highly accurate way to frame it.
But if that same mechanic says, well, I'm not going to let you leave the garage because I personally think the city you're driving to is a terrible tourist destination.
That's completely out of bounds.
Right. They are stepping out of their mechanical lane and trying to make a lifestyle choice for you.
Yeah, and translating that to a physical LNG desk, let's say a scheduler stops a cargo diversion. If they stop it because the LNG carrier physically cannot make the journey to the new terminal within the required laycan.
And just to clarify, laycan is that unforgiving contractual window of days that terminal actually allows you to unload, right?
Exactly. So if the ship can't make that laycan window, that is a legitimate veto. The brakes are shot, the physics just don't work.
Right.
But if that scheduler tries to block the diversion just because they commercially disagree with the new destination's profit margins, that is a second decide box wearing a veto's clothing. It completely undermines the desk's discipline.
I love that phrasing. A second decide box wearing a veto's clothing.
Yeah.
And just to close the loop on the four roles, the final one is informed.
Right. That's operations, finance, anyone downstream who just needs to execute on the decision once it's actually made.
So we have propose, exactly one decide, a narrow veto, and informed.
And the reason this precise allocation is so urgent in LNG compared to, say, a standard equity or fixed income desk comes down to the relentless nature of time.
And this is where the physical reality of the commodity completely changes the game for you. When we talk about deadlines on an LNG desk, we aren't talking about the closing bell on Wall Street.
No, not at all. Desks frequently fail when they import authority structures from purely financial markets. Because on a financial desk, deferring a decision is relatively cheap.
Right.
If you wait to pull the trigger on a trade, you are basically accepting a price move. It's a two-way distribution. The market could move against you, sure, but it could just as easily move in your favor while you deliberate.
But wait, hold on. Let me push back on this playfully. In almost any other traditional business, delaying a huge call is actually the prudent thing to do.
Sure, feels safer.
Right. If I have a multi-million-dollar choice in front of me, I want to gather more intel. I want to consult the quants, check the models, basically de-risk the trade. So why wouldn't you want to wait for more clarity?
It's a totally natural instinct, but it ignores the fundamental asymmetry of physical trading.
Yeah.
In LNG, the deadlines are set by geography. You have a massive vessel carrying millions of dollars of liquefied natural gas, physically burning fuel as it steams across the ocean.
Right, it's constantly moving.
Exactly. And it eventually reaches a point in the water, a routing point, beyond which a certain destination is simply no longer reachable within your delivery window. Deferring the decision as that ship approaches, the routing point doesn't de-risk the trade.
It causes the physical option to expire entirely.
Yes. It is a one-way loss.
Man, the ocean does not care about your org chart. If you deliberate too long, the ship sails past the junction and the opportunity vanishes.
Poof, gone.
So let's attach some real numbers to this concept of delay, because the course material gives us a phenomenal breakdown in the Chapter 1 case study.
Yeah, let's walk through the math.
Okay, so we are looking at an $8.45 million advantage to divert a specific cargo to Asia, rather than keeping it on its original path to Europe.
Okay, so assume the junior trader spots this massive opportunity. But they follow that traditional corporate reflex we just talked about. They get nervous about the size of the number, and they decide to kick it up the ladder.
Which makes sense on paper.
Right. But the senior trader is traveling or stuck in back-to-back meetings, and the decision just sits unmade for 48 hours.
Okay, so instead of reading out the decimal point gymnastics from the text, let's synthesize what actually happens to the cargo. While the desk waits for an answer, the ship keeps moving.
It doesn't stop.
Exactly. It passes that optimal routing point. So by the time the senior trader finally logs on 2 days later and says, yes, send it to Asia, the ship now has to backtrack or take a severely suboptimal route.
Which triggers two massive physical penalties. First, the rerouting adds 11 extra steaming days to the voyage. Now, the charter rate on this particular vessel is $85,000 a day.
Oh, wow. So you are instantly burning $935,000 just in extra shipping time and boil-off gas.
Right.
Nearly $1 million gone just in logistics.
And that is actually the smaller penalty.
Wait, really?
Yeah. Because of those extra 11 days, the cargo arrives late to the Asian terminal. It completely misses the optimal pricing window. The market has shifted, and the cargo is now pricing 90 cents lower per MMB2.
And for those tracking the metrics, an MMB2 is a million British thermal units. That's the standard measure of heat content we trade on. So when you multiply a 90-cent loss across a massive standard cargo, was it about 3.77 million MMB2?
Yeah, roughly.
Okay, so that is roughly $3.39 million evaporated simply because the ship arrived late.
Exactly. So you add the logistical cost to that market penalty, and the total cost of deferring that decision for 48 hours is over $4.32 million.
Wow, over half the value of the trade. 51% of the advantage gone in 2 days.
Yeah, and if you divide that $4.32 million loss by the 48 hours they waited.
The desk is bleeding roughly $90,000 an hour.
$90,175.65 to be exact.
That is wild.
That is the anchor metric. The desk bleeds $90,000 every single hour a decision sits unmade. This isn't theoretical value at risk on a spreadsheet. This is a computable physical decay rate based on fuel, charter rates, and forward curves.
And that exact number must govern how you design your authority structure.
It has to, because when the clock is ticking at 90K an hour, escalating a decision to the boss suddenly sounds incredibly reckless.
It really does.
Yeah.
Which brings us to the arithmetic of escalation. Let's say escalating the decision that senior trader doesn't take 2 days. Let's say it just takes 6 hours.
Okay, 6 hours. 6 hours multiplied by our decay rate means the mere act of asking for permission cost the desk roughly $541,000 in lost physical time.
So the escalation has an upfront admission price of $500,000.
Exactly. Meaning the senior trader doesn't just have to be a little bit better at their job, they have to be $500,000 better just to justify the delay.
So let's quantify that improvement. Suppose the junior trader makes an error on this specific class of decision 12% of the time. The senior trader is genuinely more experienced, so their error rate is only 7%.
Right, they offer a 5% improvement in decision quality.
Okay, so 5% of an $8.45 million decision is about $422,000 in expected value.
Now weigh the two sides. The senior trader's better judgment gained the desk $422,000. But the 6 hours it took to reach them cost the desk $541,000.
So escalating to the literal boss, who is demonstrably better at the job, mathematically destroys over $118,000 in value.
Exactly.
That is going to fundamentally challenge how a lot of people think about management. Handing it to the most qualified person is actually the mathematically wrong choice for the business.
It is cold arithmetic. And since you cannot magically train humans to have a 0% error rate, the only lever you can pull to fix this is duration. What happens if we can cut that escalation time in half, say from 6 hours to 3 hours?
Well, 3 hours at $90K an hour is an escalation cost of about $270,000.
Right. And the senior trader still adds that $422,000 in expected value.
So suddenly the math flips. You gain over $150,000 in net value purely by doing it faster.
But here's the catch. You cannot achieve a 3-hour escalation by accident, which leads us to the weekend case study in the materials.
Oh, this one is painful.
It is. It's a composite based on very real events that happen on desks globally. So a diversion opportunity arises at 3:40 a.m. on a Saturday morning. The vessel is steaming toward its routing point. The junior trader on watch realizes the risk is just too large for their mandate and they need to escalate.
But it's Saturday night. Well, early Saturday morning. The desk head is asleep and unreachable. The authority matrix technically named a deputy for this exact scenario, but...
But their phone is off.
Right. So the junior trader is scrambling, and it takes until 9:15 in the morning just to get the deputy on the line.
And when the deputy finally answers, they do what any senior trader would do. They ask for the data. They say, what is the updated voyage plan? What are the forward curves for the two competing terminals? What are our physical constraints?
But the junior trader hasn't assembled any of that.
Because they spent the last 6 hours playing phone tag instead of building the models.
Right. So now, while the clock is ticking at $90,000 an hour, the junior trader is desperately trying to pull data out of the ETRM system, run the charter rates, and calculate the boil-off.
And it takes until 1:30 in the afternoon just to gather the data. The decision is finally made just before 3 p.m.
From 3:40 a.m. to 3 p.m., over 11 hours of delay. Multiply that by our decay rate, and that's $1 million lost.
$1 million.
And the tragedy here is that the bulk of that $1 million evaporated before anyone even looked at the commercial merits of the trade. They bled cash just trying to find a human being with the pulse and open the right spreadsheets.
And technically, nobody broke the rules.
Which is the crazy part.
The org chart was followed perfectly. So, the solution to this $1 million fire drill requires no new IT budget and no new headcount. It requires a standing arrangement.
What does that look like in practice?
First, a named reachable deputy on a strict rota. If you are the deputy, your phone is on, period. Second, and most importantly, it mandates what we call a standing decision pack.
How exactly does a desk build a standing decision pack so that it's ready at 3:40 in the morning?
You automate it. Before the trigger price, the specific market price that makes the diversion profitable, before that price even prints in the market, the desk systems have already done the heavy lifting. The ETRM system is set to auto-generate the alternative voyage plans overnight. It pulls the forward curves, calculates the boil-off, lists the terminal constraints. It is all sitting in a predefined, easily digestible packet.
So when you inevitably wake the deputy up in the middle of the night, you aren't hunting for data. You're handing them a completed puzzle. You turn a frantic 6-hour scavenger hunt into a focused 20-minute commercial phone call.
Exactly. You manage the duration, which manages the physical decay rate.
Okay, so far we've established that commercial decisions in LNG are governed by this brutal math of delay. But as we pivot to the final section of our outline, we have to look at situations where that $90,000 an hour clock becomes entirely irrelevant.
Yeah, this is where we see a fascinating collision between commercial ambition and regulatory reality.
Because when a decision is regulatory, the commercial map just stops.
It does. And to understand this, we have to make the structural contrast explicit between how a U.S. desk operates and how an EU desk operates.
Which is a recurring theme throughout the master program for you guys. Let's break down the frameworks. The core difference is that a U.S. desk operates primarily on a framework of permissions.
While an EU desk operates on a framework of demonstrations.
Precisely. Let's look at the U.S. desk first.
Sure. So the dominant regulatory mechanism here involves acquiring a permission once and then checking your daily transactions against it. For example, under Section 3 of the Natural Gas Act, the U.S. Department of Energy dictates exactly which countries you are legally allowed to export LNG to.
Right.
So you hold a broad authorization, a permission, to export to free trade agreement or non-free trade agreement nations.
So the U.S. desk just has to verify that the destination terminal sits safely inside that existing blanket permission.
Correct. You get the permission once, you check it per transaction. Now contrast that with an EU desk. A European desk doesn't just check a box once, it has to provide a demonstration for every single cargo.
And that's because of things like import quotas, geopolitical sanctions.
And really strict environmental tracking, yeah. An EU desk must formally demonstrate and prove the exact country of production, literally tracing the specific molecules for every import. You have to reproduce your proof every single time a ship arrives.
And this leads to what the text calls reserved decisions, decisions that absolutely cannot be delegated to the junior trader just for the sake of speed.
Exactly. Verifying a Section 3 export authorization in the U.S., or formally attesting to the origin of gas in the EU, these are reserved decisions. They belong to a specific named individual, like a head of compliance.
But let me play the aggressive commercial trader for a second here.
Uh-oh.
It's Saturday night. The clock is ticking at 90K an hour. The compliance officer isn't answering their phone. Can't the desk just say, look, this cargo is probably fine. It's headed to an allied nation. Let's just execute the diversion to save the commercial value. If we're wrong, we'll just pay the regulatory fine later.
That is exactly how desks get shut down and traders face personal liability.
Yeah, I figured.
A commercial cost-benefit calculation is the completely wrong instrument for a regulatory question. You cannot weigh $90,000 an hour against violating federal law or international sanctions.
Right.
These decisions are reserved to a compliance officer who holds the absolute standing to veto the trade. And the trading desk cannot override that veto no matter how many millions are on the line.
So we are stuck between a rock and a hard place. We can't bypass the compliance rule, but we also can't afford the commercial delay of waiting for compliance to wake up.
Yeah.
How does a functional desk solve this?
By removing the regulatory check from the critical path entirely.
Okay.
You do not wait until 3 a.m. on a Saturday to ask compliance if a destination is legal. A sophisticated desk pre-clears the entire universe of possible destinations during peacetime, long before the commercial opportunity ever arises.
So you get your U.S. permissions sorted or
Yeah.
your EU demonstration frameworks mapped out when the clock isn't ticking?
Exactly. So when the market moves and that decay rate starts, the regulatory box is already checked, and you only have to focus on the commercial execution. It all comes back to relentless preparation.
It really does. A trading desk only survives if its structure reflects physical reality. So let's summarize the key takeaways for you as we wrap up Chapter 4.
Yeah, let's do it.
First, remember that authority is about written roles allocated to specific decisions, not the tenure or ego of the person sitting at the desk. Second, time in LNG is intensely physical. The cost of delay isn't theoretical. We calculated it at roughly $90,000 an hour in lost logistics and market value.
Third, escalating a decision only works if the improvement in judgment outweighs the time lost to delay. To ensure that happens, desks must utilize automated standing decision packs.
Right. And finally, regulatory rules, whether they are U.S. export permissions or EU origin demonstrations, always supersede the commercial clock. You have to pre-clear them or your desk will fail under pressure.
Which perfectly bridges us into Chapter 5. Now that we understand who gets to decide and exactly how fast they must operate, the next step in the program will explore what they're actually permitted to decide about.
Chapter 5 is where we dive into the desk mandate, the allocation of risk capital, and what the course defines as the obligation ladder rung. We will look at how you define the actual boundaries of a desk survival.
It's going to be a crucial step in the journey.
It is. But before we sign off, we want to leave you with a final thought to mull over. We've spent this entire session looking at how a highly sophisticated LNG desk can quantifiably bleed $1 million simply because a deputy's fund was off and spreadsheet wasn't updated overnight.
It really forces you to view your own operational bottlenecks in a new light.
Take a hard look at your own organization's structure tomorrow morning. What are the invisible costs quietly eating away at your margins right now simply because your org chart looks pretty on paper but was never actually designed to survive the physical realities of your industry? Think about it. We will catch you on the next deep dive.
Imagine looking at your trading dashboard right now.
Mm-hmm.
You've got nearly $300 million in untouched allocated capital. Your risk metrics are just completely green. Your volume is stable, you know? So you spot this incredible opportunity in the market, you go to buy just one more cargo, and your system completely rejects you. Just a hard stop.
Yeah, it's a terrifying moment.
Right. Today, we're doing a deep dive into why the numbers you are watching on your screens are, well, they're rarely the ones that will actually bankrupt your desk. Welcome to the deep dive, everyone. Joining me is our resident expert, bringing, decades of physical and financial LNG experience.
Thanks for having me.
Of course. You're a trading and risk management consultant from Durga Analytics. We're talking U.S. Gulf to Europe, Northeast Asia, running long-term offtakes, chartering, designing energy trading and risk management, or ETRM systems. I mean, basically, you've built these desks, run them, and taught others how to actually survive them.
It really is a pleasure to be here.
Yeah.
And, survival is exactly the right lens for this.
Yeah.
Oh, absolutely. When you're moving that much capital in physical form across the water, the difference between a highly profitable desk and, well, a catastrophic failure usually comes down to constraints that most traders are just never taught to measure.
Which brings us perfectly to the roadmap for today. Just as a quick reminder, we are guiding you through the LNG Trading Desk Master Program. It's this incredibly sequenced journey across 9 modules and 120 chapters total.
It's a lot of ground to cover.
It is. It covers everything from market structure and senior trading playbooks to like valuation, ETRM systems, regulation, desk legacy. But today we're unpacking Module 1, running an LNG trading desk, specifically Chapter 5.
Right, which covers desk mandates, capital allocation, and risk budgets.
Exactly. And our core promise to you today is that we're going to learn how to properly bound what a trader can actually do. We'll expose where a desk capital actually goes, why hitting your credit limit usually just blindsides you, and we're going to unpack this terrifying phenomenon called drift.
Oh yeah, drift is a big one. It can triple your risks without breaching a single limit on your dashboard.
That is wild. But before we can manage a desk's risk, we kind of have to know the rules of the game. And according to the materials, most desk leaders immediately confuse the rulebook with the scoreboard.
They really do.
Yeah.
And, separating these concepts is pretty much the very first act of governance. You basically have 3 documents that govern an LNG desk.
Okay, what are they?
Well, they're entirely separate, they're owned by completely different people, and yet they are routinely just mashed together. First, you have the mandate. Second, the risk budget. And third, the target.
Okay, let's define the boundaries of each one so we don't mix them up.
Sure. So the mandate is the absolute boundary of what the desk may do at all. It's owned by the board or the executive committee.
Right.
If you operate outside of it, you haven't just made a bad trade. You've done something nobody authorized, something the firm's balance sheet assumed was strictly excluded.
Got it. And the risk budget.
The risk budget, on the other hand, is owned by the risk function. It dictates how much of the firm's total risk appetite the desk is permitted to actually consume.
Okay, so they're related but different.
Exactly. You can be perfectly inside your mandate, making highly profitable trades. But if you exceed the risk budget, well, the firm as a whole is overexposed.
That makes sense. And what about the target?
The target is owned by the business. It's simply what the desk is expected to earn, in dollars and cents.
Right. So let's think about the behavioral economics of that for a second. Because if a target is simply an expectation of profit, but not a permission to take risk, what happens when a trader is pressured to hit a massive profit target that their mandate doesn't actually support?
That's where things get dangerous.
Like, say the business demands $50 million, but the mandate only allows the desk to take on like $5 million worth of allowed directional risk.
Yeah, that gap between expectation and permission is honestly the most reliable early indicator of a desk in deep trouble. Oh, absolutely. A desk almost never fails because of some sudden unpredictable loss. It fails when a massive target can only be reached by quietly wandering to the absolute edges of the mandate.
Or, I guess, finding unwritten loopholes in it.
Exactly. If you can't hit the target inside the mandate, you either have a target problem or a mandate problem. But, when traders try to bridge that gap quietly, they start looking for free risk.
Quote unquote free.
Right, quote unquote. And in LNG, free risk usually just means unmeasured physical risk. That is where catastrophic failures begin.
Okay, so we know the mandate sets the absolute boundaries. But, I mean, a mandate that just says, don't trade more than 10 cargoes, that isn't really a mandate at all.
Not a useful one, no.
Right. We have to look at the mechanics of how it's actually drawn. A standard ETRM system is usually set up to track the basic dimensions of a trade, right? Like what you're trading, where it's going, the duration, who you're trading with.
Precisely. And if your mandate only constrains trade size, you are flying completely blind. A proper mandate actually requires 5 axes.
Okay, let's walk through those. Grouping the first 4, like I just outlined, we start with the physical bounds. Axis 1 is the instrument, right?
Yes, the instrument details which contracts the desk may transact. Cleared futures, bilateral spot cargoes, term agreements, and crucially for LNG, charters. The physical ships must be named here as proprietary positions, not just treated as procurement or logistics.
Because chartering an LNG carrier is a massive financial commitment all on its own, independent of the gas inside it.
Absolutely, it's huge.
Yeah.
The second axis is basin and location. Which markets, which delivery points, which specific terminals are allowed.
And location in LNG is a risk dimension in its own right, isn't it? Not just a minor detail attached to a price tag.
Exactly, because of liquefaction logistics and boil-off gas during transit. It's highly physical. Then we move to the time and relationship bounds. Axis 3 is tenor. But for LNG, this axis must explicitly separate the price tenor from the commitment tenor.
Let me make sure I followed the distinction there. if a desk signs a 20-year offtake agreement to buy gas, but they only have the liquidity to hedge the price for the first year, those are two totally different tenors.
Exactly.
The commitment is 2 decades, but the price protection is only 12 months.
Yeah, and usually one of them is left unstated in a weak mandate, which completely masks the true duration of the risk.
Wow, okay. And the fourth axis.
The fourth axis is counterparty. Who is the desk allowed to face? And for LNG, this has to extend way beyond just the trading counterparty to include ship owners, terminal operators, and plant operators.
But the source materials point out that there is a fifth axis, the missing axis on almost every desk, called the obligation ladder rung.
Yes.
Based on those first 4 axes, it kind of sounds like standard ETRM systems only track, what kind of vehicle you're driving and who is in the passenger seat. But they completely ignore how close you are to the edge of the cliff.
That is the perfect way to look at it.
Yeah.
The first 4 axes describe what you trade. The ladder rung describes how physically committed you are.
Right.
Think back to Chapter 2 of the program. The obligation ladder tracks physical reality. Rung 1 is no physical commitment. Rung 3 means the vessel is fixed. Rung 5 means the discharge slot is confirmed and the buyer is actually nominated.
So your mandate has to state the maximum rung the desk can operate above and how many positions can sit there simultaneously.
Exactly.
Why do standard risk systems just miss this entirely?
Well, because an ETRM system is generally built to capture financial state and trade attributes. The obligation ladder is a property of the desk's operational situation, not a property of any individual trade's price.
Oh, I see. It doesn't really fit the software.
Right. It doesn't have a natural home in a standard trade level limit system, but it entirely determines what it'll actually cost to stop what you are doing in an emergency.
Okay, so once we have the rules of the game drawn out across these 5 axes, we have to recognize that the moment you try to apply them, geography completely changes how they function.
Oh, completely. Night and day.
Yeah, the course materials draw this really stark recurring structural contrast between running a U.S. desk and an EU desk.
It is a profound structural contrast because they answer to entirely different regulatory realities. The recurring theme to just keep in front of you is that a U.S. desk mostly acquires permissions.
Permissions, got it.
Yeah, you get them once from the government and you just check them per transaction.
Mm-hmm.
But an EU desk mostly acquires demonstrations, which have to be meticulously reproduced and verified for every single cargo.
How does that apply to the axes we just mapped out, like location and tenor?
Take those exactly. For a U.S. desk, the location axis is all about managing the permitted destination set under its specific export authorization from the Department of Energy. And the tenor axis just interacts with the expiry date of that authorization.
Pretty straightforward. And the EU desk?
It's completely flipped. The location axis must name the permitted origin set based on prior authorization and origin verification. And the tenor axis interacts with obligation dates that fall inside a typical delivery schedule.
The real trap, though, seems to be on the counterparty axis. Let's say I'm running an EU desk. I buy a perfectly legal physical cargo from an approved, fully vetted trading counterparty. They pass all compliance checks. How can I still be exposed?
Because the EU regulates the physical atoms, not just the financial handshake. This is the EU trap that catches so many people completely off guard.
Wait, really?
Yeah. For a U.S. desk, counterparty management is mostly just standard sanctions screening. But under European methane rules, the demonstration obligation attaches to the producer.
The producer, not the firm I directly bought the cargo from.
Correct. In the LNG market, a cargo might change hands 4 or 5 times while it's just sitting on the water. The original producer might be multiple transactions upstream.
Wow.
They might not even be on your desk's approved counterparty list. But if their methane equivalents cannot be demonstrated according to EU standards, your desk is suddenly stuck holding a physical cargo of gas that it cannot legally place on the union market.
So your mandate has to constrain the origin set, not just the direct counterparty set, or you're going to buy a cargo you literally cannot sell.
Exactly. It's a huge blind spot.
Okay, so once a desk has successfully built a mandate that allows them to legally trade, the very next physical constraint they hit is actually funding those trades. Let's look at where an LNG desk's capital actually goes. Because looking at the numbers and the material, the reality almost never matches what people assume.
Let's walk through a real work example from the program. We have a desk with $650 million in allocated capital. They're running 6 live cargoes. Where does that capital go?
Well, I think most people outside the industry would assume the trading hedges consume the bulk of it. That's the financial risk everyone always talks about.
Right, but the hedge initial margin for those 6 cargoes, the Henry Hub or TTF exposure,
Yeah.
is roughly $12 million.
12 million out of a $650 million allocation. That is barely a drop in the bucket.
It's under 2% of the allocated capital. The next bucket is cargo working capital. This is the cash committed to the physical cargoes between the moment you pay for them and the moment you actually receive payment from your buyer. For 6 live cargoes, that consumes roughly $144 million.
Okay, so we have 144 million in working capital plus 12 million in hedges. That's 156 million dollars accounted for. Where is the rest of the 650 million?
The single largest consumer of capital on this desk is actually a capitalized fixed commitment from a prior year. That sits at $194 million.
What exactly is that fixed commitment?
It's typically a legacy infrastructure contract, like a long-term liquefaction offtake or a terminal capacity agreement signed years ago. It just sits on the balance sheet, consuming nearly a third of the allocated capital.
The irony there is staggering. The paper hedges, which probably consume the vast majority of the risk management team's daily attention and meeting time, only use 2% of the capital.
Exactly.
Meanwhile, the biggest consumer, almost $200 million, is a commitment made before any trading even happened this year.
Attention and capital are often allocated in roughly inverse proportion, and that isn't necessarily wrong because hedges are volatile and need daily management.
Yeah, they move fast.
But it must be deliberate. You need to know that your capital is dominated by a contract you didn't make this year and honestly cannot unmake this year.
Let's add that up, though. We have the 194 million fixed commitment, 144 million in working capital, and 12 million in hedges. That adds up to roughly $350 million. On a $650 million allocation, they are only using about 54% of their capital. They have nearly $300 million in headroom. Logically, they should be out hunting for a 7th cargo.
Which brings us back to the paradox we opened with, the credit snare. If that desk tries to buy a 7th cargo, they are going to hit a brick wall.
Yeah.
Capital is only one constraint. Credit capacity is an entirely separate constraint, and in LNG, it almost always binds first.
Walk us through the mechanics of why credit chokes the desk out before capital does.
Think about the notional value of those physical ships. Those 6 live cargoes carry a notional value of roughly $36.7 million each. The total live cargo notional is roughly $220 million.
Okay, doing the math.
If the desk has a credit line with their clearing banks of, say, $250 million, they are already at 88% of their credit capacity.
Oh, wow. So they're only using half their capital, but nearly 90% of their credit.
Precisely. And if the desk only watches the capital dashboard, they will see $300 million in headroom. They will find an incredibly attractive opportunity, try to book it, and the system will reject it because the credit limit binds first.
You must compute all your constraints in the same units, right? And know which one binds first today before you need to act on it.
You have to.
So credit is one invisible wall. But there is a much more dangerous phenomenon that occurs when your numbers look perfect, but the physical reality decays. Let's talk about drift.
Drift is the invisible risk, and it is the exact reason we desperately need that missing obligation ladder rung on the mandate.
The 5th axis.
Exactly. Let's look at a pretty chilling case study. A desk operates for 18 months. They hold 6 live cargoes. Throughout this entire period, they do not breach a single limit. Their net volume stays exactly the same. Their delta, which is their directional price sensitivity, is unchanged.
Okay, looking good so far.
Their value at risk, or VAR, is perfectly stable. They use the same approved counterparties. Internal audit reviews, both years and records, absolutely 0 exceptions.
I mean, everything looks completely pristine on paper.
It does. But underneath the surface, the physical reality of their positions is shifting. Think of it like winding a mechanical spring. From the outside, a wound spring and an unwound spring look exactly the same. They take up the exact same footprint on a desk.
Right.
But the kinetic energy, the potential for a violent release, is vastly different.
How does that apply to the cargoes, though?
Over the quarter, because chartering vessels became cheaper than waiting and buyers began asking for earlier nominations, the desk's physical positions moved from ladder rung 3, which is vessel fixed, to ladder rung 5, which is discharge slot confirmed and buyer nominated.
So they became much more tightly committed to the physical delivery schedule. But because the price exposure didn't change, the risk metrics didn't catch the tightening of the spring.
Exactly. Every limit the desk has is expressed in units that did not move. But let's look at the actual cost to reach flat, meaning the sheer cost to exit every live position in an emergency.
Okay, what were the numbers?
At ladder run 3, the cost to reach flat was roughly $1.45 million per cargo. At ladder run 5, because you have locked in discharge slots and nominated buyers that you will now have to buy your way out of, the cost to exit jumps to roughly $4.94 million per cargo.
Wait, so it goes from $1.5 million to nearly $5 million per cargo.
Yes. Across 6 cargoes, the total cost to exit went from roughly $8.7 million to nearly $30 million.
That's insane.
That is almost $30 million of exit cost, against less than $9 million 18 months earlier on an essentially unchanged position.
Okay, let me push back on this, just playing devil's advocate for the trader. Let's say a liquefaction plant outage hits suddenly. The desk has to unwind these positions at short notice, and they lose $21 million trying to exit. The desk is just going to blame market conditions, right?
Right, without a doubt.
They'll say it was a black swan event. Nobody could have predicted the plant going offline.
They will say exactly that. And dismantling that excuse is the primary job of desk leadership. The plant outage did not create the $21 million cost. The cost was created over 18 months of gradual, invisible movement up the obligation ladder.
The outage just presented the invoice for the drift.
That is exactly right. I love that phrasing. If you attribute that loss to market conditions, you basically guarantee that nothing will get fixed, because market conditions are outside your control. A mandate axis is entirely within your control.
That makes total sense.
Risk, in the sense of what can be lost on a directional price move, which is what VAR measures did not increase. But risk in the sense of what it costs to stop operations more than tripled. If you aren't measuring the ladder rung, you are completely blind to drift.
If VAR, value at risk, doesn't show us the tightening spring of drift, how are executives even supposed to measure a desk's performance? The source material highlights this massive problem: dueling metrics.
Oh, this is a huge headache.
The two most common performance metrics can look at the exact same desk with the exact same numbers and come to completely opposite conclusions.
This creates immense friction at the CFO level.
Yeah.
Let's compare return on allocated capital against margin per unit of VAR. Take our desk. They have an annual program profit of roughly $210 million.
Yeah.
Against their $650 million of allocated capital, their return on capital is a very healthy 32%.
Yeah, 32% is a great year.
Now look at the other metric. That same $210 million profit divided by their $12 million VAR budget, their margin per unit of VAR is roughly 17 times.
Yeah.
Also looks fantastic. But what happens if the desk's VAR magically doubles to $24 million, but their profit stays exactly the same?
Well, their profit hasn't changed and their allocated capital hasn't changed, so the return on allocated capital stays exactly the same at 32%.
But the margin per unit of VAR gets sliced in half. It drops from 17 times down to roughly 8.5 times. The desk has doubled its risk consumption, and the return on capital metric hasn't even noticed the change.
So the two metrics are fundamentally misaligned.
They're answering completely different questions. Return on allocated capital asks, is the firm's balance sheet being used well? Margin per unit of VARs asks, is the firm's risk appetite being used well?
Okay, I see.
If a desk is only evaluated on the first metric, they can consume the firm's entire risk budget while looking completely stable to the executives.
But the real insight that ties this all together is that neither of those metrics, not return on capital and not margin per VAR, neither of them sees that $194 million fixed contractual commitment we talked about earlier.
Not at all. Both denominators ignore it because it is a certainty rather than a trading position. But in a narrow spread regime, that legacy certainty can produce a massive loss, say over $100 million, arising with absolutely no limit breach and no model failure.
Wow.
That massive fixed obligation must sit on its own line in the risk pack. You cannot divide it by anything, and you absolutely cannot blend it into VAR. Running an LNG desk requires understanding the physical structural architecture of these commitments, not just the financial outputs.
We've covered how to actually bound a trader using all 5 axes. We've seen how credit will just choke you out long before capital does, and we've dragged that invisible drift out into the light.
It's a lot to process.
Yeah.
But before we wrap up, I want to leave you with a practical, desk-focused exercise to run today.
Awesome. Let's hear it.
Calculate your portfolio's cost to reach flat right now, using the obligation ladder rungs we discussed. What is the sheer cost to exit every live physical position? Then, compare it to a snapshot from 12 months ago.
Just to see how much kinetic energy is wound up in the spring today versus last year.
Exactly. The difference between those two numbers is the exact amount of invisible drift infecting your desk. Once you see that number, you won't be able to ignore the missing fifth mandate axis ever again.
What a brilliant exercise. So what comes next in the master program?
Well, now that we know what a desk is accountable for and what boundaries we place around their decisions, Chapter 6 is going to ask the question that most trading desks are absolutely terrified to formally ask.
And what's that?
When should you choose not to trade LNG at all?
That is going to be a fascinating conversation. Well, you now have the tools to draw your mandate's boundaries, measure your true distance to the edge, and know exactly how hard you have to hit the brakes if the road suddenly ends. Run that self-check, look for the drift, and we will see you on the next deep dive. So, usually when we talk about a medical diagnosis, there's this clear expectation of precision, right?
Exactly.
It feels like engineering. Like if you break your arm, the x-ray shows that jagged white line, and the doctor just points at the screen and says, well, there it is. It's a binary visible fact, broken or not broken.
Right. And human beings, we really crave that kind of certainty. I mean, we want our risks to be visible and, easily categorized so we can manage them.
But the moment you step onto a high-stakes LNG trading desk, that x-ray machine just shatters. I mean, we are looking at a diagnostic landscape for profitability that is, well, it's incredibly murky.
Oh, entirely. It is the absolute definition of diagnostic muddy waters.
Because you're sitting there making execution decisions where a fraction of a cent means millions of dollars in profit or loss, and you're being forced to do it through a total fog of estimation.
Yeah, and if you're an aspiring or working professional in this space, whether you are a trader, an originator, or a risk manager, or maybe you're building the ETRM systems, navigating that fog is your actual job. You just don't get to wait for perfect clarity.
Which brings us to the mission for today's deep dive. We are stepping back into the LNG Trading Desk Master Program.
Designed by Durga Analytics.
Exactly. And for those following along, this is a massive, carefully sequenced journey. It spans 9 modules and 120 chapters, starting from the literal physics of the value chain, liquefaction and boil-off, all the way through indexation, trading playbooks, and ultimately desk leadership.
Right, and it's built entirely on real markets, verified arithmetic, and desk-ready applied builds.
And our focus today lands squarely in Module 01, which is running an LNG trading desk. Specifically, we're going to explore the mechanics behind Chapter 06. When not to trade LNG.
Yeah, that title alone feels like a paradox, doesn't it?
It really does. Think about where we are in this journey. Earlier on, we were given the exact arithmetic to calculate a highly specific netback.
Right, the exact numbers.
Like, let's say a profitability metric of 2.8089 US dollars per delivered MMB2. We figured out exactly how to price our margins. So if we have the perfect math to identify a profitable trade, why are we suddenly dedicating an entire discussion to hitting the brakes and doing absolutely nothing?
Well, because treating that $2.8089 netback as a hard, undeniable fact is, frankly, exactly what destroys trading desks.
Wait, really? How so?
I mean, the arithmetic used to calculate it might be perfectly correct, but the inputs feeding that arithmetic, they're not facts, they're estimates. And every single estimate has an error attached to it.
I see.
So that final netback number is actually an illusion. It really shouldn't be viewed as a rigid single number. It's a distribution of probabilities.
Okay, let me stop you there, because treating a profit margin as a distribution of probabilities, that sounds like a great way to paralyze a trading desk. How do you practically map out that uncertainty without just freezing up?
You build what we call an error stack. So if we look at a standard Atlantic cargo, there are 5 distinct sources of estimation error baked into your netback, and they come from entirely different categories of risk.
Okay, let's lay those out on the table.
Right, so 2 are physical, 1 is commercial, 1's observational, and 1 is contingent.
Let me list them. First, we have heating value, which is the physical measurement tolerance at the custody transfer point.
Exactly. Second is the boil-off rate, which changes based on, the condition of the vessel, the sea state, how many days the ship is laden.
Third is freight, meaning the spot charter market rate you get when you actually go to fix the vessel. Fourth, we have price assessments, since the published market benchmarks carry their own bid-ask spreads.
Right. And finally, demurrage, which is entirely contingent on whether the berth happens to be congested when your ship actually arrives.
Okay, so we've got our 5 errors.
Yeah. And what happens next is this really fascinating clash between human psychology and mathematical reality. Because On almost every desk, if you ask the operations department what they spend their days arguing about with counterparties, it is almost always heating value.
Okay, wait, I have to push back on that being a psychological flaw.
Oh.
Yeah, I mean, operations teams argue about heating value because it dictates the actual invoiced quantity. If the measurement is off, one party is legally overpaying or underpaying, it causes massive real-world settlement disputes. It makes complete sense that they're upset with it.
Well, it makes legal and operational sense, certainly. I'm not denying that.
Yeah.
But mathematically, in the context of the trade's overall risk profile, it is a massive distraction.
How much of a distraction?
When you actually run the numbers on the error stack, heating value only accounts for 4.9% of the total variance in your netback.
Wait, 4.9%?
4.9%.
So the thing everyone is fighting over, sending all these angry emails about, is essentially a rounding error in the grand scheme of the trade's risk. It's like arguing over the cost of a new thermometer while completely ignoring the Category 5 hurricane outside your window.
That is the perfect analogy. And the hurricane in this case is freight.
Freight.
Yes, freight contributes a staggering 44.9% of the total variance on its own. It's the dominant force.
But why is the gap so massive? Why does freight overshadow everything else to that extreme degree?
It comes down to a mathematical principle called quadrature. When you're combining independent errors, meaning, one error doesn't cause the other, you don't just add them up in a straight line.
Right, you can't just do basic addition.
Exactly. You take the square root of the sum of their squares.
Oh, I see. So by squaring the numbers before adding them, the math forces the largest single term to absolutely dominate the final output.
Precisely. The heavy hitter pulls all the gravity. So when you combine all 5 of those specific cargo errors in quadrature, the math spits out a combined standard error of 0.1327 US dollars per MMB2.
Which means attention on an LNG desk is routinely allocated in the exact inverse proportion to what actually causes variance.
Right.
The desk will fight tooth and nail over a 4.9% physical measurement dispute, but completely accept the 44.9% commercial freight risk as just the cost of doing business.
Which is a very dangerous cultural norm to accept. Because if freight is this giant swinging pendulum of risk and our combined standard error is sitting at 0.1327, the trader has to mathematically draw a hard line between a genuinely good trade and a literal coin toss.
How do you draw that line on a busy desk without it just being like a gut feeling?
You establish a strict minimum tradable edge, and the applied desk-ready rule of thumb for this is 3 standard errors.
Okay, let me do that math really quick. 3 times our standard error of 0.1327 gives us roughly 0.3981 US dollars per MMB2.
Correct.
And if you multiply that by a standard LNG cargo size, you are looking at exactly 1,491,911 US dollars per cargo.
That $1.49 billion is your floor. Any opportunity that presents a projected profit margin smaller than that threshold should be declined on pure arithmetic.
Wow.
And that decline needs to happen before anyone on the desk even forms a view about where the global gas market is heading.
I want to look at the practical example from the curriculum here, because this is where the math really humbles you. Let's say a trader spots a tight basin spread, and the spreadsheet shows a projected profit of $0.18 per MMB2.
Right, 18 cents.
Yeah. And to a lot of traders, 18 cents is green, it's positive, they want to hit execute. But if you divide that 0.18 by our standard error of 0.1327, you are only operating at 1.36 standard errors.
And operating at 1.36 standard errors is terrifying if you actually understand probability. Doing that trade means you have roughly a 1 in 12 chance of taking a massive loss purely from estimation error.
A 1 in 12 chance of losing money before the market even opens. I mean, before any prices move against you, before any counterparty defaults, before a single thing actually goes wrong operationally. Just baked in mathematical failure.
And when you add in the cost of eventually exiting that position, which we know is a very real, price cost a trade at 1.36 standard errors isn't a small marginal win. It is a coin toss where you're paying a massive transaction fee for the privilege of flipping the coin.
Jeez.
Yeah. A desk that executes that trade hasn't found a small edge. They've taken no edge at all.
But telling a trading desk they just have to sit on their hands and stop trading isn't a viable business strategy. I mean, you can't just tell management, sorry, the math said no. So how does a desk actively lower that threshold so they can safely execute more trades?
You use what we call the freight lever. Remember, we established that freight accounts for 44.9% of the variance, right?
Right.
Well, most desks treat chartering a vessel as a procurement task, It's just a cost to be minimized, usually delegated to the shipping department days or weeks after the actual trade is committed.
But the strategy here flips that entirely. It argues you should fix the vessel before you commit to the trade.
Exactly. It's a fundamental shift in sequencing. Because if you fix the ship first, you completely remove that 44.9% variance from your error stack. The uncertainty of the freight market is gone because the rate is locked.
Let's run the new numbers on that because the impact is wild. If you remove freight from that quadrature calculation, your combined standard error drops from 0.1327 down to $0.0985 per MMB2.
Yep.
Which drops your 3 sigma minimum edge from $1.49 million per cargo down to $1.11 million.
You just reduced your required threshold by over 25%. So by simply changing the sequence of how you interact with your shipping department, you converted roughly $384,000 of previously untradeable opportunity into legitimate, mathematically safe trade territory.
But hang on, fixing a ship early usually means you aren't getting the absolute optimal bottom dollar freight rate. I mean, you might be paying a premium for that early security.
And that is the exact trade-off calculation the desk needs to make. The math clearly shows that if the premium you pay to secure that charter early is less than that $384,000 gap, fixing early is highly profitable.
Oh, that makes sense.
It widens the universe of trades your desk can safely execute. Chartering is not a side quest for the operations team. It belongs deeply embedded inside the trading decision itself.
Okay, so we've covered the rigid arithmetic of when to decline a trade based on price, variance, margins. But let's be real, the reality of a trading desk isn't just math. There are times when the decision to walk away has absolutely nothing to do with money.
Oh, absolutely. And this brings us to the vital distinction between priced economic constraints and unpriced regulatory gates.
Right. In the professional practice, there are really only 5 things that should force you to decline a trade. The first 3 are the price constraints we just talked about. Number 1, your edge is inside the error bar. Number 2, there's simply no vessel available in the market for your window. And number 3, your credit capacity is exhausted.
And those 3 are ultimately cost-benefit calculations. If the edge is large enough, you might find a way to, pay up for an expensive vessel or get management to free up more credit. But the final 2 reasons to decline a trade are gates.
Right.
And a gate does not have a price. You cannot buy your way out of it.
And those 2 unpriced gates are origin and destination. And to really understand how these gates function in the real world, we have to look at the structural contrast between a U.S. desk and an EU desk.
Very true.
Because they answer to entirely different regulators, and frankly, they fail in completely different ways.
This is one of the most important concepts for a modern desk to grasp. Let's examine the U.S. desk first. The governing principle for a U.S. desk is permissions.
Okay, permissions.
Right. Generally speaking, the origin of the gas is not a primary constraint on U.S. exports. The destination, however, must sit inside the export authorization held under Section 3 of the Natural Gas Act. And importantly, that authorization follows the gas even after a title transfer or a re-export.
But the operational reality for the U.S. desk is that this is essentially a permission that is checked once per transaction type, right? It's a structural hurdle, but it's somewhat static.
Correct. But then you pivot to the EU desk, and you are operating in a completely different regulatory universe. Their governing principle is not just obtaining a permission, it is demonstrations.
Okay, let's break that down. What does an EU desk actually have to demonstrate?
Well, first, the origin country of the gas must be rigorously verified. It cannot simply be assumed. This falls under prior authorization regimes. And based on current implementation schedules, the upstream producers monitoring, reporting, and verification, their MRV for emissions, must be actively demonstrable as equivalent to strict EU standards.
Wow. And on the destination side for the EU?
It is incredibly tight.
Yeah.
The receiving terminal and the specific buyer must be completely clear of applicable sanctions packages. And remember, modern sanctions don't just apply to the buyer's corporate entity. They reach deep into vessel history, maritime insurance, terminal services, and here is the kicker. This is not a one-and-done structural check. This demonstration of compliance must be reproduced from scratch for every single cargo.
Which creates a massive, intense behavioral trap on the trading floor. I mean, picture a trader sitting there holding a potential deal. They have a willing counterparty, the math works, but they are waiting on a compliance check for the EU destination.
Yep.
The decay pressure on that decision, like the market moving while they wait, can easily cost $90,000 an hour.
Oh, absolutely. The financial pressure is immediate and visible on the screens.
So, with the clock ticking and $90,000 evaporating every 60 minutes, human nature kicks in. The trader looks at this unpriced structural regulatory gate, and their brain tries to transform it into a priced timing constraint.
And they will say something to the desk head that sounds entirely reasonable and professional in the moment. They'll say, look, we are highly confident the origin and the MRV equivalents are fine. Let's execute the trade to capture the margin, and we'll formally confirm the compliance paperwork after the fixture.
It sounds so rational. They're trying to save the firm money while assuming a risk they feel is negligible.
It sounds rational, but from a regulatory perspective, it is deadly. Being right about the facts after the fact isn't the test. Being able to demonstrate those facts at the exact moment you made the execution decision is the test.
Oh, wow. So if they get audited.
Yeah, if a regulator audits that trade 2 years later and the assessment record is missing at the exact timestamp of execution, that is a massive conduct failure.
Yeah.
The regulator does not care that the origin turned out to be fine. They care that you acted without the demonstration in hand.
So how does a desk actually prevent that? You can't just train traders to ignore $90,000 an hour. That goes against every instinct they have.
You don't try to change human nature. You change the desk structure. You have to structurally separate the people. The person holding the gate, like the compliance officer, verifying the origin or the MRV equivalents, must absolutely never be the same person feeling the financial pressure of the decay.
Oh, I see.
If the person watching $90,000 an hour burn away is the same person who has the authority to waive the gate will eventually fall. It's a structural inevitability.
Which perfectly brings us to the hardest question in this whole curriculum. If declining trades is this incredibly complex, if you have to balance quadrature error stacks, minimum edges, freight levers, and these massive regulatory gates, how do we know if a trading desk is actually any good at saying no?
You have to look at the act of declining as a U-curve. It's a skill with an interior optimum, meaning the sweet spot is right in the middle. Both extreme ends of the curve represent failure states for the desk.
Right. So on one end of the curve, you have a desk that declines absolutely nothing. They aren't selecting trades based on edge. They're just a passive price taker with a shipping department attached. Their profit and loss will just be the random average of whatever opportunities the market tossed their way.
Exactly. And on the far other end of the curve, you have a desk that declines almost everything. They've completely replaced commercial judgment with overly rigid rules.
Right.
The massive danger there is that their failure is totally invisible. If you execute a bad trade, that error of commission shows up immediately in the P&L. But if you pass on a brilliant trade, that error of omission exists nowhere in standard accounting.
I want to ground this in the composite case study from the curriculum because it perfectly illustrates a desk that thought they were being incredibly disciplined, but totally misunderstood their own variance.
Yeah, let's walk through the setup of that case.
Okay, so a trading desk spots a basin spread opportunity. The spreadsheet shows a tight edge of $0.21 US per MMB2 on a standard cargo. They run their error stack calculation. 0.21 divided by our 0.1327 standard error means they're operating at a 1.58 standard error edge.
Which we know is well below the 3 sigma threshold we established. Operating at 1.58 standard errors carries a 1 in 17 chance of failure purely from estimation error before the market even moves.
Exactly. But the desk rationalizes it. They say, look, it is a small edge, yes, but we are going to do it a bunch of times and diversify the risk.
Right, the diversification argument.
Right. So they go out and execute 11 of these exact same trades over 2 quarters. 11 cardos, standard size, all at a 0.21 edge. Based on the math, they expect to make about $8.6 million in profit.
And what was the actual realized result after the 2 quarters?
They lost $3.18 million.
Yeah. And when management came down and asked what happened, what was the desk's defense?
They threw their hands up and said they just got uncharacteristically unlucky.
But luck had absolutely nothing to do with it. Nobody mismeasured the physical gas. No pricing models broke. The edge they saw was real. It was just smaller than the uncertainty in measuring it.
Right.
The fatal flaw was their fundamental misunderstanding of diversification.
Let me use an analogy here because this is where the math really clicks. The desk thought they were flipping 11 independent coins, giving themselves 11 different chances to land on heads and average out a win.
Right.
But because of how the market works, those 11 coins were essentially glued together. They weren't getting 11 chances. They were just making one massive, incredibly heavy bet on a single coin toss.
That is exactly what happened. Repeating a trade 11 times only reduces your variance if the risks are truly independent. But in this case, all 11 cargoes shared the exact same spot freight market. They shared the
Ah.
same two published price assessments. They shared the same seasonal berth congestion at the terminal. They were highly correlated.
So by repeating the trade, they didn't diversify anything. They just massively scaled their financial exposure to the exact same risks without reducing their variance per unit one bit.
Which is why a desk mandate cannot just rely on a simple volume limit. The control remedy taught here is a strict rule stating that no position can be initiated below a stated multiple of its own standard error. And crucially, that multiple must apply to the correlated family of positions, not just the individual trades in isolation.
Okay, so we have all this math telling us when to walk away. But if standard accounting won't show us when we are wrong to walk away, like if errors of omission are invisible, what is the practical desk-ready remedy?
It's a tool that costs absolutely nothing to implement, yet almost no one actually does it. It's the declined opportunity register.
Well, when you say a register, we are literally just talking about a spreadsheet, right?
A simple spreadsheet, but one that requires immense cultural discipline.
Okay.
Every single time you decline a trade on the desk, you log it. You record the date, the counterparty, the computed edge, the standard error at the time, and the specific reason code. Was it a price constraint or was it a regulatory gate?
Got it.
And you mandate that every decline needs a single named owner logged in that sheet.
But the real magic of the spreadsheet isn't what you do on the day of the decline. It's the column you fill out months later.
Yes, the realized outcome column. At the end of the quarter, you go back and look at the observable market prices to see what actually would have happened to your P&L if you had taken that trade.
I absolutely love this because after a year, this register answers the one question no standard accounting system can. Were your declines actually right?
Exactly.
If you look at that spreadsheet and see that your decline trades would have systematically made millions of dollars, you have hard proof that your threshold is too high. You are being too conservative and leaving money on the table. But if the data shows those trades would have bled money, then your discipline is working perfectly. And in a bad year, when market volatility is low and leadership comes marching down to the trading floor demanding to know why execution volumes are down, that register is the only hard empirical evidence you have.
You can prove to management that your desk was actively and intelligently selecting the right risks rather than just blindly accepting whatever toxic opportunities the market happened to offer. It forces your errors of omission out of the shadows and makes them visible.
All right, we have unpacked a massive amount of technical ground today, so it is time for the self-check. If you are listening to this on an LNG desk right now, here is your practical homework based on Module 1, Chapter 6. First, build your own error stack for your most common trade flow. Use honest, realistic ranges for your 5 terms, compute your standard error, and convert your minimum threshold into actual US dollars per cargo.
And second, say that hard dollar amount out loud to your team so everyone knows the floor.
Third, explicitly separate your unpriced regulatory gates from your priced constraints and verify that the person holding the gate is structurally insulated from the cost of delay. And finally, open that declined opportunity register spreadsheet before the end of the week.
Right. And if we pull back and connect all of this to the bigger picture of running a durable desk, true commercial discipline is never about building a more mathematically perfect net-back model. It is about understanding the strict limits of your own uncertainty.
Yeah.
It's about knowing your variance, fixing your freight early to buy yourself a wider tradable edge, and most importantly, having the institutional courage to walk away from a deal when the arithmetic demands it.
Which perfectly sets us up for where the Durga Analytics Master Program goes next. In Chapter 7, we are going to dive into the structural differences between the deliberate, speculative positions a desk takes versus the continuous flow business it runs every single day.
Which require totally different risk controls.
Exactly. They fail in completely different ways, and wildly, most desks spend all their risk management effort on the smaller of the two.
It's a critical operational distinction if you want your desk to survive the long term.
It really is. So we'll leave you with this final thought to mull over until we dive into the next chapter. We spent our entire careers agonizing over the consequences of our yes, the trades we executed that went bad, the counterparties that defaulted. But if your standard P&L only tracks what you actually did, how much of your desk's actual strategy is being secretly driven by the ghosts of the trades you never took?
We'll see you on the desk. If you are serving on a submarine, there are essentially 2 ways your vessel can take on water.
Right. Neither of them are great.
Exactly. Neither is good. But the first way is, it's terrifying, but it's incredibly obvious. The hull breaches, alarms blare, red lights flash, and every single person on board immediately knows there is a massive crisis that requires instant intervention.
Yeah. Everybody drops what they're doing.
Right. But the second way is just a tiny, silent leak in some obscure valve. It's so small that it doesn't trigger a single pressure alarm. But if nobody is actively checking the bilge levels, that slow, steady leak will eventually sink the vessel just as surely as the breached hull.
And the outcome is identical, right? You're still sinking. Yet the psychology of how we monitor for those two distinct events is completely different. Human beings, and by extension, the risk management systems we design, they're fundamentally hardwired to watch for explosions, not drips.
That psychological blind spot is exactly the central mystery we are unpacking today. Welcome to this deep dive into the high-stakes, honestly incredibly complex world of energy markets. For those of you following our journey through the Durga Analytics LNG Trading Desk Master Program, you know this course is this massive sequence journey across 9 modules and 120 chapters.
It's a huge undertaking, from the physical value chain all the way to ETRM systems and desk legacy.
Yeah, exactly. And today we are firmly planted in Module 1, which is running an LNG trading desk, and we're zeroing in on Chapter 7, titled Spec versus Flow Control Points.
And this is really a critical juncture in the program because it challenges the fundamental architecture of how a trading desk actually operates. I mean, we are looking at how a sophisticated LNG desk is, in reality, 2 entirely different businesses operating under one single roof.
2 completely distinct loss profiles.
Exactly. And yet desk leadership almost always places their risk controls in exactly the wrong places.
Okay, let's unpack this because, I mean, how can a highly capitalized, super technologically advanced trading desk lose millions of dollars over time without a single alarm bell going off? Just because the losses arrived as a slow leak?
Well, the root of the problem actually starts with the very people hired to protect the desk. Like, risk management teams are highly trained professionals, but their training is overwhelmingly focused on dramatic existential failures.
You want to catch the explosion.
Right. They are scanning the horizon for the rogue trader, the sudden and catastrophic market collapse or the massive unhedged bet. Because they focus almost all their energy, their budget, and frankly, their technology on the spectacular, they leave the mundane, everyday physical operations completely blind to aggregate losses.
Wow. Okay, so before we can really analyze why these safety controls fail, we need to clearly define these 2 different beasts living on the trading desk. The source material categorizes them as flow and speculative business. And if you ask desk management to separate these 2, their first instinct is usually to try and measure intent.
Yeah, which is a trap.
Totally. They will claim that speculative trades are the ones executed specifically to make money, while flow trades are just the operational movements they, quote-unquote, had to do.
And the source material just dismantles that definition instantly.
Yeah.
Because in LNG trading, or really any commodity trading, every single transaction is executed with the intent to make money.
Right. Nobody's doing it for charity.
Exactly. Every position on the board creates an economic obligation. You cannot measure risk by asking what the trader was, feeling in their heart or what their strategic intention was when they clicked the execution button.
So intent is a completely false metric. The true metric, according to Chapter 7, is obligation. It's entirely about where the obligation actually originated.
Yeah, let's break down the mechanics of that proper definition. So flow is business the desk is committed to by a pre-existing arrangement. Think of a long-term sale and purchase agreement, an SPA, or a booked regasification slot at a European import terminal.
So it's already on the books.
Exactly. The desk didn't wake up this morning and actively decide to take on this specific exposure. It was already there. It's baked into the infrastructure and the legacy contracts. Therefore, the central question for the flow business is simply, did we execute well?
Did we execute well? Okay, and on the other side of the ledger, we have the speculative or spec business. So this is exposure the desk actively chose to add to the portfolio, or crucially chose to retain when they could have easily closed it out.
Right. It's a current active decision to take a view on the market.
So the central question for spec is fundamentally different. It's, were we right? It's kind of like being a city bus driver versus taking a sports car off-road.
I like that analogy.
Right. The bus driver has a strict pre-planned route, a rigid schedule, passengers waiting. Their only job is to drive that specific route safely and efficiently. That's flow. But the sports car driver is going off-road specifically to find a completely new shortcut that no one else has discovered. That's spec.
And because the driving styles for a heavily laden city bus and a nimble off-road sports car are so fundamentally different, you absolutely cannot hand both drivers the same safety manual.
Yeah, that would be a disaster.
It would. If you tell the sports car driver they have to stop at every designated bus stop along the way, they will never find the shortcut. And if you tell the bus driver to go off-roading through the mud, you are going to cause a massive, massive accident. Yet trading desks consistently try to use one unified risk manual for both.
Which brings us to how desks actually measure these two types of business in practice. And this is where the underlying math gets incredibly revealing for you guys listening. The chapter lays out 4 specific measurements using a hypothetical but highly realistic portfolio desk.
Yeah, let's look at the numbers.
So the desk is running 24 cargoes a year, 20 turn cargoes, which is their flow, and 4 discretionary cargoes, which represents their speculative business.
So when we look at measurement number 1, which is volume, flow makes up an overwhelming 83.3% of the desk's physical activity.
83%. Okay, that makes perfect sense, as it represents the bulk of the heavy physical movement and shipping logistics.
Right. Then measurement number 2 looks at the result, or the profit. The speculative side, even though it only accounts for 4 out of the 24 cargoes, it brings in 57.1% of the financial result.
Wow. So it is inherently high margin.
Very high margin. And measurement number 3 is expected loss, where speculative accounts for 64% of the total expected risk.
Okay, so those first 3 columns tell a completely coherent, logical story. Flow is the heavy lifting, massive physical volume, lower margins, lower expected loss. Spec is tiny in volume, but drives outsized profits and carries the vast majority of the expected risk. But then we hit measurement number 4, which is control spend.
Yeah, the budget.
This is the actual budget, time, technology, and human effort spent on risk management. The source notes that desks typically allocate a staggering 80% of their control effort to the speculative side.
And this introduces a really critical analytical concept from the chapter, which is control density. Control density evaluates how much money a desk spends on risk management per dollar of expected loss.
Okay.
So when you run the math on this typical 80-20 budget split, the speculative side is controlled 2.2 times more densely per dollar of expected loss than the flow side.
2.2 times.
Yeah. For every dollar of expected loss on the spec side, they're spending 83 cents on controls. But for the flow side, they're only spending 37 cents.
But wait, looking at those numbers, doesn't that massive control spend on the spec side sort of make perfect sense? I mean, if a trader gets a speculative bet completely wrong, they could bankrupt the firm overnight.
Yeah.
We've all read the headlines about rogue traders destroying companies.
Sure, the Nick Leesons of the world. Snally. But a flow error, like a missed customs document or a demurrage charge, which, for those who don't know, is just the penalty you pay when a ship sits idle at a port waiting to unload. That's just a minor clerical cost, right? Shouldn't a desk spend 80% of its budget preventing actual bankruptcy? That is exactly the pushback that management always gives,
Yeah.
and the source material anticipates that exact challenge. The chapter is not arguing for strict mathematically proportional spending, the tail risk on the speculative side, that remote chance of a catastrophic company-ending market event that absolutely justifies heavier, denser, and more sophisticated controls.
Right.
However, the core argument is that this 80-20 split on most desks isn't some highly calculated, optimized decision designed specifically to survive tail risk. It's not. It is an inherited, completely unexamined habit from a bygone era when flow risk genuinely was trivial.
So they do it just because they've always done it.
Exactly. They have left the flow side critically underfunded out of habit, not strategy.
Ah. And because these two risks are fundamentally different in nature, they actually appear at totally different times in a cargo's lifespan, which means applying the same control philosophy to both is just a guaranteed disaster.
Completely.
The source provides some fascinating visual data mapping out where risk actually lives chronologically. Speculative risk concentrates and peaks at the very front of a cargo's life. It peaks at the deal phase.
Right, the moment of decision.
Exactly.
Yeah.
That is the moment the trader makes the decision to take the position, decides on the massive volume, decides on the hedging strategy. Once that initial decision is made, the speculative risk actually declines over time as the outcome becomes increasingly determined by the market.
And flow risk operates on the exact opposite timeline. It starts incredibly low when the long-term deal is signed. The operational risk steadily rises through the middle phases, the nomination of the ship, the loading at the liquefaction plant, the physical voyage across the
It
ocean.
just keeps building.
Yeah, and it absolutely peaks at the back end of the cargo's life during discharge and settlement. Those are the stages where the messy physical execution can severely deviate from what was neatly written in the contract.
Okay, so because the timing is inverted, the nature of the actual financial losses is inverted. Flow losses are frequent, they're small, and they are usually caused by things like measurement errors of the terminal flange or unexpected boil-off gas during a delayed voyage, or even just a typo in a customs document.
Yeah, physical realm problems.
Right. And crucially, because they happen in the physical realm, they are often only detected weeks later during back-office settlement reconciliation.
Contrast that with spec losses, which are rare but large. They're caused by fundamentally having the wrong view of the global market or sizing the financial trade incorrectly, and they are detected immediately. They're visible daily through mark-to-market accounting, where the risk system is constantly evaluating the current position against today's live market prices.
Right, the screen tells you right away if you're losing money. And here's where it gets really interesting. Because the nature of the risk is so different, the tools required to manage them have to be different. The source issues a very practical, blunt warning here. You cannot use limits for flow risks, and you cannot use checklists for spec risks.
Yeah, if you try to apply a financial limit to a physical flow risk, it is completely useless. A single demurrage loss of $40,000 is so far below any multi-million-dollar trading limit set by the board that it will never trigger a system alert.
It won't even blip on the radar.
Exactly. The losses just slowly accumulate under the radar. It's the slow leak in the submarine we talked about earlier.
Conversely, if you try to manage a massive speculative risk with a procedural checklist, you create this incredibly dangerous false sense of security. Because making a terrible speculative bet on European gas prices isn't a missed procedural step.
No, it's a bad judgment call.
Exactly. A trader can fill out a compliance checklist perfectly, get all the required executive signatures, and still make a disastrous judgment call on market direction. By applying front-end financial controls to back-end physical problems, you guarantee that you are over-controlling one half of your business and vastly under-controlling the other.
And this is where the curriculum's focus on desk structure really shines, particularly when we contrast a U.S. desk with an EU desk. This is vital to understand. A U.S. Gulf Coast lifting desk is heavily focused on acquiring permissions.
Permissions, got it.
Right. They secure Department of Energy export authorizations and FIRST approvals once, and then they check them per transaction. Their risk is highly front-loaded. But an EU discharge desk, however, is obsessed with demonstrations. They have to continuously demonstrate compliance with remite reporting, specific terminal regulations, and dynamic pipeline nominations for every single cargo.
So it never stops for them.
It never stops. The flow risk on an EU desk requires constant, repetitive execution, making it incredibly vulnerable to these small, accumulating back-end errors.
Man, that makes the separation of flow and spec seem super clean in theory. But real life on an LNG desk is messy. A single cargo doesn't always stay in its designated lane. The source material dives into what it calls the hardest case, which defeats almost all standard ETRM software designs.
Yeah, the shape-shifting cargo.
The shape-shifting cargo. What happens when a cargo changes its identity mid-voyage? Let's actually walk through the 5-step journey of this shape-shifting cargo because this blew my mind.
It's a great example. So step 1, the desk lifts a term cargo under their long-term sale and purchase agreement out of a U.S. facility. This is textbook flow. The obligation pre-existed, and the desk's only job is physical execution.
Okay, simple enough. Step 2, the desk instantly sells that physical cargo forward against the European market index like TTF just to lock in the margin. It is still a flow cargo. They have closed the exposure.
Right. But then comes step 3. The trading desk forms a distinct view on the market. They suddenly believe European prices are going to skyrocket, so they lift the index hedge.
They lift it. Mechanically, they go into the market and buy back the financial paper they originally sold.
Exactly. Now, the physical cargo is still sitting on a ship in the middle of the Atlantic, but because it is now unhedged and exposed to floating market prices, this cargo becomes speculative entirely and immediately.
Wow. And then step 4, because it's now a speculative position, the desk decides to divert the physical cargo away from its original destination, sending it to a completely different basin, just to chase better pricing.
So it is now speculative on both a financial and a physical dimension.
Right. And finally, in step 5, the market moves against them, they abandon the diversion, and the cargo is ultimately delivered against that original term sale from step 2. So it reverts back to flow.
And the system blind spot here should absolutely terrify any risk manager listening, because when the auditors look at the official system record after the fact, what does it show?
It just shows a term cargo lifted under an SPA and delivered on a term sale. Everything that happened in the middle, the removed hedge, the physical diversion, the massive speculative exposure carried across the ocean for 3 weeks, it leaves zero trace in the primary positioned history.
None. The ETRM system sees a closed financial ticket when the hedge is lifted, but it doesn't inherently flag that the physical cargo is now naked to the market unless it's specifically configured to do so.
It's just invisible.
Completely invisible unless the desk deliberately records category changes as official risk events. And human nature dictates that if the shape-shifting cargo made money, the desk will praise its own brilliant execution of a flow cargo. If it lost money, they will simply blame the market.
That is wild. And this highlights the most counterintuitive yet vital concept in this entire chapter, exposure by subtraction. Just think about the mechanics of opening a position. If a trader wants to open a brand new 4 million MMB2 speculative position, which, by the way, is just the standard metric million British thermal units we use to measure massive quantities of gas, they have to run a strict gauntlet.
Oh yeah, it's a huge process.
They need desk head approval, risk committee sign-off. It generates a bold ticket in the system, and everyone sees it.
But to remove a hedge on that exact same volume of flow business, which immediately creates the exact same economic exposure to the market, requires nothing.
Nothing.
No special ticket, no committee approval, no alarm bells.
It's literally like driving down the highway at 80 miles an hour, taking your hands entirely off the steering wheel, and claiming you aren't actually driving anymore, so you don't need a license. You're still in the driver's seat. You are still responsible for the cargoes.
And that asymmetry in the control framework is incredibly dangerous. The source states clearly leaving a cargo unhedged is an active choice with the exact same economic content as putting a brand new position on. Unhedged flow is the largest single category of concealed speculative exposure on modern trading desks.
So what's the fix? The remedy the chapter offers is wonderfully simple and requires zero new software procurement. You just treat the removal or reduction of a hedge as a deliberate, active decision that requires the exact same authority and sign-off as opening a new position of that identical size.
Yeah, you force the desk to record category changes as deliberate events with stated, time-stamped reasons. You require executive permission for inaction when that inaction creates risk.
Okay, to demonstrate the devastating real-world impact of everything we've just discussed, the chapter provides this amazing composite case study. It's built from real market volumes and loss assumptions to illustrate a desk whose flow book was simply never subjected to aggregate review. And we can look at the contrast over a 3-year operating period.
Let's look at the speculative book first. On the Spec book, they had a mature, highly funded control framework. Daily risk packs, weekly reviews, strict value at risk limits or VAR limits. Over 3 years, this heavily controlled Spec book had exactly 2 reportable losses. 2. Totaling $3.1 million. And both were caught instantly by the mark-to-market systems, escalated to management, and stopped. The expensive system worked exactly as designed.
Okay, now examine the flow book, the quote-unquote safe side of the desk. They had standard operating procedures and back-office settlement reconciliation, but no actual aggregate risk review. Over those same 3 years, the flow book had 0 reportable losses.
0. Nothing was ever escalated to the risk committee.
0 reportable losses.
Yeah.
But it suffered 94 small events. 94 little paper cuts. Measurement errors at the flange, demurrage penalties, documentation mix-ups that delayed unloading. And the average loss was just under $45,000.
And this is where the trap snaps shut. When you add up those 94 small events, the flow book lost a gross total of $4.18 million. Even after the operations team managed to recover $610,000 through counterparty claims, the net loss was $3.57 million.
It lost more money than the speculative book, $3.57 million compared to $3.1 million. And senior management never noticed. I mean, how does a multi-million-dollar leak remain invisible?
It comes down to a structural flaw called the materiality threshold.
The materiality threshold.
Yeah, this is a reporting floor, usually expressed per individual event. Say your threshold to alert the risk committee is a loss of $100,000. Well, the Flowbook's largest single loss over those 3 years was $88,000.
Oh, wow. So it never tripped the wire.
Exactly. A materiality threshold expressed per event is structurally blind to a distribution with a heavy body and a thin tail. Nobody concealed anything. Nobody committed fraud. The EU and US operations teams operated their distinct processes exactly as designed. The fundamental problem was that the aggregate number simply had no owner.
And the fascinating detail in that case study is the $610,000 recovered in claims. To me, that is the absolute smoking gun. Think about how a demurrage claim actually works. The ship arrives at the terminal, it's backed up, the ship burns boil-off gas while waiting, the demurrage clock starts ticking.
Right.
The commercial operations team sees this, logs the hours, calculates the financial penalty, and files a claim to claw some of that money back from the terminal operator.
Which means the operations team absolutely had the data. That $610K proves that someone on the desk knew about every single one of those 94 individual losses. The information existed in the building.
Yes.
But because of the materiality threshold, literally nobody in the risk organization ever asked the operations team to take those 94 events and just add them up for a monthly review.
They were diligently bailing out the submarine with a teacup and never told the captain there was a structural leak because no single drop of water was big enough to require a formal report.
That's perfectly stated. And the solution the Durga Analytics curriculum provides is a desk-ready applied build. It's elegant in its simplicity. You just create a single monthly metric showing total flowbook leakage. You show it gross, and you show it net of recoveries.
With no thresholds.
Exactly. You report it right alongside the speculative book's losses, but with absolutely zero materiality threshold applied. You just aggregate the small losses. You force desk leadership to look at the slow week every single month.
It completely changes the visibility of the risk without requiring new technology. So if we synthesize the core lessons from Chapter 7, you must understand your underlying obligations, not just your strategic intent. You have to actively match your controls to the specific life cycle of the risk, so using limits and strict decision rights for the speculative front end while utilizing checklists and aggregations for the physical flow back end. And perhaps most importantly, you must guard against exposure by subtraction. If a cargo shapeshifts mid-voyage, the governance and the paperwork need to shift with it.
And that perfectly sets up the next stage of the master program, because Chapter 8 continues this specific journey by analyzing how LNG desks actually fail in the real world, not at isolated single-point events, but as deeply interconnected operational chains, exploring why the steep cost of physical intervention means prevention must absolutely dominate detection.
I am incredibly eager to get into those chain failures. But before we wrap up today's analysis, if we take a step back from the LNG-specific mechanics, I want you to think about this broader concept of exposure by subtraction, the act of quietly removing a safeguard, taking your hands off the steering wheel, and requiring no formal permission to do so. It creates massive invisible risk on a global trading desk. But where else in your own life or your own business architecture are you making high-stakes decisions simply by choosing not to act? By letting a financial hedge drop or letting an operational boundary quietly slide? And more importantly, is anyone aggregating that leakage? Are you watching the big red alarms, or are you actually checking the bilge for the slow leak? Thank you for joining us on this deep dive into the LNG Master Program. Keep questioning the thresholds you rely on, and we will catch you on the next one.
So imagine looking at a $103.7 million loss on your trading desk. Just the money's just gone.
Right. Just evaporated.
Exactly. And now, imagine investigating that crater only to find out that before the disaster, not a single risk alarm went off.
Yeah, that's the scary part.
I mean, the market didn't suddenly crash. Your multi-million-dollar value at risk limit never breached.
Not once.
So if you are running an LNG desk right now, that scenario should absolutely terrify you.
Oh, yeah. I mean, that is basically the ultimate nightmare for any risk committee, right?
For sure.
Because we're so conditioned to believe that, massive financial losses require this loud, singular villain, like a catastrophic market shock or something.
Right, like a Lehman Brothers moment.
Exactly. But
Yeah.
on an LNG desk, the most lethal disasters, they're almost always silent.
Well, welcome to this deep dive, and this is tailored specifically for you, whether you're already running an LNG trading desk or, you're an aspiring professional just looking to understand the real mechanics of the market.
Yeah, the actual nuts and bolts.
Exactly. And just to anchor us, We are continuing our journey through the LNG Trading Desk Master Program.
Which is quite the journey.
It is. It's this massive sequence across 9 modules, 120 chapters. We're covering everything from like the physics of liquefaction to enterprise trading and risk management, or ETRM systems, all the way to regulation and desk legacy.
And today, we are stepping into Module 1, Chapter 8, which is titled How LNG Desks Actually Fail.
A very uplifting topic.
Very. But, drawing on decades of consulting at Durga Analytics, where we've built and run desks, traded physical and financial LNG from the U.S. Gulf to Europe and Northeast Asia, I can tell you that failure is widely misunderstood.
Yeah.
So our mission today is to fundamentally rewire how you view trading losses.
Yeah.
We really have to stop looking for the lightning strike, right? And start analyzing the invisible chain of quiet, seemingly cheap decisions that built the lightning rod in the first place.
Right. And to really ground this, we're looking at 2 real-world case studies today. A $20.9 million loss on a U.S. desk, and that staggering $103.7 million loss on an EU desk that we just, talked about.
And the kicker is, neither of them was driven by a price shock.
Which is wild. So let's rethink failure entirely then. You're saying that the catastrophic event, the thing that actually triggers the loss, is essentially a distraction.
It really is. I mean, when a massive loss crystallizes, you ask a desk what went wrong, and they immediately point to the physical event.
The plant went offline, right?
Yeah, or a hurricane delayed a vessel.
Yeah.
But the event is just where the money evaporated. It's almost never where the failure actually occurred in the system.
Okay, that makes me think of installing this state-of-the-art security system in your house, right? But you program it to only check for broken glass, and you completely ignore that the front door was just left wide open.
That's a perfect analogy.
So when you get robbed, blaming the burglar is, technically accurate, but it completely ignores the structural failure that made the burglary so incredibly easy.
That is a much sharper way to look at it.
Yeah.
The burglar is just, physical reality catching up with your structural blind spot.
Right.
Every single LNG desk failure we analyze in this master program, it follows this identical chain. Months before the loss, a decision is made calmly, like zero urgency.
Right, just a normal Tuesday.
Exactly.
Yeah.
And that decision creates a latent vulnerability. Then a second decision happens that leaves that vulnerability completely unmeasured by your systems.
Okay.
And finally, a completely ordinary operational hiccup happens. The combination of those unmeasured conditions turns a standard supply chain issue into a multi-million-dollar crater.
So if asking what went wrong just leads us to point at the burglar, how do we actually diagnose the root cause?
Well, we use the only diagnostic question that actually matters for an LNG desk, which is, what would have had to be true for this event to have cost us nothing?
What would have had to be true for this to cost us nothing?
Okay.
Right.
When you force a desk to answer that, you isolate the specific link in the failure chain. And almost without fail, you'll find a decision made months earlier that would have been, honestly, incredibly cheap to fix.
All right, let's put this to the test with the U.S. desk case study. The theme here from the outline is incomplete decomposition. So walk us through the mechanics of this specific chain.
Sure. Let's build a scenario. The U.S. desk holds 2 cargoes, and they've sold these forward delivered ex-ship, or DES, at, let's say, $9.80.
Okay, just to pause there and clarify the acronym for you listening. DES means the desk holds a transportation risk, right? They are physically on the hook to secure the vessel and deliver that gas to the buyer's port.
Spot on. They own that delivery obligation.
Yeah.
But to source the gas in the first place, the desk is relying on a supply contract with an asymmetric relief clause.
Asymmetric relief, so it only goes one way.
Exactly. This means if the liquefaction plant fails, the supplier is legally excused from delivering the gas to the desk.
Oh.
But crucially, the desk's forward DES sail to their buyer. That contract does not excuse the desk if the plant goes down.
Okay, I see the trap. The plant declares force majeure, the supplier exercises their asymmetric relief, and they just walk away cleanly.
Yep.
Clean break, but the desk is now short 2 cargoes they are legally required to deliver, and they have literally no gas.
Zero gas.
So they are forced onto the spot market to buy replacement cargoes under extreme duress, which leads to this realized loss of, $20,986,442.40.
That's the chain right there. So if you run a standard corporate postmortem on this $21 million loss, What is management's conclusion?
Well, I mean, looking at the setup, management is going to point straight at the supply contract. That's link one, right?
Yep.
Like someone signed a sale agreement without negotiating a matching relief clause. So they'll fire the originating lawyer, mandate new contract templates, and just call it a day.
And that response is entirely useless.
Really? But it sounds so proactive.
It feels proactive because, contracts are tangible. You can point to the bad clause. But let's look at the economics of that intervention. Let's say you try to fix link one. Negotiating a matching relief clause or even pricing out its absence costs roughly $112,000 in legal and origination time.
Okay, so it's a bit pricey, but compared to $21 million.
Right. But more importantly, it requires an external dependency. You need your counterparty to willingly surrender a massive commercial advantage.
Oh, true. They might just say no.
Exactly. You could spend the $112,000, fight for the clause for months, and just lose the negotiation.
So you can't guarantee a fix at link one because you literally don't control the board.
Precisely. You don't control the counterparty. Most effective, cheapest intervention is actually link two.
Okay, which is what?
The failure wasn't just signing the contract, it was how the desk recorded that exposure in their enterprise trading and risk management system, their ETRM. They logged this position purely as price risk.
Wait, explain what that actually looks like on a screen for an analyst. Like when you say they didn't decompose the risk, what did they physically fail to do?
So when the trade was entered into the ETRM system, the analysts saw that the purchase price and the sale price were locked in. The margin looked safe.
Right. They bought for X, sold for Y, locked in the profit.
Yeah. So they just checked a box for the price hedge. What they failed to do was decompose that single entry into three distinct components: price risk, volume risk, and delivery optionality.
I see.
They didn't model the scenario where the volume drops to zero, but the delivery obligation remains at 100%.
Because of the asymmetric relief clause.
Exactly.
So the system thought everything was perfectly balanced, just completely blind to the legal mismatch. What would it have cost to actually fix that at link 2?
Well, to correctly decompose that risk profile, a competent analyst needs to spend maybe about a week building out the logic in the system.
Yeah.
And an analyst week costs roughly $15,000.
Wow. The math here is wild. Fixing the analytical blind spot at link 2 costs $15,000. You don't need board approval for that. You don't need a counterparty to agree to surrender anything. You just need someone to sit down and do the math accurately in the system.
And look at the leverage on that $15,000. It is 7.5 times cheaper than trying to fight the counterparty over the contract at link 1.
Yeah.
But more importantly, it is an astonishing 1,399 times cheaper than swallowing the $20.9 million loss at the end of the chain.
Okay, but let me push back a little on the timeline here. Let's say the desk completely misses link 2. The risk isn't decomposed, fine. Why does the loss balloon to nearly $21 million? Like, why does detection at the end of the chain cost so much more than prevention?
Because of market mechanics at link 4. By the time the desk detects the failure, which is, when the plant actually goes offline, they have lost all optionality.
Right. The clock is ticking.
Exactly. They have days, maybe hours, to find a replacement cargo to fulfill that DES obligation.
Yeah.
And the spot market, it instantly senses that desperation.
Blood in the water.
Oh, absolutely. You aren't just buying gas at that point. You are buying an immediate physical rescue. And the market will absolutely gouge you on the premium. You're paying for emergency shipping, prompt loading, and just the seller's sheer knowledge that you have literally no other choice.
That makes total sense.
Yeah.
The $21 million isn't just the cost of gas, it's the cost of desperation.
Exactly.
Okay, now let's pivot. We know from the master program that U.S. desks and EU desks are, fundamentally different animals.
Very different.
U.S. desks generally operate on acquiring permissions. You check the regulatory and contractual boxes once per transaction, log it in the ETRM, and you're mostly good. But an EU desk operates on demonstrations.
Right, physical demonstrations.
Right, they have to constantly prove their physical capacity for every single cargo. So a paperwork trick wouldn't take down an EU desk in the same way, right?
The underlying structure of the failure is identical, but you're absolutely right. The mechanism is completely physical here. An EU desk fails through something we call unexercisable optionality.
Unexercisable optionality, okay?
Let's examine their chain.
Set the board for us.
Okay, so the EU desk holds a long-term position that is free on board, or FOB.
And FOB means the seller just provides the gas at the loading port, but the EU desk has to provide the ship and figure out where to actually take it.
Correct. The desk controls the vessel. Now, this specific contract is oil indexed. Let's say we price it at 12.5% of Brent crude plus a 60-cent premium.
Okay.
And the key feature here is that the contract grants the desk massive destination flexibility across a 20-cargo annual program. On paper, they have the right to send this gas into Europe or route it all the way to Northeast Asia.
I mean, that sounds like a highly valuable option to hold.
It is, until the market shifts. That's link 3. Crude oil rallies aggressively, but European gas prices stay flat.
Oh, boy.
Yeah. Because the contract is indexed to oil, the desk's gas becomes incredibly expensive to buy. If they dump those expensive cargoes into the flat European market, they guarantee a massive loss.
But they have destination flexibility, so the Asian arbitrage must look fantastic on their screens, right?
It looks brilliant. The desk looks at the ETRM system, they see their contractual right, and they decide, hey, let's route the entire 20-cargo program to Asia to capture that margin.
Makes sense on paper.
But then comes link 4. The physical reality. The Asian route is substantially longer. When they finally go to actually schedule the deliveries, they discover their fleet is tied up in dry dock maintenance and prior commitments.
Oh, no.
Yeah, the shipping capacity simply isn't there to make the longer voyage for all 20 cargoes.
So going back to an earlier concept we talked about, it's like paying a premium for a global gym membership that lets you visit any location on Earth, right?
Right.
You feel great looking at the brochure, but you don't own a car, the buses don't run, and flights are grounded. The paper option is entirely worthless because the physical world doesn't supply a mechanism for you to actually exercise it.
That analogy perfectly captures the core lesson here. A contractual right that you cannot physically execute is not an option, period. Because the shipping wasn't available, the desk is trapped. They are forced to dump all 20 cargoes into Europe anyway, swallowing a finalized loss of $5,189,139.40 per cargo.
Per cargo.
Per cargo. Across the annual program, that is a $103.7 million disaster.
Over $100 million burned because a spreadsheet didn't talk to a boat.
Basically, yeah.
So, applying our diagnostic question again, what is the cheap intervention here? Obviously, they can't change the global shipping market for $15,000.
No, they can't.
Yeah.
But the cheapest link to break is, once again, link 2, the analytical failure.
Okay.
The desk valued their destination flexibility in their models without ever testing it against the physical constraints of their actual fleet. The intervention here is just a routine fleet availability study. Before you assign value to that option to ETRM, you verify the steel on the water.
But wait, I have to ask, how does a desk of this size just ignore their own ships?
Because trading and scheduling often sit in silos. It happens all the time. The quant values the option based purely on price spreads. A proper fleet study means pulling the dry dock schedules, calculating boil-off rates for the longer voyage, and matching vessel availability to the actual loading window.
So it's forcing the financial guys to talk to the physical guys?
Exactly. It requires forcing the financial model to obey physical physics.
And what does a proper fleet availability study cost to run?
Roughly $40,000 in operational time and software modeling.
Let's connect those numbers then. The full swing across that 20-cargo program, like the difference between successfully routing to Asia versus being trapped in Europe, was over $169 million.
Massive swing.
So spending $40,000 on a physical capability study to realize your paper rights are fiction, the return on investment there is just staggering.
It returns over 4,200 times its cost. And it does this not by magically predicting the crude oil rally, but simply by tethering a financial assumption to operational reality. The lesson is, never value a right on paper without verifying the capacity to execute it.
This brings us to what I found to be, honestly, the most chilling part of this entire analysis. We just walked through a $21 million failure and a $104 million failure.
Yep.
And according to the source data, both of these desks utilized incredibly sophisticated risk models. The reported value at risk, the VAR limit for both desks, was set at $12 million.
That's right.
The U.S. desk lost 1.75 times its VAR. The EU desk lost 8.65 times its VAR limit. And neither of them breached a single limit before the money was just gone. If I'm sitting on the risk committee reviewing these smoking craters, my immediate conclusion is that the VAR models are completely broken. Like, the math failed us.
Oh, and that is the instinct of every executive the day after a crash.
Right.
But the uncomfortable truth is that the model didn't fail. The math was flawless. The problem is that the model was measuring the wrong universe.
Unpack that. What universe is VAR actually measuring, then?
Value at risk measures the distribution of price moves on marked positions over a set holding period. It looks at historical volatility and correlation. But look at what actually killed these two desks. Neither loss was triggered by a price shock.
Right. The U.S. desk died because a lawyer negotiated an asymmetric relief clause and a plant failed.
Yeah.
And the EU desk died because a boat couldn't physically make a longer voyage.
Exactly. The U.S. desk was perfectly hedged on price. If you looked at the VAR dashboard the morning the liquefaction plant went offline, it would have told you the portfolio was completely safe.
Oh.
Because VAR is entirely blind to structural non-price events, it only sees the positions that the system holds. It has zero visibility into exposures for which the ETRM system only has like a basic text field.
Okay, but we also hear a lot about standard MMB2 materiality controls, right? Like counting the volume of energy to ensure the desk isn't overexposed. Those fail too.
Well, MMB2 controls just count millions of British thermal units. They measure volume. They see that you bought 1,000,000 MMBTUS and sold 1,000,000 MMBTUS, so they report that you are flat.
Okay, so they're blind too.
Exactly. An MMB2 control cannot read a legal contract to realize that your supply can be canceled, but your delivery obligation cannot.
So, practically speaking, what does a desk do? I mean, you can't just throw out value at risk. It's a fundamental regulatory requirement.
No, you definitely keep VAR,
Yeah.
but you must recognize its absolute limits. Alongside VAR, a modern desk has to implement two specific non-model measures that reflect structural risk.
Okay, what are they?
First, the cost to reach flat. This means modeling the exact cost of unwinding your physical obligations in a distressed market.
Okay.
And second, an itemized list of exposures for which no financial instrument exists.
Meaning risks you can't just go and buy a hedge for on an exchange.
Exactly. If the U.S. desk maintained an itemized list of non-instrument exposures, asymmetric force majeure risk would have been sitting right there in plain text, completely independent of the VAR calculation.
Oh, I see.
It forces the risk committee to look at the structural vulnerabilities, not just the price volatility.
Which perfectly transitions into the psychology of how management tries to actually stop these failures. We established that intervening at the prevention stage, like that $15,000 analyst correctly decomposing risk, is incredibly cheap.
Very cheap.
But if the desk misses that and catches the error at the detection stage, like realizing you're short gas while the plant is offline, it costs millions.
Right. The data shows a massive prevention detection ratio. We know that detecting the U.S. failure at Link 4 costs over $10.4 million in spot market differentials.
Yeah.
But intervening at Link 2 for prevention costs $15,000. So relying on a detection capability is roughly 699 times more expensive than relying on a prevention capability.
But wait, if management knows this math even implicitly, why do desks still throw all their capital at detection? Like, a desk will happily approve a $180,000 budget to hire a senior risk quant to build a glowing new detection dashboard, right?
All day long.
But they won't dedicate $15,000 of time to simply verify the contracts are modeled correctly. Why the disconnect?
It comes down to demonstrability. We fund what we can show off.
Ah.
Detection is highly visible. A daily risk pack, a 50-page VAR report, a real-time glowing dashboard that is tangible evidence of control. A risk manager can slide that across the boardroom table and prove they're doing their job.
And prevention.
Prevention is entirely invisible. Imagine an analyst quietly sitting at their desk in March, noticing a volume mismatch in the ETRM, and quietly correcting the risk decomposition.
Yeah.
Because of that $15,000 action, a crisis never happens in November. But what does that produce? It doesn't generate a flashy report. It generates silence.
And it is incredibly hard to get corporate funding to produce silence.
Exactly.
So how does a desk ever reward or even track that invisible work? Are they just taking the analyst's word for it that they saved the company millions?
To solve this, elite desks implement something called a near-miss register.
A near-miss register.
Right. The problem with learning from $100 million realized losses is that they're rare, and by the time they happen, the people who made the initial cheap mistakes have usually left the firm anyway. But a desk experiences dozens of failure chains that stopped before they became expensive.
So they catalog the bullets they dodged.
Precisely. In the near-miss register, you track what anomaly was noticed, at which link in the chain it was caught, what the financial impact would have been if it ran to completion, and most importantly, you track how it was caught.
Yeah.
Did a formal control catch it, or did a person?
And when management actually looks at that register, what uncomfortable truth do they usually find?
They find that the vast majority of their multi-million-dollar near misses were not caught by their expensive ETRM systems, their MMB2 controls, or their VAR limits. They were caught because an individual just happened to notice something felt off. The honest answer to what saved us is almost always a person.
So let's pull all of this together for you listening. We've completely reframed how LNG desks fail today. They are never sudden events. They are chains of calm, cheap decisions that leave structural vulnerabilities unmeasured.
Right.
We explored the specific ways these desks fail, like incomplete decomposition on the U.S. desk, where legal mismatch wasn't modeled, and unexercisable optionality on the EU desk, where paper rights ignored physical fleet constraints.
Couldn't have summarized it better.
And we learned that these fatal flaws are completely invisible to standard VAR models and volume controls. So the mandate for any risk professional is to hunt down that analytical, cheap second link to fix, rather than trying to cure the symptom at the end of the chain.
Which leaves us with a final, highly provocative reality to consider. If your desk implements a near-miss register, and you discover that your multi-million-dollar disasters are routinely being avoided simply because Sarah from operations has a fantastic eye for mismatched schedules,
Right.
what exactly happens to your desk's survival rate on the day Sarah takes a higher-paying job at a rival firm?
Oof, the lightning rod just leaves the building.
If a person is the only thing catching the errors, your detection capability isn't a system at all. It is undocumented, unrepeatable contextual knowledge wrapped in a human being. And that makes Sarah your single point of failure. The quiet catastrophe is just waiting for her to log off.
It's a really sobering realization that your multi-million-dollar risk apparatus might just be entirely reliant on human habit. But don't worry, we aren't leaving you hanging there. In Chapter 9, we're going to dive straight into the machinery of how to handle that exact human element. We'll be exploring moving authority, dealing with escalation, and building override governance to ensure your desk survives even when the people change. So thank you so much for joining us on this deep dive, and we'll see you in the next chapter.
So usually when we talk about a medical diagnosis, there's, this expectation of precision.
Right, like a clear answer.
Exactly. You break your arm, the x-ray shows a jagged white line, and the doctor just points at it and says, there it is. That's the problem.
Easy to fix.
Right. But when you step onto an LNG trading floor during a massive market meltdown, I mean, that x-ray machine is completely useless.
Yeah, it really is.
You are looking at a landscape that is just murky, it's chaotic, and it's moving incredibly fast. So, welcome back to the deep dive, everyone. We are really thrilled to have you with us as we continue moving through the LNG Trading Desk Master Program.
A very long journey, but a necessary one.
For sure. And for those of you actively working the desks or, aiming to run one eventually, this is a 9-module, 120-chapter journey. We started with the actual physical realities of liquefaction, and we are working our way all the way up to full desk leadership.
Step by step.
Exactly. And right now, we are squarely in Module 1, running an LNG trading desk. And specifically, we're digging into Chapter 9 today, which focuses on authority, overrides, and escalation rights.
And this is really where the theoretical framework just kind of collides with human panic.
No, absolutely.
Think back to our discussion in Chapter 4, right? We established this foundational rule that on a trading desk, there is exactly one decide.
Right. The person who actually pulls the trigger.
Exactly. And we also quantified the sheer financial bleed of indecision. I mean, we showed that delaying action costs the desk over $90,000 an hour.
$90,175.65 to be exact.
Yeah, real money. And then in Chapter 8, we looked at the anatomy of failure. Because desks don't just explode out of nowhere, right? They unravel through these interconnected chains of bad decisions.
Like a domino effect.
Totally. So our mission today, pulling from, my decades of consulting at Durga Analytics, is to hand you the actual mechanical blueprints to break those failure chains before they wipe out an entire year's worth of profit.
And that sets the stakes perfectly, I think. To ground this in reality for everyone listening, I want to pitch a scenario right now that we are going to autopsy a bit later on.
Oh, the $41 million question.
That's the one. How does an LNG desk operating with a beautifully documented, fully audited escalation policy still manage to lose over $41 million on a single position?
It sounds impossible on paper.
Right. I mean, they didn't go rogue. They followed every single documented rule. They checked every compliance box. And the ship still just went straight to the bottom of the ocean.
Yeah, and it's really the ultimate paradox of risk management, because when we audit these catastrophic losses, the root cause is almost never a secret rogue trader hiding tickets in a drawer somewhere.
It's not like the movies.
Not at all. The fatal flaw is structural. Desks fundamentally confuse moving information with moving authority. They build these policies that, feel like action, but they're actually just reporting mechanisms.
Okay, wait. let me just challenge that for a second.
Yeah.
If a trader is holding a position that starts hemorrhaging cash, right, and they fire off an email to the desk head saying, hey, I'm down millions, the market is turning against me, I mean, isn't that escalating the problem?
Well,
Because they are literally raising their hand and saying there's a fire.
they are raising their hand, yeah, absolutely. But they're not relinquishing the steering wheel. What you just described is notification, not escalation.
Oh, I see.
Information moved, right, from the trader screen to the desk head's inbox. But here's the acid test every professional listening really needs to apply to their own desk's policy right now. After that step, after that email is sent, who has the authority to commit the desk?
Who actually holds that decide?
Exactly. Who holds the decide if the trader is bleeding cash, but they are still the exact same person choosing whether to hold the position, fold it, or average down? Authority hasn't moved at all.
Okay, so it sounds like it's like having a fire alarm that just sends a text message to the building manager instead of, actually triggering the sprinkler system.
Yes.
Like the text is informative, but it doesn't do a single thing to extinguish the actual flames.
And even worse, it leaves the person who accidentally started the fire solely in charge of figuring out how to put it out.
Wow, yeah.
True escalation means authority violently shifts. A completely different person must now make the decision. If your corporate policy outlines a 4-level escalation ladder, but the trader retains control of the position for the first 3 levels.
You don't really have a ladder.
You don't actually have a 4-level ladder. You have a notification system that basically just exists to generate a massive paper trail to protect management.
Just covering their bases.
Right, with only one real level of escalation at the very, very end. And by the time you hit that final level, the failure chain is already embedded in concrete.
Which brings up a huge operational problem. Because most standard corporate policies I read, they say something incredibly vague, like escalate if the P&L loss exceeds $10 million.
Which sounds very responsible on paper.
It does. On paper, it sounds great. But why is tying an escalation trigger to a mark-to-market loss functionally useless in real time?
Mostly because nobody on a trading floor watches mark-to-market losses on a continuous tick-by-tick basis.
Oh, right.
A loss threshold is expressed in a unit that you really only observe when the system runs a valuation cycle.
Like end of day.
Right, end of day, or maybe a midday flash report if you're lucky. Traders aren't just staring at P&L reports all afternoon. They are staring at market prices.
Right. They're watching the screen print. They're watching TTF or Henry Hub fluctuate in real time.
Which means if your safety mechanism is tied to a, say, $9 million loss, that trigger is practically invisible in the heat of the moment. You're relying on a control that fires when a back office report is generated, rather than a control that fires when the actual market moves.
That's a huge disconnect.
It is. So the fix is remarkably simple, but honestly rarely done. You must convert that loss ladder into hard trigger prices once, in advance, so those exact numbers sit permanently on the trader's screen.
Let's actually walk through the math from the chapter to make this super concrete for the listeners.
Sure.
Let's say a desk holds a position of 6 live cargoes against the European TTF benchmark, okay? And their entry price is $9.80.
Okay, $9.80.
Yep. And the delivered volume for those 6 cargoes is roughly 22.48 million MMB2. So
Yeah.
if the corporate policy mandates a notification at a $9 million mark-to-market loss, how do we translate that into a tool the trader can actually use?
Well, we just do the division up front. You take that $9 million loss limit and you divide it by your exposure, which you said is the 22.48 million MMB2.
Right.
That calculation gives you an adverse price move of just over 40 cents. It's 0.4003 to be exact.
Got it. So we just subtract that 40 cents from our original entry price of $9.80.
Yeah.
That puts our new trigger price at, well, basically $9.40, 9.3997.
And just like that, you have removed all the ambiguity. Instead of waiting for a midday P&L run to realize they breached a limit, the desk knows that the absolute second the TTF prints at 9.3997, the notification level fires automatically. The math is already done.
That is so much cleaner.
Mm-hmm.
And applying that same logic across the ladder, the chapter shows that if the actual escalation level where authority is finally supposed to move to the desk head is set at a $15 million loss, that translates to a TTF price of roughly $9.13.
Right, 9.1329.
Yep. And the final tier, the reduction level at a $22 million loss, equates to $8.82, or 8.8216. So we are left with 3 hard numbers.
Yeah.
9.3997, 9.1329, and 8.8216. A trader can actually internalize those on their screen.
They can internalize them, and more importantly, they cannot debate them.
Yeah, yeah.
This targets a massive behavioral flaw in how risk policies are written. Desks love what we call discretionary wording.
Like,
A policy will say something like, escalate if the position becomes concerning, or reduce the position if liquidity deteriorates.
but I mean, I could play devil's advocate here. Don't we hire expensive, highly experienced professionals precisely for their discretion?
Sure.
Shouldn't we trust them to determine what concerning means?
We hire them for their discretion when building a thesis, absolutely. But we cannot rely on their discretion to dismantle that same thesis.
That's a great point.
Every single word in a discretionary policy requires subjective judgment, and you are demanding that judgment from the individual who has the absolute strongest psychological incentive to view the situation through rose-colored glasses, right at the exact moment their ego is bruised and they are terrified of admitting defeat.
So the alternative is conditional wording.
Yes.
Instead of saying reduce if liquidity deteriorates, the rule needs to say reduce when quoted size at the touch falls below 40,000 MB2 for 2 consecutive sessions.
That removes the human element entirely. It becomes a fact of physics, really. It fires identically whether you are the star trader generating half the desk's revenue or just a junior analyst on their very first rotation. Because it's conditional, invoking it isn't a personal failure. It is simply the environment changing and the rule executing itself.
That sets up the most aggressive control in the chapter, the reduction level. Using our previous example, TTF has plummeted to $8.82. We've hit the final tier. The policy dictates that authority must violently leave the position holder and transfer entirely to the risk committee.
Right.
Now, taking the keys away from someone who built the trade. I mean, it's like taking the car keys away from someone who doesn't realize they're too exhausted to drive. That is a massive structural shift.
It is, and it causes a lot of friction. But you have to view this completely dispassionately. Taking the keys away is not an insult to the trader's character or their historical performance. It is just an unavoidable structural reality.
Because they're compromised.
Exactly. When a trader is tasked with deciding whether to reduce their own bleeding position, they aren't making a market call anymore. They are deciding whether to convert a painful unrealized loss into a permanent realized loss.
And their brain will invent any narrative to avoid crossing that bridge.
Oh, yeah.
They'll tell the risk team, the macro thesis is completely intact. This is just a temporary liquidity gap.
Oh.
Or my favorite, averaging down here is totally normal.
Yeah, averaging is standard market practice. The master program really hammers this reality home. Those arguments are universally available regardless of the underlying facts.
Right.
Traders can and will deploy them every single time a position goes south. Because those justifications are always present, they're completely useless as risk indicators.
That makes total sense.
The decider is structurally compromised by their own exposure. Moving the authority to a neutral party costs the desk absolutely nothing when the position is healthy, but it is the only mechanism that actually arrests a failure chain when it isn't.
But, simply moving the authority isn't enough, because human nature still infects the risk committee too.
Oh, absolutely.
The chapter emphasizes a best practice called the minimum reduction rule. Because if the risk committee takes over, looks at the market, and just issues a generic instruction to reduce the position, the desk will inevitably sabotage it, won't they?
If you do not specify a hard mathematical minimum in advance, the desk will execute a malicious compliance maneuver.
Malicious compliance.
Yes, they will sell one single lot. They will reduce the position by the most microscopic fraction theoretically possible just to satisfy the instruction, while keeping their precious exposure perfectly intact.
And the knock-on effect is that the very next morning, the market drops another cent, the exact same trigger fires, and you are back in the boardroom having the exact same argument.
Which is why the reduction fraction must be pre-agreed in peacetime. The rule must state, upon hitting reduction, we automatically cut the position by 1/3. It transforms a highly emotional negotiation into an automated instruction.
Okay, let's shift gears slightly. We've established these ironclad rules, but, trading floors exist in a messy reality.
They do.
Sometimes the desk absolutely needs an exception to operate. They need an override. But there's a huge blind spot here that seems to completely baffle governance committees.
It is arguably the most dangerous illusion in corporate risk management. When governance committees review overrides, which, are just time-bound permissions to operate outside of stated control, they obsess over the count.
just the number of them.
Right. They look at volume. Let's look at a desk's data.
Yeah.
In month 1, they granted 3 overrides. By month 12, they granted 27 overrides.
Well, if I'm sitting on that governance committee, I see an 800% increase in exceptions. I'm going to assume desk discipline has completely gone off the rails.
And you would be focused on the entirely wrong metric.
Really?
Yes. The count ignores the hidden multiplier, which is duration. Let's dig deeper into the numbers. In month 1, those 3 overrides had a median duration of 5 days. That equals 15 override days of risk exposure.
Okay, so the desk operated outside the guardrails for a total of 15 days. That feels manageable.
But look at month 12. Those 27 overrides weren't closed quickly. They were left open, and the median duration stretched to 74 days.
Oh, wow.
If you multiply 27 by 74, you get 1,998 override days. Yes, the count grew 800%. But the actual physical risk exposure to the desk grew 133 times.
That is staggering. A 133x increase in invisible risk because nobody is tracking how long these exceptions stay alive.
Exactly.
The approval happens, the email gets buried, and the risk just compounds in the background.
Yeah.
So how do you force that risk back into the light?
The governance mechanism must enforce a hard expiry date the absolute second the override is granted. And I do not mean a review date.
You see people just ignore those.
Review dates are a corporate fiction. Nobody attends them, and they just get pushed down the calendar indefinitely. I mean a hard, system-enforced expiry date where the override automatically dies and the underlying limit violently crashes back into place.
So if the desk genuinely still needs that exception, they have to actively fight to renew it. They have to present a business case all over again.
Exactly that. It forces the risk into visibility. And this leads to a diagnostic heuristic I use constantly. If a desk comes to you and renews the same override 3 consecutive times, it is no longer an override.
It's just the new business model.
It is the new normal. A third renewal is a massive red flag screaming that your underlying limit is wrong. Your framework is calibrated for a business you are no longer running.
So you shouldn't just keep overriding it.
Right. Don't keep suspending the rule. Force the desk to go through formal governance, justify the new risk appetite, and literally change the limit to match reality.
Now, we need to view all of this through the dual lenses the master program always emphasizes, right? The EU desk versus the US desk. Because a rule that works in Houston might get you indicted in London.
Very true.
How do these control structures diverge across the Atlantic?
The structural contrast is profound, and honestly, it runs through every single chapter of this program. A U.S. desk is primarily in the business of acquiring permissions.
Permissions.
Right. They secure their authorizations once, usually up front, and then they simply check those permissions per transaction. But an EU desk operates in a completely different reality. They are in the business of acquiring demonstrations.
Demonstrations. Meaning they have to prove it continuously.
Yes, they have to continuously reproduce their compliance for every single cargo.
Which introduces this vital concept of gates versus overrides that the chapter gets into. If an override is permission to accept a cost, what constitutes a gate?
A gate has no cost to accept because it is a hard legal or physical barrier. It can never be overridden, no matter how much money is on the line.
Give me an example for the U.S. desk.
For a U.S. desk, you can never override a destination that falls outside the export authorization granted under Section 3 of the Natural Gas Act. You can never bypass sanctions screening of a counterparty, a vessel, its owner, or its flag.
Because that's the law.
It's the law. If a failure chain breaches a gate in the U.S., external escalation immediately involves the CFTC and EFRS, both of which possess massive anti-manipulation authority.
And the EU desk faces a completely different set of immovable barriers.
They do. On the EU desk, you cannot override an import if you lack a verified country of production. You cannot override terminal capacity commitments because, well, the infrastructure is physically constrained.
You can't just invent more space in a terminal.
Exactly. And if an EU desk breaches a gate, external escalation triggers Erminoff's obligations. That brings catastrophic scrutiny regarding market benchmarks and mandatory disclosures on your own physical assets. The regulators don't care about your internal P&L, they care about market integrity.
There is a terrifying warning in the chapter regarding how ETRM systems, the actual software vendors sell to trading desks, handle these gates. What is the design flaw we really need to watch out for?
Out of the box, generic ETRM software often treats a gate the exact same way it treats a soft credit limit. It provides a drop-down menu with an override option. Yeah, if your system administrators do not actively configure that software to lock down those fields, You are basically sitting on a time bomb. Because if the field can be selected, I guarantee you a junior scheduler under immense pressure at 3 a.m. will click override on a sanctions check just to get a cargo moving.
And when the regulators eventually kick the door in telling them, well, the system let them do it, but they shouldn't have, is obviously not going to fly.
Not at all.
If it's a legal gate, the software shouldn't even present the option to bypass it.
It must be hard-coded out of existence. Now let's tie all this machinery together by revisiting the autopsy of that $41 million loss you mentioned at the start.
Yes. How did a desk check every box and still just drive the car off the cliff? Let's walk through the timeline using the chapter's standard cargo convention.
Okay, so Session 0, the trade is captured. By Session 3, the market has turned aggressively against them. The TTF benchmark hits a notification trigger at 9.38. Risk management is informed, but the trader retains control of the position.
So right there, failure number 1. Information moved, but authority did not.
Correct. Session 6 arrives, and the market just keeps bleeding. TTF hits the formal escalation trigger at 9.1N. The desk head reviews the situation, but they write a memo allowing the trader to hold the position. The audit trail shows they escalated, but the structural reality is that authority never left the compromised position holder.
I mean, they are in absolute free fall, but they are writing incredibly detailed memos about the wind resistance.
Exactly. Then we hit Session 9. TTF drops to 8.79. This is the absolute reduction level. The policy clearly states the risk committee must take over. Authority is finally supposed to move.
Finally.
But the policy includes a quorum requirement for the committee, and because it's a Friday or, people are traveling, they cannot physically gather a quorum until Session 11.
The quorum trap. I read this and it blew my mind. It is literally like requiring a committee vote to deploy your parachute after you've jumped out of the plane.
It is a devastating structural flaw. A quorum requirement practically guarantees that your safety mechanism will fail at the exact moment. Conditions are most chaotic weekends, holidays, massive volatile market events.
The worst times.
Always. That 2-session delay, just waiting for senior management to dial into a conference call, saw the market drop another 45 cents. On their specific volume, that administrative delay alone cost the desk $7,195,351.
$7 million incinerated while waiting for calendar invites to sync. That is painful. But they finally meet in Session 11, right? TTF is now down to 8.34. The committee flexes its muscle and forces a reduction. So they fixed it, right?
No, they executed the malicious compliance we warned about earlier. Because no minimum reduction fraction was pre-agreed in the policy, the committee reduced the position by just 20%.
Meaning they satisfied the procedural instruction, but left 80% of a bleeding toxic exposure actively dying on the books.
And by Session 14, the pain crossed the threshold of endurance. The position was fully liquidated in an absolute panic at a massive realized loss of $41.3 million.
It is a tragedy of perfectly followed, terrible rules.
Yes.
But the remedies outlined in the program are shockingly simple. You don't need a multi-million-dollar software upgrade. You literally just need to add 3 sentences to your governance document.
3 sentences change the destiny of that desk. Sentence 1, authority moves at every escalation level, immediately.
Okay.
Sentence 2, a standing deputy system replaces quorum requirements, guaranteeing the mechanism never fails to convene.
No more waiting for Friday afternoon calls.
Exactly. And sentence 3, a minimum reduction fraction is pre-agreed and mandatory upon execution. If those 3 sentences existed, that $41 million loss would have been contained at a fraction of the cost.
So, to synthesize this for everyone listening, right? Start measuring your overrides in days of exposure, not just counts, because duration is the silent killer. Take your vague mark-to-market loss limits and translate them into hard trigger prices so your traders can actually see them hitting the screen. Ensure that escalation means authority violently changes hands rather than just generating a scary email. And scrub the quorum trap from your crisis response entirely.
Absolutely. And I'll leave you with one final thought to mull over before you log into your systems tomorrow morning. Pull up your desk's escalation policy.
Oh, this is good.
Read it objectively, like a mechanic looking at an engine. Ask yourself, is this document genuinely engineered to arrest a catastrophic loss in real time? Or is it merely designed to create a beautiful paper trail so management can prove they were kept informed while the ship sank?
A terrifying but absolutely necessary question. And that wraps up our deep dive into Chapter 9. But as you know, the master program journey continues. Now that we understand how a desk controls its decisions and breaks these failure chains, what happens when we examine the financial fallout?
The fun part.
Right. In Chapter 10, we are going to pivot to what the desk actually reports. We'll explore the senior view of LNG desk P&L. We'll dig into why the accounting number and the economic number constantly diverge and uncover what that unexplained residual is actually screaming at you about your portfolio. Until then, keep your triggers conditional, and we'll see you next time.
You know that feeling when you look at a final spreadsheet and the number at the very bottom is printed in bold black ink and it just, well, it tells you exactly what you want to hear.
Oh, absolutely.
Okay.
On a trading floor, that moment is just magnetic.
Right. So imagine your desk just cleared a $1.6 million profit on a single U.S. desk cargo. The trade is done. The screen is flashing green. You know, high fives all around. You point at the screen and just say, there it is. We made money.
And it is incredibly comforting to have that single definitive number to point to. I mean, we are psychologically wired to want complex physical operations neatly categorized into one bottom-line figure.
Yeah, humans love simplicity.
Exactly. But if a senior reviewer on an LNG trading desk looks at that $1.6 million success story and just stops there, they haven't actually learned anything about how their business is running.
Which is, I mean, that's terrifying when you think about the capital at stake. Because hiding inside that $1.6 million win is, well, it's a dose.
A very expensive ghost.
Yeah, there is over $150,000 buried in that profit that absolutely nobody on the desk can account for. And that is exactly what we are uncovering today. So welcome to the deep dive.
Glad to be here for this one.
If you've been following our journey through the LNG Trading Desk Master Program, you know we've already covered the basics of running a desk. But today, we are zooming into Module 01, Chapter 10. And that is the senior view of LNG desk P&L.
And we are tackling this from a very specific practical perspective, drawing on decades of experience from Durga Analytics, trading physical and financial LNG across the U.S., Gulf, Europe, and Asia.
Right, the real hands-on stuff.
Exactly. We're looking at this through the eyes of an LNG trading and risk management consultant. So we aren't just talking about abstract theory here. This is about real markets, verified arithmetic, and building a durable desk that can actually survive.
Just a quick reminder for anyone jumping in, this whole program is a sequenced journey, 9 modules, 120 chapters in total.
Yeah, from Module 00 on the absolute basics, right through market structure, senior playbooks, valuation, risk, execution, ETRM systems, regulation, all the way up to Module 09, which is desk leadership and legacy.
It's massive, and today we are right in the thick of it. So let's get into the muddy waters of that profit and loss report, the P&L.
Let's do it.
When you hand a desk head a single P&L number to tell them how their team did, you are essentially forcing that one poor number to answer 3 completely different questions.
3 entirely different questions that often point in completely opposite directions, yeah.
And I imagine the most obvious one is the accounting result, right? Like the official ledger that dictates what people get paid their bonuses on.
Oh, that is the one that gets all the attention, certainly. I mean, what will the firm actually report this period under the applicable accounting treatment? Gets heavily managed because, well, compensation is directly tied to it.
Natural.
But before you even look at the accounting result, you have a completely different reality, which is economic effectiveness.
Meaning, did our chosen positions actually make money on their own terms, regardless of what calendar month we're in?
Exactly that. Marking the true economic result across all legs of a trade, and that includes the unsettled ones. But because this true economic view doesn't cleanly tie back to the official accounting ledger at the end of a quarter, it often just gets ignored in standard reporting.
Just swept under the rug.
Pretty much. And then you have the third question, which might actually be the most critical of all: liquidity adequacy.
Let me guess. Do we actually have the cash to survive until the trade finishes?
That is the survival question, yes.
Yeah.
Can we fund what we hold through the worst possible path to settlement?
Wow.
I mean, this isn't really a P&L question in the traditional sense, right? It is a cash and margin projection. But the industry forces it into the P&L conversation, or even worse, they leave it out entirely until the exact day it becomes a literal life or death crisis for the desk.
That sounds, okay, let me unpack this. Relying on one P&L number to do all that, it sounds like using your car's speedometer to tell you how much gas is in the tank and also what the car's resale value is at the exact same time.
That is a great analogy. The tool just wasn't built for the job.
But why is this 3-way tug-of-war so much more violent in liquefied natural gas specifically?
Yeah.
I mean, you don't hear about this level of structural chaos in standard equity trading, right?
No, you don't. And that's because the physical realities of LNG stretch time and geography in ways that completely break standard accounting.
How so?
Well, think about the physical commodity itself. A cargo at sea takes weeks to reach its destination. For that entire voyage, it is financially marked but physically unsettled.
Right.
Or zoom out even further. Think about a 20-year term sale and purchase agreement, an SPA, a massive multi-decade obligation to buy or sell liquefied gas.
That's a huge commitment.
It is. And that massive commitment might appear nowhere on a standard balance sheet. The physical nature of LNG simply decouples those three numbers. The economics, the accounting, and the cash are just structurally separated.
Which means any manager managing their risk off that single overarching P&L number is literally flying blind.
Completely blind. To actually understand what is happening, you can't look at the whole month at once. You have to strip away the noise and break down the physical reality cargo by cargo.
You have to force your systems to attribute every single dollar of variance on a trade.
Yes. Every single dollar.
Okay, let's actually walk through a real-world example from the source material to show how this works. We'll use a real U.S. desk cargo from Chapter 1, and I'll round the numbers just a bit to keep us focused on the scale of the issue.
Sounds good.
So the desk's planned margin for this cargo was roughly $10.5 million. But when all was said and done, the actual realized margin came in at nearly $12.2 million.
So we have a highly favorable variance of about $1.65 million. We made $1.65 million more than we thought we would.
A great day on the desk.
A fantastic day. But that money didn't fall from the sky. A rigorous risk management function has to decompose that variance. So in this cargo, we have 4 explained drivers.
Okay.
First is feed gas. The Henry Hub price in the U.S. moved in our favor, gaining us roughly $669,000.
Okay, so the underlying gas we bought to liquefy got cheaper relative to our plan. Makes sense.
Second, we look at the basin. The European TTF price, that's our selling price, also moved favorably. That netted us about $937,000.
Also great news, we bought cheaper gas and sold it into a higher market. Win-win.
Third is freight. We suffered an adverse move in shipping rates, which is about $3,000 a day. So that cost the desk $66,000 overall.
Ouch, but manageable.
And finally, boil off. The ship spent 1 extra laden day on the water, and since LNG is a cryogenic liquid, it literally boils off and evaporates during transport.
Oh, right, the physics of it.
Yeah. That extra day cost us roughly $38,000 in lost gas.
Okay, so let me do some quick mental math on those drivers. If we add up the wins from the feed gas in the basin and subtract the losses from freight and boil off, our explained drivers total up to roughly $1.5 million.
Correct.
But wait, our total variance on the cargo was over $1.65 million. So we have an unexplained residual of just over $150,000.
And there is the ghost in the machine.
But let me play devil's advocate here. If I'm a senior trader looking at this report and I see $150K out of a $1.65 million net win, I mean, that's under 10%. It's about 9% of the variance.
Right.
In a market as volatile as global energy, 9% unexplained really doesn't sound like a crisis. Why shouldn't I just shrug that off as, normal market noise? Let's just go to the pub.
That instinct, that exact instinct right there, is how risk managers walk their desks into catastrophic failure.
Wow, really?
Yes, because you are falling into a massive arithmetic trap by measuring that residual against a net denominator.
Walk me through that. Why is the net number a trap?
Because net variance is incredibly deceptive. Imagine a different month. Imagine a scenario where a massive favorable move in your feed gas perfectly offsets a massive adverse move in your European basin price.
Okay, they cancel out.
Exactly. The two giant moves cancel each other out, and your net variance for the whole cargo collapses to near zero.
Ah, I see where this is going.
Right. So if your net variance is only, say, $5,000, but your ETRM model still has that same $150,000 unexplained residual, suddenly your residual ratio isn't 9%, it just exploded to thousands of percent.
Oh, man.
Your risk system will start flashing red. It'll generate pure panic and endless executive meetings over a fake catastrophe. The denominator collapsed, so the ratio exploded.
It's just an arithmetic artifact. The actual size of the error didn't change at all, just the illusion of the percentage.
Precisely.
So if net variance is a liar, what is the honest way to measure this?
You must measure the residual against the gross attributed movement.
Gross attributed movement.
Yes. That means taking the absolute sum of all your drivers, completely ignoring whether they were positive or negative. In this cargo's case, you add up the absolute values of the feed gas, the basin, the freight, and the boil-off moves.
So instead of netting them out, we're just stacking all the absolute changes together.
Exactly. And that gross number is about $1.7 million.
Okay. And when you divide the $150,000 residual by that $1.7 million gross movement, you get a ratio of 8.85%.
Right. The percentage happens to be similar in this one specific cargo just because all the big drivers were pointing in the same positive direction.
Yeah, that makes sense.
But the key is that the gross denominator is stable. It never collapses to zero just because a win canceled out a loss. It tells you exactly how much of the true economic movement your software model simply cannot explain.
Okay, so we've properly isolated this 8.85% residual. We know it's real. The next logical step isn't just asking how big the ghost is, but figuring out how it behaves over time.
Yes, the behavior is everything.
Because true measurement noise, just the friction of the real world, that should be random, right? But a structural error in your modeling software won't be.
That is the crucial distinction. And to find out which one you're actually dealing with, we use a highly effective, beautifully simple diagnostic tool. We call it the sign test.
But the sign test.
If a residual is genuinely just market noise, the plus or minus sign attached to it each month should act exactly like a fair coin toss.
Okay, think of it like flipping a coin. If you flip a coin 12 times and get heads 11 times, your gut instantly says, you know, this coin is rigged.
Right.
So if my desk has a positive residual in 11 out of the last 12 months, my natural instinct is to just calculate the exact odds of getting exactly 11 heads out of 12 flips to prove it's rigged.
And that is a classic statistical trap that we see analysts fall into all the time.
Really? Why?
Because a point probability, meaning the odds of getting exactly 11, cannot be used inferentially to prove significance. To determine if your model is actually broken, you must calculate a two-sided tail probability.
Okay, I might need you to translate that into plain English for me. Why isn't just measuring the 11 out of 12 enough?
Because it isn't just about that one specific outcome. You have to calculate the probability of a result at least as extreme as the one you actually observed.
Oh, I get it.
If you see 11 out of 12 months sharing a sign, you have to calculate the probability of getting 11 out of 12 and 12 out of 12. And because it's two-sided, you have to account for both extremes.
Meaning the odds of getting 11 or 12 positive or are 11 or 12 negative.
Precisely. You're testing the extremes of the distribution.
So it's about the likelihood of the model being that wildly off-center in any direction.
Exactly. And when you run that correct two-sided tail calculation on 11 out of 12, the probability is 0.0063.
0.0063. So 0.6 of 1%.
0.6 of 1%. At that level of probability, it is mathematically proven that this residual is not noise. Your coin is rigged.
Wow.
Something systematic, some fundamental reality of the physical trade is being left out of your attribution model.
You know, what I find so powerful about this sign test is that it doesn't require a PhD in quantitative finance or some massive stochastic model. Any desk manager can just open a spreadsheet, look at a column of plus and minus signs, and run this.
It is entirely desk ready.
Huh.
In fact, you don't even need 12 months.
Really?
No. With just 6 months of data, a clean sweep of 6 positive or 6 negative signs gives you a two-sided probability of about 3%. That is mathematically actionable.
So within just 2 quarters of launching a new desk, you can flag a systemic ETRM defect without writing a single line of code.
Exactly. It's incredibly powerful. But here is where the reality of running a desk gets really complex. The sign test fixes the mathematical blind spots in your model.
Right.
But what happens when your model is actually perfectly accurate, yet the firm's rigid accounting rules force your traders to make bad physical decisions anyway?
Oh, this is a massive issue. This is where the true economic reality and the corporate accounting reality just violently clash.
And when they clash, they create highly toxic behavioral incentives on the desk. Let's look at tolling fixed fees as an example.
Okay, these are the fees you pay for the right to liquefy gas at a facility, right?
Yes. And economically speaking, a fixed fee is a sunk cost. It is already paid.
Right, the money's gone.
Exactly. Therefore, it should be entirely excluded from the marginal decision of whether or not to lift a specific cargo. If lifting a cargo and putting it on the water loses the firm money, you don't lift it. You don't throw good money after bad, regardless of the fixed fee you already paid.
Right, that's just basic economics 101.
But standard accounting treats that tolling fee as a period expense. It hits the ledger this quarter.
I see the problem.
It creates massive visible pressure on a desk head. Put yourself in the shoes of that desk head. If your bonus is tied to that accounting P&L, you're going to feel immense pressure to lift an uneconomic cargo just to generate a little bit of revenue.
Just to absorb the fee on this period's ledger.
Yes. You are literally incentivized to lose economic value just to make the accounting report look slightly less painful for the quarter.
That is wild. You are actively destroying firm value to appease a spreadsheet.
Happens all the time.
And there are other examples where accounting hides value, right? Like cancellation rights on a cargo.
Cancellation rights are a perfect example of hidden value. Having the right to cancel a cargo is an incredibly valuable economic option. In the course data we use, at a TTF price of 3.90, that option is worth nearly $1.9 million per cargo.
Wow, 1.9 million just for the option to walk away.
Yes, but accounting rules usually carry that option at zero on the balance sheet.
Because it hasn't been exercised.
Right, so the desk's offtake position looks falsely terrible, and because the value isn't visible, the right is almost never exercised optimally.
This brings up a really important contrast that we track throughout this whole master program, which is the structural difference between a U.S. desk and an EU desk.
Yes, that is a vital contrast.
Because they operate under different rules, they fail in different ways, right?
That contrast is essential to understand. A U.S. desk mostly acquires permissions. Things like that tolling fixed fee or export license. You obtain the right once, you pay for it, and you just check it per transaction. It's a static hurdle.
Right, I have the permission, now I just trade.
An EU desk, however, mostly deals in demonstrations.
Demonstrations, you mean like proving compliance continuously?
Exactly. You are constantly proving things to a regulator for every single cargo that lands. You have to demonstrate regasification capacity. You have to track and prove emissions compliance.
That sounds exhausting.
It is. Think about that regas capacity in Europe. Economically, it's partly recoverable because if you don't use it, you can release it back into the market for a price.
Right.
But the desk's accounting often treats it as a sunk period cost.
So the EU desk and the US desk are fighting totally different battles. The US desk is wrestling with static permissions that distort the P&L, while the EU desk is weighed down by continuous demonstrations that hide recoverable value.
They feel differently because their infrastructure commitments and their regulators are entirely different. But the core lesson remains exactly the same.
Which is?
In both geographies, if you manage your team to the accounting P&L instead of the true economic reality, you will inevitably make the wrong physical trade.
Man. Okay, to really drive home the danger of these misunderstood numbers and these hidden model defects, we have to look at a real-world case study from the course material.
Oh, this is a great one.
This is a composite case of a desk that found one of those ghosts in their machine and how they reacted to it.
It's a perfect illustration of why you can never, ever get complacent on a trading desk. So this desk ran the exact sign test we just discussed. They looked at their data and found that in 11 out of 12 months, they carried a positive residual.
And it averaged out to roughly $150,000 per cargo, right?
Correct. Which means they had about $1.8 million a year flowing through their desk's result with absolutely no owner.
Now, human psychology is a funny thing.
Yeah.
Because that residual was positive, because they were making more money than their model predicted, the desk was relieved.
Naturally.
They just assumed, oh, we must be being cleverly conservative somewhere upstream in our assumptions. They literally patted themselves on the back and essentially ignored it.
Which is the most dangerous assumption you can make in risk management.
Yeah.
A favorable residual is not evidence of your trading skill. It is not a buffer. It is simply a model defect that hasn't cost you money yet.
So when they finally dug into it, what was the actual defect? Where was that 1.8 million actually coming from?
It was a heating value convention mismatch.
Heating value.
Yeah. The purchase contract for the gas was priced on a gross heating value basis and physically measured at the loading port. But the sale contract was priced on a different basis, measured at the discharge port.
So the physical reality of how the gas was measured actually changed between loading and discharging. But what did the ETRM software model say?
The ETRM software mistakenly used the loading figure for both legs of the trade. It completely ignored the change at discharge.
Oh, wow.
The residual was only positive because that specific convention difference happened to work in the desk's favor on that particular geographical route. It was pure geographical luck.
And their luck was about to run out.
Rapidly, because the desk was just about to open a reverse route in the Pacific.
Right.
On that new Pacific route, the geography changes, but the model stays exactly the same.
Yeah.
That exact same software defect would have generated an unknown massive adverse loss.
If they hadn't run the sign test, and if they hadn't hunted down the source of that positive residual, they would have stepped right onto a landmine.
It is the definition of flying blind.
So favorable unexplained money is still a massive defect, It is literally a ticking time bomb just waiting for you to apply a flawed model to a new market. So, looking back at all of this, the through line for anyone managing an LNG desk is pretty stark. You cannot let your systems blend your economic effectiveness, your accounting result, and your liquidity survival into one deceptive number.
No, you have to keep them distinct.
You have to measure your residuals against gross movement so you don't chase fake crises. And if you blindly trust a positive residual without running a sign test to find the structural flaw, you are just walking into a minefield.
And as we close out this chapter, I want to leave you with a final thought to mull over, tying this back to the failure chains we dissected in Chapter 8.
Oh, yeah. The bankruptcies.
Right. Go back and look at the LNG desks that blew up and went bankrupt. On the morning of those massive structural failures, every single accounting P&L line on their executive reports would have looked completely normal.
That is genuinely chilling. The ledger looked totally fine while the ship was literally sinking.
Because the ledger doesn't track survival. If your P&L reporting only shows period-end snapshots, do you actually know what your lowest cash point will be on the worst possible path to settlement?
I mean, if you're only looking at the accounting snapshot, no, you don't.
And if you don't know your lowest cash point, it doesn't matter what the accounting ledger says. You will run out of cash before you can ever prove you were mathematically right.
That entirely changes how you look at a spreadsheet. Next time, we are moving to Chapter 11, where we stop looking at your ETRM as just a piece of software and start treating it as the ultimate control architecture for your entire desk. Until then, keep digging into those numbers and question every assumption.
So imagine you're sitting in the cockpit of a commercial airliner, right?
Okay, I'm picturing it.
Right. And every single light on the control panel is green. The dials are totally perfect. The navigational computer is just flawlessly crunching the numbers, telling you that you are perfectly on course.
Sounds great so far.
Yeah, until you look out the window and realize you are flying directly into the side of the mountain.
Oh, wow. Yeah, that is terrifying. I mean, you're placing complete trust in this instrument that is perfectly, flawlessly calculating a completely false reality.
Exactly. And that is exactly what is happening on, multi-million-dollar LNG trading desks all over the world right now. Welcome to the deep dive.
It really is an epidemic on these desks.
It is. And today we're exploring some proprietary insights from Durga Analytics to understand why the very systems designed to protect global energy portfolios are often blinding desks to massive existential risks.
Yeah, the systems that are supposed to save them are actually part of the problem.
Right. And for those unfamiliar, the concepts today are drawn from their LNG Trading Desk Master Program. It's this incredible, comprehensive, 9-module, 120-chapter journey.
It covers everything. I mean, from the physics of liquefaction to market structure, curves, risk, you name it.
Yeah, but rather than starting at the beginning, we're jumping straight into the operational deep end of Module 1 to focus on a critical concept. Chapter 11, which is titled ETRM as a Control System for LNG.
And what's fascinating here is how often the fundamental nature of that system is just totally misunderstood.
Like, people just think of it as software.
Exactly. We usually talk about an ETRM as a piece of software. Companies treat it like an app. You run a procurement process, you buy it, you install it, and you expect it to just work.
But this material demands a complete shift in perspective, right? If you want a durable, profitable trading desk, you have to stop viewing your ETRM as a software product and start viewing it as a rigid control architecture.
That is the core of it.
Okay, so let's unpack this. When you say a rigid control architecture, you mean it's not just a giant calculator. It is a specific sequence of rules built into the daily workflow of the desk.
Right. The architecture consists of 6 calculation layers, and each layer exists to answer one specific question for the business. First, deal capture, which asks, what did we agree?
Right.
Second, position, what do we hold? Third, valuation, what is it worth?
Okay, and then you get into the risk side.
Exactly. Fourth is risk, what could we lose? Fifth is scheduling, so can we physically perform? And finally, settlement, what was actually owed?
Deal capture, position, valuation, risk, scheduling, settlement. I mean, that makes logical sense, but earlier you mentioned this architecture is rigid. Where does that rigidity create the blind spots?
Well, the blind spots come from the golden, unforgiving rule of this architecture, which is that dependency flows down, but detection flows up.
Wait, dependency flows down, detection flows up.
Yes. Calculation dependencies propagate downstream. So every single layer's output depends entirely on the reality presented to it by the layer directly above it.
Okay, so if we think about this like building a house, If the construction crew pours a crooked foundation, the deal capture layer, it doesn't matter how perfect the framing or the plumbing or the drywall are in the valuation and risk layers.
Not at all.
The entire house is still tilted. The drywallers aren't going to fix the foundation. They're just going to hang the drywall perfectly on a crooked wall.
That analogy captures the danger perfectly. A defect at any layer propagates downward and is never inherently corrected by the layers beneath it.
Wow.
I mean, a valuation engine cannot fix a deal capture error. It doesn't even know a deal capture error occurred. It can only value the wrong position incredibly accurately.
And a risk report cannot fix a position error either,
Yeah.
right? It just measures the value at risk of that wrong position with precise statistical confidence.
Exactly. So if the system flawlessly processes whatever bad foundation is poured at the top, you have to ask, what happens when that very first layer, the deal capture, is about to reflect the wrong physical reality entirely?
And this is where we run into a massive structural flaw on so many LNG desks. Because historically, the major ETRM systems were configured and implemented based on pipeline gas or power logic.
Right. And if you are trading pipeline gas, there is only one volume to worry about.
It's essentially an in equals out equation. The gas that enters the pipe at the receipt point is the exact same volume of gas that arrives at the delivery point.
In equals out. One data field for volume. Simple enough. But LNG is a completely different beast. You aren't pushing gas into a pipe. You are supercooling it to a liquid and putting it on a giant ship.
Which fundamentally changes the physics of the trade.
Absolutely. An LNG cargo is a living, breathing, shrinking asset. Because of that, a single physical cargo has 3 separately measured quantities, not one.
Right, there's 3 of them.
First, you have the nominated quantity. This is the volume the annual delivery schedule expects. Second, the bill of lading quantity. That is what is actually loaded at the flange at the export terminal.
Okay.
And third, the discharged quantity, which is what actually arrives at the receiving terminal after weeks on the ocean.
So let's put some real numbers to this, just to see how big a deal this is. Let's say our nominated volume for a specific cargo is roughly 3.88 million MMB2.
Okay, pretty standard.
The ship docks at the export terminal in the U.S. Gulf Coast. They load it up, and the bill of lading, the official loaded amount, comes in slightly lower at 3.87 million MMB2.
Right.
Then the ship sails across the Atlantic, arrives at the buyer's terminal in Europe, and the discharge volume is only 3.75 million MMB2.
And if we connect this to the bigger picture, we have to look at the commercial contract structure. Often, a desk is buying free on board, or FOB, and selling delivered ex-ship, or DES. This means the risk and title transfer at different points. The desk pays the seller based on the volume at the loading flange, the bill of lading, but they get paid by the buyer based on the volume at the receiving flange, the discharged quantity.
Okay, so the gap between what was loaded and what was discharged in our example is roughly 120,000 to 130,000 MMMP2.
Yeah.
And that is purely because of the physics of moving the cargo, right?
Yes, specifically boil off and heal.
Right.
To keep the LNG at minus 162 degrees Celsius, some of the cargo naturally evaporates or boils off just to maintain the cryogenic temperature.
And the heel.
Furthermore, the ship cannot empty its tanks completely when it discharges. It has to retain a certain amount of liquid, which we call the heel, to keep the tanks cold on the return voyage.
Ah, so preventing the metal from suffering thermal shock and cracking when the next cargo is loaded.
Exactly. So at a standard market price of, say, $9.80 per MMB2, that physical gap of boiled off and retained gas is worth over $1.2 million per cargo.
Over $1.2 million. And to be clear, this is not an unexpected financial loss, right? The trading desk already factored boil off and heal into their economics when they priced the deal.
Yeah, they know what's happening.
But it is a physical and commercial reality. That $1.2 million gap must be represented somewhere in the system.
And here's where it gets really interesting. If your multi-million-dollar ETRM only has one single volume field at the deal capture layer because it was built for pipeline gas, that $1.2 million gap literally cannot exist in the system.
There's just no data field for it.
It becomes a ghost. It registers nowhere in deal capture, nowhere in position, nowhere in the valuation engine.
The risk layer's completely blind to it.
Totally blind. It only surfaces weeks later at the very bottom layer, settlement. The back office team receives a purchase invoice based on the bill of lading, and they issue a sale invoice based on the discharged quantity, and the two don't match.
So it appears as a mysterious reconciliation break.
Exactly.
Now, playing devil's advocate here. Desks have massive back office and settlement teams specifically dedicated to resolving these kinds of discrepancies.
Yeah, they do.
So if the settlement team is eventually catching this $1.2 million gap when the invoices don't match, isn't that just the cost of doing business in a complex physical market? Like, the books eventually balance, don't they?
That is the exact rationalization that destroys the durability of a desk.
Really?
Yes, because when the settlement team investigates this gap, they often close it as a manual reconciliation adjustment. And they do this for every single cargo, forever.
Wow.
They think they are fixing a recurring data entry error, when in reality they are manually papering over a structurally broken system model. I mean, a stable, recurring manual adjustment of a predictable size is never an error rate. It is a model gap.
And a pipeline model dropping physical volume data isn't the only risk. It also drops regulatory data. The material draws a really stark contrast here between how a U.S. desk operates versus an EU desk, and why this control architecture breaks down differently depending on your geography.
Yeah, this raises an important question about regulatory mechanics. A U.S. desk mostly acquires permissions.
Permissions?
Right. You obtain your blanket export authorizations from the Department of Energy once, and then the system just basically checks that permission per transaction.
Okay, so it's a one-and-done setup.
Exactly. But an EU desk answers to a very different regulatory framework. They mostly acquire demonstrations.
Demonstrations, meaning they have to actively prove compliance over and over again.
Every single time. You have to prove and reproduce compliance, like strict destination tracking to ensure the gas didn't end up in a sanctioned market, or origin tracking for carbon footprint requirements for every single cargo.
So if the deal capture layer is sloppy, let's say the system just provides a free text box for a trader to type in the destination.
Sure.
The U.S. desk might survive that because they just need their blanket permission.
Yeah, sure.
But the EU desk is completely doomed.
Completely. Because if destination is a free text field, one trader types France, another types FR, and a third types the specific terminal, Montoir. The system doesn't know they are the same place. So downstream, when the EU regulator demands a demonstration report of exactly where every molecule of gas went that quarter, the ETRM cannot pull the data.
It just spits out gibberish.
Exactly. The defect at deal capture has now corrupted the regulatory reporting at settlement, and the desk is suddenly scrambling, digging through emails to prove they didn't violate sanctions.
Which brings us back to my devil's advocate question. I asked if having the back office untangle these messes was just the cost of doing business. But the cost isn't static, is it? We're talking about the escalating cost of correcting a defect based on where it is found in those 6 layers.
Right, the escalation ladder. The cost to fix a problem in an ETRM doesn't scale linearly, it explodes. The program outlines a staggering 260x multiplier.
Okay, walk us through this ladder. Because if you catch a bad data entry, like a misspelled destination or a missing volume field, at the very top at deal capture, the impact is minimal.
Yeah, if you catch it at deal capture, it takes about 1 hour of effort to fix. You just amend the field before anyone else relies on it. But if that bad data slips down to the position layer, it takes 4 hours. You have to amend the trade, rerun the position reports, and explain the sudden position change to the book runner.
And what happens when that bad data hits the valuation layer? I know this is the 15-hour friction point. Why does it jump so high?
Because valuation is where the quant and finance teams live. If the volume is wrong, the mark-to-market is wrong. When you finally catch the error, you are untangling complex curve mismatches.
Oh, man.
Yeah, you have to restate a financial mark and spend hours explaining 2 days of phantom profit and loss movement to the finance department.
And it gets worse, right? If the defect bleeds down into the risk layer, you're looking at 40 hours of effort.
Because now your value at risk, your VAR calculations, are corrupted. The chief risk officer sees an inexplicable spike or dip in the firm's exposure.
Cue the emergency meetings.
Literally, emergency meetings are called. You have to restate reported exposure to the risk committee and prove that the firm wasn't actually out of compliance with its trading limits.
Then we hit the physical reality. If the bad data reaches the scheduling layer, the cost jumps to 90 hours of wasted effort.
Right, because scheduling is where physical assets start moving. If the volume data was missing the boil-off, the scheduler thinks they have more gas arriving than they actually do.
So they nominate a delivery.
Yes. Counterparty ship owners are notified. The receiving terminal builds a regasification schedule based on that false volume. When the reality hits, you are unwinding physical logistics across multiple external parties.
Which brings us to the bottom of the filter, settlement. If the defect reaches the final layer, it takes 260 hours of effort to correct something that would have taken 1 hour at deal capture.
260 times more expensive.
Why? Why so much?
Because by the time it reaches settlement, it is no longer a typo in a database. It is a commercial negotiation.
Right.
A liquefaction plant, a shipowner, a receiving terminal, a buyer, and a counterparty's finance team have all acted on the bad data. Real money has moved. Physical assets have been committed.
And everyone now has a vested interest in defending their version of the right answer.
Exactly. You aren't fixing a database anymore. You are arguing over millions of dollars with external lawyers.
So, if the escalation cost is that brutal, the obvious solution is to force people to enter the right data at the very beginning. But desks usually try to solve this by telling a manager, hey, please double-check your trader's entries at the end of the day.
Which is an incredibly weak control. I mean, a human review is just a person looking at a screen, usually under intense time pressure right before they go home. You do not need human reviews. You need system validation.
A validation meaning the system literally puts up a wall and refuses to proceed.
A hard stop. The cheapest, most effective control on an entire LNG desk is making a field mandatory with no default value.
Okay.
If the system simply refuses to save a cargo without a specified heating value, or if you force that destination field to be a controlled drop-down list rather than free text, you instantly eliminate the downstream chaos.
You convert a fallible human check into an automated system refusal.
Exactly. It costs almost nothing for IT to configure, and it saves thousands of hours of back-office archaeology.
But let's look at the human element of this. When you start locking down the official system, when it refuses to save deals, or when it structurally only holds one volume field for a cargo that actually has 3, traders aren't just going to sit there and fail.
No, they won't.
They inevitably rebel.
Yeah.
And they do it by building their own spreadsheets.
Yes. The dreaded shadow systems.
It is a corporate crusade.
Yeah.
I mean, if you've ever worked on a trading floor, you know that IT and management wage absolute war against shadow spreadsheets. They view them as traders going rogue, being lazy, or trying to hide their actual positions.
Right. The standard corporate response is always a massive project to eliminate shadow systems, and it always fails.
Always fails.
Why? Because shadow systems are evidence, not misbehavior. They exist for a reason, and that reason is almost never laziness.
So if I'm a desk head and I walk the floor and see my team running complex Excel models parallel to the multi-million-dollar ETRM, what is that actually evidence of?
Well, a shadow system is a highly accurate user-generated map of the exact gap between the rigid ETRM architecture and the actual realities of the business.
Okay, so it's a diagnostic tool.
Exactly.
Yeah.
If a trader spends all day building a freight routing model in Excel, it's not because they love Excel, it's because the valuation layer in the system doesn't know how to price the boil-off variance between a steam turbine ship and a modern MEGI engine ship.
The system is blind, so the trader builds a flashlight.
That reframes it completely. The spreadsheet is basically a functional requirements document written by the person actually doing the work.
So it is infinitely more accurate than any requirements document an external consultant will ever write for you, which is why the material introduces a diagnostic tool called the spreadsheet test.
Yes.
Instead of blindly deleting shadow systems, desk leaders should ask 3 specific questions about them.
Right, let's run the test.
Okay, the first question is, does the spreadsheet hold data the system lacks? I'm assuming if a trader is calculating boil-off in Excel, because the ETRM only has one volume field, that means the system itself is structurally deficient.
Exactly. That is a system problem. The core model must be changed to represent the physical reality of the business.
So what do you do with the spreadsheet?
Until IT can fix the architecture, you don't delete that spreadsheet. You protect it, because it is currently a necessary control preventing the desk from flying into the mountain.
The second question, does the spreadsheet perform a calculation the system cannot? So this isn't missing data, this is missing capability. Like if an originator is running complex 10-year scenario planning on a liquefaction offtake agreement, the daily ETRM probably just isn't built for that kind of fluid analysis.
Right, which means this is a process problem, not a system failure. It is legitimate, complex desk analysis.
So you keep it.
You absolutely keep this spreadsheet, but you version control it, you document the logic, and you assign a clear owner so that if that originator quits, the desk doesn't lose the capability.
Okay, and the third question in the spreadsheet test. Does the spreadsheet just duplicate the system perfectly? Does it do exactly what the ETRM already does?
Yeah.
Now, wait a minute. Why would a risk manager spend 2 hours a day manually maintaining an Excel sheet that just copies the math the million-dollar system is already doing?
Well, this is the most dangerous scenario of all because this is a trust problem.
A trust problem.
Yeah. If someone with commercial responsibility is hand-maintaining a duplicate calculation month after month, it means they do not trust the firm's externally reported numbers. They are double-checking the ETRM because they genuinely believe the system is lying to them.
Wow. And they are usually right, aren't they?
Usually, yes. That requires immediate, urgent investigation. In fact, if you want a reliable barometer for the health of your trading operations, track the growing number of these shadow systems across your desk.
That makes total sense.
It is a massive leading indicator of desk decay. Even if your reported P&L looks great and profits are stable, if the number of duplicating spreadsheets is multiplying, the distance between your controls and your physical reality is widening.
The plane is off course. You just haven't hit the mountain yet.
Exactly.
So what does this all mean for you listening? Let's bring this all together. The core lesson here is that an ETRM system review that only checks if the internal math is correct is totally useless. The system will always calculate 2 + 2 = 4 perfectly. You have to check what the layers were asked to calculate.
Yeah, if you ask the architecture to value a single volume pipeline trade, it will do it flawlessly. It just won't tell you about the $1.2 million of LNG boil-off evaporating into the ocean.
The system is working, the model is wrong. If you are sitting there right now staring at 3 different Excel monitors just to figure out your true position, you know exactly what we are talking about. Look closely at your own daily operations. Go talk to your settlement team. If they're performing a manual adjustment that is stable in size and direction every single week, they are not fixing an error. They are patching a broken model.
And identifying these systemic gaps is just the beginning,
Right.
which logically transitions us into the next stage of the master program. Module 1 concludes with Chapter 12, which is Desk Leadership and Legacy.
Okay.
We zoom out from the ETRM entirely and look at the full life cycle of a trading desk. We explore the 3 core leading indicators of desk decay, one of which is that exact shadow system count we just discussed.
Right.
And we walk through a 10-point durability checklist that requires absolutely no software to implement. It is entirely about human behavior, governance, and leadership.
I can't wait to dive into the leadership mechanics next time. But before we wrap up, I want to leave you with one final thing to chew on. We talked about the escalation ladder, how fixing a defect at deal capture takes 1 hour, but untangling that exact same defect at settlement takes 260 hours.
260 hours.
If a single forced drop-down menu upstream can save a company 260 hours of brutal commercial disputes and millions in reconciliation headaches downstream, what tiny, easily fixable upstream constraints in your own life or your own business are you totally ignoring while you exhaust yourself fighting massive predictable fires downstream?
That's a great question.
Are you fixing the instrument panel so you can finally see the mountain? Stop papering over the gap. Fix the model. We'll see you on the next deep dive. You know, usually when we talk about a major financial failure, like a massive company suddenly going under, or I don't know, a specialized trading desk blowing up and taking millions of dollars with it, there's this natural expectation that the warning signs were flashing red for months.
Right, yeah. You naturally assume that failure is preceded by this highly visible distress.
Exactly. You picture panic traders, massive daily losses mounting up, a risk dashboard that just looks like a horror movie.
I mean, it feels logical, right? You think a sinking ship takes on water where everyone can actually see it.
But there is this counterintuitive reality in energy markets that completely flips that assumption on its head. If you step onto an LNG trading floor, the most dangerous time for a trading desk, the period where the foundational architecture is actually, crumbling beneath the trader's feet, isn't when the desk is losing money.
No, not at all.
The most dangerous time is when profits are at their absolute historical highest.
It is the ultimate paradox of risk management. And honestly, it's exactly why so many highly successful, seemingly invincible desks ultimately fail.
Welcome to this deep dive. If you've been following along with the architecture of the LNG Trading Desk Master Program, you know we are on a massive journey. We're talking about a sequenced progression across 9 modules and 120 chapters.
Yeah, going from the absolute basics of what an LNG desk is accountable for, all the way through execution, ETRM systems, and desk leadership.
Exactly. And today, we are officially wrapping up Module 1, which covers running an LNG trading desk, by diving into the capstone, Chapter 12, Lessons from Failed LNG Desks.
Which is a great chapter.
It really is. The mission today for you, the listener, is to learn how to locate a desk on its life cycle by looking at its hidden warning signs rather than, simply looking at its calendar age. And we're going to uncover the deeply uncomfortable truth about why controls decay.
And I want to clarify right away, we aren't looking at bad luck here. or sudden, unpredictable market crashes. Drawing on my decades of consulting and hands-on experience at Durga Analytics building and running these exact desks, negotiating long-term sale and purchase agreements, chartering LNG carriers, and designing risk systems from the U.S. Gulf Coast to Europe and Northeast Asia, I can tell you that failure is mechanical.
Mechanical. I like that word for this.
Yeah, we're going to look at the specific mechanisms of how a desk decays, how that decay stays perfectly hidden behind this veneer of record profits, and, well, how we actually fix it before the collapse.
So let's establish this life cycle first. The research lays out 4 distinct phases for any trading desk, right?
Right.
Build, peak, drift, and decay.
Exactly.
And the build phase makes intuitive sense. It's slow, it's cautious, and honestly, it's pretty unimpressive financially.
Yeah, you're not making headlines in the build phase.
All right. The risk controls being put in place are perfectly designed for the exact business the desk is conducting right then. But then you hit peak. And in peak, the controls fit perfectly, the desk is highly competent, and rule exceptions are incredibly rare.
And this is exactly where the illusion of calendar age really tricks management. Because a desk might hit the peak phase in year 2 and stay there for 15 years.
Wow, 15 years.
Sure, provided that the ownership is stable and the controls are constantly rigorously refreshed. But alternatively, a desk could hit peak and slide right into the next phase drift within 3 years just because of a simple internal reorganization.
So you can never locate a desk's health by asking how long it's been operating.
Never. You have to locate it by its symptoms.
Which brings us to drift, the absolute danger zone.
It is lethal. During the drift phase, the underlying business organically changes.
Like what kind of changes?
Or maybe the physical flow geography shifts, right?
Sure.
Where the regulatory environment in a target market evolves, or the team starts taking on totally different infrastructure commitments. But the controls, the risk frameworks,
Let me guess, they stay the same.
they do not change. They remain entirely static.
Let's ground this for you listening. Think of it like driving a high-performance car where the steering linkage is slowly rusting away. But because you happen to be driving on a perfectly straight, newly paved highway, which in this case represents a fantastic, highly profitable market environment, you feel like a world-class driver.
Exactly. The dashboard says you're making record time.
Right. You don't realize the steering is entirely disconnected until you are forced to make a sharp turn. And by the time you turn the wheel, it's far too late.
That is a perfect analogy. The gap between the official controls and the actual physical reality of the business just grows silently. And crucially, this rust accumulates while the financial results are incredibly strong.
So nobody notices.
Sometimes it happens during the best quarterly results of the entire cycle. And human nature dictates that absolutely nobody investigates a good quarter.
Okay, so if we can't look at the calendar age of the desk and we absolutely cannot trust the P&L because it's showing record profits, how on earth do you spot the rust before the crash?
Well, we have to look at 3 leading indicators. These are specific metrics that rise monotonically, meaning they just keep going up and up while the reported P&L remains perfectly flat and healthy.
These are the undeniable symptoms of drift.
Exactly. But to really understand how they manifest, we have to view them through the dual lens we've been using throughout the whole program. The deep structural contrast between how a U.S. desk operates versus how an EU desk operates.
Right, because even though they both trade LNG, they operate under fundamentally different frameworks and, frankly, fail in entirely different ways.
Yes. Let's walk through a day in the life. A U.S. desk mostly acquires permissions.
Okay, permissions, like what?
You obtain a permission once, like, say, securing long-term liquefaction offtake at a facility in the Gulf Coast, or booking firm pipeline capacity. And then your systems basically just check that permission per transaction.
Got it. And the EU desk?
An EU desk mostly acquires demonstrations. Delivering into Europe means you have to constantly reproduce proof of compliance for every single physical cargo.
Like verifying emissions profiles or terminal slots.
Exactly. So when drift happens, it attacks these specific operational structures differently.
Let's look at the data we have here from the source material, because the chart tracking these metrics is honestly haunting. It tracks an LNG desk over 8 quarters. The dashed line, the reported P&L, which is usually the only thing the board of directors ever looks at, is perfectly flat and stable. But underneath it, 3 other lines are just skyrocketing. Let's start with the first hidden warning sign. Override days outstanding.
Right. So this metric measures the accumulated distance between your official limits and the actual business being done. An override is simply when a trader or a scheduler goes into the system and says, I need to break the specific risk limit temporarily to execute this strategy.
And in the cautious build phase, that's incredibly rare.
Like extremely rare. But in the drift phase, it becomes a daily routine. In the specific case study we're analyzing from the text, the pure count of overrides grew by 800%.
800%. So they were just constantly overriding the system alarms.
Yes, but the truly terrifying part is the days outstanding.
Meaning how long those overrides were left open and unresolved.
Exactly. That metric didn't just grow by 800%, it grew by an astonishing 133 times.
That is insane. So how does that look on the ground for our two desks?
Well, for a U.S. desk, this might look like a trader constantly overriding the pipeline nomination limits. Why? Because the original permissions coded into the software simply don't match a new physical flow they've started trading.
And I'm guessing updating the system takes too long.
Exactly. Now, for an EU desk, it might be routinely bypassing the risk check that verifies terminal slot demonstrations. Because, the standard verification process is suddenly deemed too slow to capture a fleeting arbitrage opportunity.
It is literally the rust on the steering linkage in real time. And we mentioned systems. Let's define that quickly for the listener.
Yeah.
When we talk about these limits, we're generally talking about the desk's ETRM.
Yes, the energy trading and risk management software.
Right, which is this overarching digital architecture that's supposed to track every trade, every hedge, and every physical movement to ensure the desk isn't taking on fatal risk.
Precisely. The ETRM is basically the official brain of the desk, and
Yeah.
overrides are the traders actively lobotomizing it because the brain no longer understands the business.
Wow. Okay, which brings us to the second skyrocketing metric, the cost to reach flat.
Yes, this one is crucial.
This captures the financial movement up the obligation ladder to neutralize the desk of positions. And the case study numbers are wild here. The cost to flatten the book jumped from $7.3 million in year 1 to $29.66 million in year 5.
A massive jump.
But hold on, I have to challenge this. Looking at the data in that exact same year 1 to year 5 window, the desk's its value at risk, which is basically the gold standard of risk metric used by every major financial institution, it barely moved.
Barely twitched.
It went from $9.4 million to $10.1 million. The P&L was great. The VIR was stable. If the standard risk metrics are holding entirely still, why is the actual cost to flatten the book quadrupling? How is the math that blind?
Because standard financial metrics like VAR simply do not contain the information about the physical reality of LNG.
What do you mean?
Well, value at risk essentially assumes liquid markets and a normal distribution of price movements. It measures the potential loss on your mark positions based on historical price volatility. But physical LNG is incredibly lumpy.
Lumpy.
Yeah, you cannot buy half a cargo. What happens if a liquefaction train suddenly trips offline and you lose a cargo you were relying on?
You have a massive physical hole in your obligations.
Exactly. Your VAR doesn't tell you what it will physically cost to source replacement LNG in a scarce market. It doesn't factor in the cost of suddenly having to charter a spare LNG carrier or negotiating a spot charter party agreement at exorbitant short-term rates.
And VAR definitely doesn't calculate the physical physics of the voyage, right?
Not at all. It completely ignores boil-off the natural evaporation of the cryogenic liquid gas during the voyage, and it entirely ignores the rigid send-out schedules required to actually inject that gas into the destination grid.
So when the cost to reach flat triples,
it means the logistical friction and physical scarcity have fundamentally changed what the desk can actually survive, even while the financial VAR number remains perfectly sedated.
that is terrifying. Which leads directly into the third indicator, the shadow system count.
Ah, yes. Spreadsheets.
Right. Every shadow system is basically a manual spreadsheet built to bridge a gap between the official ETRM architecture and the real business.
And these are usually written by the analyst or the scheduler who is directly feeling the pain of that gap. You don't even need to audit what is in them. You just count how many exist each quarter.
So the raw number doesn't matter as much as the velocity of the trend.
Exactly. If you go from 3 spreadsheets to 30 in a year, you are in deep drift.
So what does this all mean for you, the listener, who might be sitting at an LNG desk right now? It means the warning signs are already sitting in your data. The research points out that computing these 3 metrics overrides, cost to reach flat, and shadow systems, requires absolutely no budget, no software vendor, and no new hires.
None. It takes a basic spreadsheet and a half hour of your time a quarter.
Which raises an incredibly important question. If it is that easy, why don't desks track them?
Because these three indicators share a property that makes them deeply unpopular.
Because they rise during the drift phase, which means they rise when financial results are fantastic.
Exactly. Raising these numbers means walking into a boardroom and asking a highly successful, highly profitable desk to explain itself. It requires confronting success with skepticism.
Hey everyone, incredible quarter, record profits. Quick question though. Why do we currently rely on 29 shadow spreadsheets to function? And why would it cost us $30 million to exit our current positions?
Yeah, that is not a fun meeting to initiate.
No, it is not. But it is the only meeting that saves the desk from the decay phase.
Absolutely.
Okay, so knowing the diagnosis is one thing. But how do we actually build a desk that withstands this drift in the first place? If we know the ETRM is going to slowly fall out of sync, how do we design better architecture?
Well, throughout Module 1, we generated various controls. Chapter 12 synthesizes them into a 10-point durability checklist. We are talking about decomposition, ladder limits, near-miss registers, flow aggregates.
And again, just to marvel at the design here, none of these require a massive IT overhaul.
Right. 7 of them are just records built from data the desk already holds, and 3 are strictly decisions about who is allowed to do what.
But the research pivots hard to focus on 4 foundational controls out of that 10. The fatal 4 that absolutely must exist before the first trade is ever executed.
Before the first trade, yes.
We have a mandate on 5 axes, reserve decisions with named holders, trigger prices, and a minimum tradable edge.
If we connect this to the bigger picture of desk design, this is entirely about the strict rule of sequence. Sequence matters more than completeness.
Meaning having 9 retrospective controls is genuinely better than having none at all, but
But a control applied after the fact is fundamentally compromised.
okay, wait, I have to push back here. Let's say I am launching a new LNG trading shop. Isn't defining a strict mandate on day 1 incredibly suffocating?
How so?
Well, why can't a desk just add these rules in year 2 when they actually have the budget, the ETRM system is fully built out, and they have the hard-won experience to know what limits actually work for their specific physical flow? To me, for you as the listener, it feels like trying to draw the out-of-bounds lines on a tennis court after the match has already started, just so you can hit a few balls to see how the court plays.
It's a really fair question. But a boundary set after you have crossed it is a ratification, not a limit.
A ratification.
Let's look at the minimum tradable edge, the absolute lowest margin you will accept to take on the risk of a trade. If you set that after the desk already has a massive book of positions, human nature guarantees that the math will be reverse engineered and calibrated simply to justify the existing book.
Oh, wow. So you aren't creating a rule, you are creating an alibi.
Exactly. Or take trigger prices, the escalation ladder of what happens when a position goes against you. If you write your escalation ladder during a massive market drawdown, it is being written by the panicked person who is currently holding the losing position.
They are going to write the rules to save their own job in that exact moment. They aren't thinking about the health of the desk.
Precisely. And look at reserve decisions. These are critical gates held by a named individual who has the explicit standing to refuse a trade. The very first time one of those gates is tested, it will be under intense time pressure with millions of dollars on the line.
So the holder of that reserve decision must already exist, with their authority completely unquestioned before the pressure hits.
Without a doubt.
So how does this play out across our 2 desk models?
Okay, on a U.S. desk, the mandate defines the permissions. What specific pipeline, interconnects, or liquefaction trains you are authorized to trade around. If you start trading a new, highly complex interconnect and then ask for the mandate to be updated to include it, you have just ratified rogue behavior.
You've proven to the traders that limits are just suggestions.
Exactly. Now, on an EU desk, it's about demonstrations. If your trigger price for escalating a delayed cargo is only defined after the LNG carrier is already spinning in circles outside a constrained regasification terminal in Rotterdam, you aren't managing risk.
You are just panicking with paperwork.
Panicking with paperwork while incurring massive daily shipping penalties.
It's the difference between architecture and archaeology.
Yeah.
You want to thoughtfully build the house on day 1, not dig through the ruins years later to figure out where the load-bearing walls used to be.
That's a fantastic way to contextualize it. But we also have to dispel a major myth here. Even with all 4 foundational controls firmly in place on day 1 and all 10 points on the checklist actively monitored, mistakes will still happen.
Which leads us to a fascinating concept.
Yeah.
because there's a very common misconception about this module, which is that it describes a magical, mythical trading desk with 0 defects.
Right, a desk where nobody ever fat fingers a trade in the ETRM or misreads a complex charter party agreement.
But no such desk exists anywhere in the world.
Absolutely not. Every single desk has defects because LNG trading involves immense complexity. You are dealing with massive physical logistics, complex contractual indexations, and price reviews. Things break. People make errors.
So the true measure of a durable desk is not perfection,
No, it is speed. We call this detection latency.
detection latency. The precise time between a defect arising and someone actually acting on it.
Yes, and the arithmetic regarding this is staggering. Let's say a defect occurs at the capture stage of a trade, like someone enters the wrong volume or the wrong delivery window. The cost of intervening early at what we call link 2 in the failure chain is calculated in our case study at exactly $15,000.
Okay, knowing you might have to buy someone an apology coffee, but totally survivable.
Totally. But if that exact same defect is allowed to propagate through the system, if the latency is high and it isn't caught until link 4 when physical operations have commenced and financial settlements are already committed, the cost to intervene explodes to over $10.4 million.
Wait, really? A 699x penalty? And that isn't from the market price moving against you. It's literally just the administrative and operational friction of unraveling the mistake.
Exactly. Think about what has to happen at link 4. The physical gas has likely already flowed to the wrong place. The counterparty has invoiced you. You might have breached the rigid delivery terms of a long-term sale and purchase agreement.
Oh, man.
Yeah, unraveling that requires hiring external lawyers, unraveling complex financial hedges, booking massive accounting adjustments, and potentially engaging in formal dispute resolution.
And the time cost data you brought up before. Correcting a capture defect right at capture takes about 1 hour of administrative work, right?
Yes.
But finding that exact same defect weeks later during a settlement dispute takes 260 hours of corporate unraveling.
It's exponential.
It is the difference between catching a massive typo right before you hit send on a legally binding contract versus hitting send, realizing it a month later, and having to issue a public legal retraction, hire a legal team, and completely renegotiate.
Exactly. The typo itself is the exact same. But the latency is what destroys your reputation and your wallet.
That is exactly it. The ultimate takeaway for LNG professionals, whether you are an originator hunting for deals, a scheduler managing the physical flow, or the risk manager running the ETRM system, is that a desk's return on its control investment is dominated almost entirely by how early it looks, and hardly at all by how thoroughly it looks late.
If you aren't fast, it doesn't matter how accurate you are.
Let's take a breath and look at the journey we have just completed. If you look at the architecture of the program, Module 1 has been massive. We have covered what the desk is actually accountable for. We have mapped out decision authority, how to measure flowbook leakage, and how failure mechanically escalates through a chain.
We really covered a lot of ground.
We did. And today, we have learned that you locate a desk's health by its warning signs, like override days, and the physical cost to reach flat, not its shiny P&L. We've seen why day one rules matter, and that driving down detection latency is your ultimate defense against the inevitable human error.
It is a massive milestone in the curriculum. Module 1 has thoroughly taught us how to run an LNG desk safely and accountably. It has given us the controls, the checklists, and the foundational organizational architecture. But notice what it hasn't taught us yet.
How to actually trade. We've built the safest car in the world, but we haven't learned how to race it.
Exactly, and that is the exact pivot we make next. We transition into Module 2, LNG market structure that actually matters.
That sounds intense.
It is. This is where we dive into the physical value chains, the specific contracts, the pricing indexations, and the brutal shipping constraints. We're going to look at where the actual numbers we've spent Module 1 protecting come from, and where the EU and US models diverge the most sharply in the physical real world.
I cannot wait for that. But before we wrap up today, there is one final, honestly chilling thought from the research that I want to leave you with. It is called the succession problem.
Ah, yes. This is the quiet, invisible killer of great desks.
The idea is this. A control any rule on your 10-point checklist is really just a recorded hypothesis about how a business might fail. It is a bet made by the people who built the desk.
Right.
But over time, people get promoted, people quit, analysts move to different companies. If the original team who designed your desk's controls has left, all you have left is the documentation of their conclusion. You have the rule, but you have completely lost their reasoning.
It's a terrifying spot to be in.
So ask yourself, are you currently sitting at a highly profitable desk where everyone follows the ETRM rules perfectly, but absolutely no one remembers why those rules exist in the first place?
Because if so, you might already be in the decay phase.
You might be driving that high-performance car, setting absolute record lap times on a perfectly straight highway, completely unaware that the steering linkage has long since turned to dust. Something to mull over before we see you for Module 2.